Dan. You're gonna have to. There we go. We're live.
We are live. We are live. Welcome, traders. This day has come. Trade Management Marathon is here. And over the next 6 hours, we are diving deep into the trade management from all the angles, exploring risk, money management, execution, and everything that separates great traders from all the rest. So we've got an amazing lineup for today of experts ready to share real and practical examples that you can apply right away. So here's what in the store. We have the expert insights from all the top traders that you're going to hear from today. We're going to have the actionable strategies to refine your trade management, no matter which strategies you use, no matter which trade system you use. We're going to host live Q&As where you will be able to ask experts any questions related to the trade management. And we have an exciting announcements. And for those who stick around, exclusive opportunities, which Alex is going to walk you through in a moment.
Yeah.
Right? So me and Alex are thrilled to be your host for today. We're going to make sure that everything runs smoothly. Right, Alex? How are you doing today?
Hopefully, we're a good team, you and I. So it's going to be good. This event is every kind of different event we've done when it comes to the boot camp, training week, and all of these different things people have loved. So now it's time to focus really on one of the most important things in trading, and that is risk. So it's going to be fantastic. I can't wait.
It will be. It will be. I'm myself really looking forward to learn from our experts who's going to be teaching today, because their experience altogether, the amount of years alone, not even talking about, the expertise that they bring to the table, is absolutely massive. So I'm really looking forward to that myself. I've got something to take some notes, so I'm going to learn myself today a lot of things.
Yeah, definitely. So we'll go quickly because Jordan is our first guest. But before we go into that, we'll just go through a little bit of the ground rules and some of the different things that we'll be going over. So first, the speakers will be coming up. If you have any kind of questions, there will be times within the presentation that we'll be doing questions. So write them. Anastasia and I will be going through. We're going to be marking them. So don't worry if your question doesn't get answered straight away. We will mark it and the person will answer afterwards. Now the giveaway. Okay, now you're gonna, if you're wanting to get involved in the giveaway, you're going to see the link that is going to be posted that will be able to enter into the giveaway. You'll have to wait for the code. The code will, in the middle of the presentation, will be pulled up on the screen. You've got a brief couple of minutes for you to see it. That code needs to be entered in for you to enter into the giveaway. And then during the breaks, we will be giving away 5 10K high stakes accounts for every break that we have. So all over, you're going to be able to get around 15 high stakes accounts if you're patient and you stay with us to the end. So there you go.
You better stay till the end for sure for some exciting, and also not only knowledge, but the giveaways that Alex told you about. So make sure to.
So let's get started because I know he's really excited to come on. We've got Jordon Mellor, an FX trader of going close to a decade now, also CEO of Tradelicious, which is a fantastic retail trading network. I'm just going to bring him on right now because I know how, that's such a lovely layout. Wow. Oh my God. So
Good morning.
Go. How's it going?
I'm well.
In Australia, no? It's quite late. Yes. It's quite early for you. What is it?
It is. It's just gone 5 p.m. It's 35 degrees. So if you see the bush moving behind me, it's because if I don't have the aircon on, my camera will turn off from overheating. But no, I'm doing well. We've had a fantastic day. I'm actually really excited to talk about risk management because I've got a funny one. I'm going to chat about something here that most people think they've already got down pat, that they don't need to pay any attention to. And I'm going to show them why it's costing them money. And I always like, as you know, in Tradelicious, we always like challenging the norm and diving deep and being curious. So that's exactly what I'm going to run everyone through today. So I'm looking forward to it. You're both looking very well today.
Jordan, you too.
Okay.
It's going to be good.
There we go. We'll pass it over to you when you're ready. Pull up everything, and we're going to be in the background, and I'm gonna pop in and out, and that's it. We'll see you in a bit.
Awesome. Let's get into it. All right. Well, everyone at home, thanks for joining me. I know I'm first up early in the morning here, and I know a lot of you will still be waking up. So I'm hoping you've got a hot, warm coffee in your hand, depending on where you are. It might be an iced coffee. And I'm also going to ask that you have a notepad a notepad and pen. Preferably a few pages, because you've got a long day ahead of you. And trust me, I've seen some of the things that are going to come out. You're going to want to be writing this down. As always, if you have any questions throughout my presentation today, I'm going to be disappointed if you don't. But make sure you put them in the chat. Alex and Anastasia are going to be behind the scenes, being able to pull those up. And at the end of the session today, I'll spare a little bit of time to be able to answer these questions. Risk management. I think might possibly be the biggest buzzword in the trading space. I think everyone knows it. Everyone knows its importance and everyone loves to talk about it. Not many people challenge it. Today, I'm going to attempt to do that. I'm going to go into an area of risk management where most of you probably don't look anymore. And I'm going to show you why it's so important to adapt to it. If those of you that don't know me, I have been trading for a little bit longer than what I want to admit. My age is catching up on me just a little bit, but I actually started out on a more professional side. I went into institutions, some unsuccessfully, some successfully, and attempted my pathway as a career into being a trader. And today I'm going to be talking about position sizing. Position sizing is something most people have down pat. We've got position size calculators, position size. You can find them everywhere. You already know. If I ask you, you probably already know exactly what position size you operate on, depending on the assets you trade. This is how I thought for a very, very long time. And then I walked into a trading firm in Melbourne, and I walked to this trading desk and I questioned them on how they did it. How do they go about risk management from a trader perspective? And this trader went through the 3 departments of trading. And we're going to cover all these today in some format. The trading strategy, which we won't dive into much, that's more personal to the trader. The psychology of a trader, which we all know well and truly is incredible hard to master. And then risk management. And he separated these 3 segments within this business. And what I found out as a trader applying at this firm is the traders themselves had no control over risk management. They didn't get a choice on the position size that was used. All they did was submit orders. They chose where to buy, they chose where to sell. That was it. They didn't get to choose the position size. And I found that fascinating because we all argue time and time again on whether or not you should be risking 1%, 0.5%, doing a fixed lot risk. We always argue on what's the best one to do. Well, these guys completely removed it from the trader's responsibility. In doing so, it's shown them some incredible insights. And today, I'm going to run you through exactly that. I'm going to show you how to step outside of your own skin, look at yourself as a trader in objectivity, and understand how you need to look at your position sizing. Most of you, as I mentioned, will know your position sizes. This is where it's going to get fun. So without further ado, excuse me, I just got message there. Without further ado, let me go ahead and pull up my presentation and we're going to run you through what I'm talking about. Now, this is the first slide. What is position sizing? That's a joke, right? I'm not actually going to dive into what is position sizing. I know a lot of you here are to learn the advanced concepts that our experience has given, and that's what I want to challenge. So instead of going through what is position sizing, which if you don't know, don't worry, the Fivers, ABL, Trade the Pool, and Tradelicious have an abundance of resources where you can find this information, or do a real simple Google and you'll get the answer that you need. What I am going to do is introduce you to James and Bobby. James and Bobby here are 2 incredible traders that have put their hand up and allowed me to analyze their trades to apply the best position size management system that I can objectively. James here on the left is a profitable trader. He's actually a really good trader. He consistently drives good returns. Bobby, on the other hand, is a little bit inconsistent. Okay, he's not quite knacked it. He's getting there, but it's not there yet. So what we're going to do is dive into both James and Bobby's system and apply a risk management strategy that makes sense for them. What I want you guys to do at home is to apply yourself. If you are a break-even or consistently profitable trader, from here on out, you are James. When I reference James, I am talking to you. If you're an unprofitable or inconsistent trader, from here on out, you are Bobby. When I mention Bobby, I'm talking to you. Everything that I go through, the processes that I go through, I want you to also go through. I want you to learn from it and go through this process. If there's anything I want you to take away from this presentation, it's how to perceive yourself as a risk manager, not as a trader. So these two have offered up 25 trades of history, which I think we all know is nowhere near enough to actually judge a system. But for the sake of this, we're going to use the 25 trades. Here's James's last 25 trades. Very impressive. Both of these guys trade the same strategy. It's just James is a little bit better. You can see his losses are all 10 pips. That tells me he's got a fixed stop loss of 10 pips. And his risk to reward ratio on those returns are anywhere between 2 to 3%. He's a very profitable trader. Bobby, on the other hand, trading the exact same system, it's not as sexy. He's lost a lot more. His win rate is nowhere near as high, and his risk to reward ratio is lower. They're both trading the same strategy. They just operate on it differently. If we had to look at these guys' equity curves, this is how it will be perceived. So James, the green line, is very profitable. After these 25 trades, he's actually got 349 pips in profit. On you, James. Good stuff. Bobby, on the other hand, struggled a little bit. After 25 trades, he's down 109 pips. What I am going to do today is apply various different position sizing methods to these guys' trades, okay? I am not going to alter a single bit of their strategy. Their results will always be 349 pips in profit for James and 109 pips in loss for Bobby. I am not allowed to change that. All I can change is the number of the position size. And doing so, I'm going to show you the power of position sizing. These are the three, and I've got good nicknames. I say three because the bet on green, I'm not going to lean into too much. But these are the three position sizing techniques that I'm going to share with you. We've got the Daredevil, the Steady Eddie, the Smooth Operator, and the bet on green. The bet on green is something you definitely should not do. For those of you that know me, I probably would have told you about this already. It's not something I recommend, but the mathematics behind it is very important to understand to apply it to something like the Steady Eddie. But let's start off with the Daredevil. At any point, if you resonate with one of these risk management techniques, I want you to scream at me in the chat. I want you to tell me that that is the system that you use. Say hello to the Daredevil. The Daredevil is like a raging bull. He sees red and he runs. There is no mathematics behind it. It is the same number of lots every single time they trade. They know what they're risking. They know where their stop loss is. They know the dollar value. They run at it. The raging bull, the Daredevil. If you're a Daredevil, let me know in chat. It's a very, very simple process. You figure out what lot you're comfortable with, what losses you're comfortable with. You trade the same size every single time. I've found out through insider information that James and Bobby are both Daredevils. So what I've gone and done is apply this to their trading strategies. In order to do that, I need to estimate the pip value. Both of these traders trade the euro US dollar, okay? And they're both consistently trading with a 10 pip stop loss. So stay with me as we move through here. To work out the pip value, it's very simple maths. It's pip size, which is usually your fourth decimal point of your currency pair, unless you're trading Japanese yen. It's usually your fourth currency point, decimal point, times by your lot size in units. One lot, 100,000 units of base currency. In this case, we're going to use 5 lots. That's 500,000 times 0.0001. That gives you $50. That was a lot of math. I know, I just threw it at you. Stick with me. Have your coffee. You got your pen. Stick with me. Just trust me. Okay. So this means every pip that moves, both of these traders either win or lose $50 in equity. Okay. Very, very simple maths. So when we apply this to their trading, on the left here, you can see James's profit and loss. On the right here, you can see Bobby's profit and loss. The color coding here really makes it evident on who's the more profitable trader. On the left, you can see James pulls in anywhere between $1,000 to $1,500 per win. And Bobby over here only gets slightly to the upside. He doesn't actually have $1,000 winner at all. But every time, both traders lose $500. That's because they're risking 5 lots every single time with a 10 pip stop loss. If we have a look at this in an equity curve, this is James. He's up $17,000. Most people who are in James's position, break even or profitable traders, will now sit back and think, I've mastered it, probably start a signals group. They're good, right? Most people will take their hands off. I'm going to show you exactly what James should be doing, not changing a single thing, but one digit on how he could be making more money. Bobby, on the other hand, is down 5.5, right? Bobby is close to blowing his account. He's stressed and he's close to getting to that point where he wants to do something a little bit crazy. Bobby, we're going to look at this a little bit differently. What we want to do is mitigate the loss. See, in Bobby's situation, and if you're a Bobby, in your situation, our goal is to ensure longevity so you can get enough data to identify the problem areas to increase your strategy. That's as simple as it is. For James, we're trying to mitigate drawdown and increase profit potential. For Bobby, we're trying to mitigate drawdown and increase longevity. That's our courses here. So let me introduce you to the next one, the Steady Eddy, the most used position size management tool in the world. This is the classic, reliable method that you've heard everywhere, only risk 1% of your account. How many people have heard only risk 1%? Only risk 2%, only risk 0.5%. These rules that you constantly get. How many people have heard it? I'm willing to guarantee you probably have. I myself am a Steady Eddy. I risk 0.5% per trade. Okay. This is probably one of the most reliable ways of managing risk and your position sizing. And the purpose for that is because it's relative. Okay. It grows with you, it shrinks with you. And that's very important. The idea of calculating the Steady Eddy is very simple. Your account balance time your risk percentage in a decimal point. Okay. And you divide that by your stop loss in pips and your pip value. Remember, we just went through how to work out your pip value. Take a screenshot of this chart right here if you want to know how to work this out, or anyone who downloaded the resource from signing up, you'll have all the calculators in there as well. For this example, we're going to be risking 0.5%. That's because what I personally risk in my trading. And I'm going to apply this to both James and Bobby's trading. After doing the mathematics, you can see the green writing on the bottom right of your screen down here. This brings us out at 5 lots. Funny enough, that's the same amount as the fixed lot. The difference with this is we do this calculation every trade. So as the equity changes, whether they win or lose, we recalculate this for it to give us the next position. Let's compare. Let's move it over to the trading portfolio. And as you can see, DD profit here is the Daredevil profit. And now we're moving into the Steady Eddy profit. So this is all in green, right? There's going to be no red. Even the losses are in green, just to highlight where we're looking at the Steady Eddy. You can see that these numbers are already differing compared to the left. In this circumstance here, you can see that James won $1,050, but using this Steady Eddy system, he actually made $1,155, an extra $100. He hasn't changed anything in his strategy. He hasn't altered anything at all. The only thing that I've done is change his risk management approach, change his position sizing. Same thing if we have a look over at Bobby's side, you can see some of these losses, they're all $500. Lose $500 every single time. But when you apply the Steady Eddy approach, as he loses more money, his risk management pulls in. Some of these losses are nowhere near as much. And this scales with the future. The best way to visualize this and compare it is by putting on a chart. Here's Bobby. Once again, the same trades, the same entry, the same exit. The only thing I have done is change his position sizing based on his rules. That's it. These lines look almost identical, but what you do see is the further down we get, the more that they separate. This is only 25 trades. You should be doing this with 2,500 trades. If you can't do 2,500, go 250. Meet me in the middle, okay? But the further that this goes, the bigger that gap here is going to become. And the bigger this gap becomes, right, the less money Bobby loses over time. It's very simple math. Then we move on to James. Apply the exact same thing. The difference is not only does it mitigate Bobby's loss, but it actually increases James' profits. See, James didn't do anything different. I just altered his position size. And as time has gone on to the 25 trades, but James has come through here and actually made an extra $1,000 with no extra effort, no change to the strategy, no new indicator. he made an extra $1,000. So Bobby managed to save himself about $150. James managed to make himself over $1,000 just by altering one little thing. Now, I'm repeating myself here, but the reason I am doing this is because I'm going to show you how to compare all of these. And the reason I want you to compare all these is because I want you to objectively look at your trading in the same way. The mission here, my mission here, is to get you guys to go through this exercise, to step out of the trader mind and not think about how you can improve your strategy or change the asset you trade or the frequency you trade, but just purely look at your results from a risk point of view and apply different position sizing techniques. That's all I'm asking. And that's what I want from you. And we're going to move into the smooth operator. The smooth operator chooses his position size based on how wild the market reacts. He uses some kind of volatility tool to understand where the market is going crazy and where it's trading in his prime spot, and he changes his risk accordingly. This is what that fund in Melbourne did. You see, traders would trade based on these units that were made up, coins, essentially. This was before crypto was a big thing. And what they would do is they would trade for points and coins on the system at the fund. And then there would be dedicated risk managers behind the scenes that would analyze their data and choose, essentially trade the traders, choose when they go heavier on risk and when they reduce the risk. That was fascinating. And the smooth operator approach was the way that they did it. And I want to share that with you today. But first, I've got a question. And this question has a very, very simple answer. It's either yes, no, or I don't know. Okay. And I want you guys to write this down, but I also want you to put it in the chat. You've either got to say yes, no, or I don't know. You ready for your question? Here you go. Do you personally, you at home, make more money when the market is more volatile? That's your question. Do you at home make more money when the market is more volatile? Yes, no, or I don't know. Okay, beautiful. Getting a lot of questions in here. A lot of answers. Lovely. Lovely. Wow. Okay. All right. We've got maybe 3 I don't knows so far. 3. Incredible. There's a lot of people that know their system in here. A lot of yes, definitely yes, no's. Awesome. All right. Fantastic. Fantastic. Well done. Here's the thing. For everyone that said, I don't know, give yourself a pat on the back. Because if you truly don't know, what you've just done is been very honest with yourself. And you've shown a spotlight on part of your strategy that you don't understand. So you've given yourself a bit of a pathway for research. So well done. If you said yes or no, I'm hoping that means that you know exactly what it is that your strategy performs well on and what it doesn't. I was surprised with how many yes and no's we got. The next question I'll ask, can you prove it? If I picked you at random out of this chat today and I asked you to prove it with data and statistics that you make more money when the market is more volatile, can you show me the hard evidence that suggests that is the case? That's the meat. That's what I want to know. If you can, awesome. Stick with me. I'm going to show you how to utilize that. If you can't, that's okay. Be honest with yourself. You may identify an area of issue or an area of research that you can dive into. But we cannot work on the smooth operator approach unless we know whether you perform in a better volatile market or a less volatile market. The smooth operator approach uses a volatility indicator. For today, we're going to use the ATR, okay? Not to enter or exit trades. We're not adjusting a strategy. We're going to use it for a different purpose, okay? And it selects different sizes of positions depending on the ATR. This is what that firm in Melbourne did. They looked at the traders, they analyzed who traded better in high volatility markets and who traded worse in lower volatility markets. And then they applied that to these traders without them knowing and enhanced their profitability behind the scenes. There's something in it with the traders not knowing. As retail traders, we don't get someone behind us analyzing it and altering our risk for us. Unfortunately, it's just us. Okay. So if we go ahead and have a look at a trading view chart, for example, let's just go ahead and get the ATR in here. This is the ATR of 200 on Euro US dollar. We know that both these traders trade Euro US dollar in the same trade. All right. You can see this is averaging up at 0.17 all the way through. We get in and around the 10s, the 14s. What is really important is to have a look into this and really understand where you perform best. Do you perform better? Look at your trade history when your ATR is much, much higher. Okay. Or do you perform better when the ATR is slow and steady and it's much, much nicer? Who knows, right? That's up to you to go. What I did was I looked back at Bobby. Okay. Now, Bobby here had an interesting pattern. My job was to identify this pattern as a risk manager. And what I found is Bobby, he had a 60% win rate when he just traded when the ATR was less than 14. If he just traded lower volatility markets, Bobby would have made money. He would be a profitable trader. Fascinating. But my job's not to tell Bobby to not trade those higher markets. Bobby trades his strategy. I'm not allowed to touch the strategy. All I'm allowed to do is change his position sizing. So then I went and looked at James and I looked for the same thing. Is there a pattern between the ATR and James's outcome? James's profit and loss. Is there a pattern? Not as much. You see, most of James's trades were at 14 or under on the ATR. This could be where James is performing better than Bobby, perhaps. But that's altering a strategy. I don't want to do that. What I did notice is anything above 14 ATR, James lost. It was only 3 circumstances, small track record, but he lost. So I set some new rules. I automated their position management. Whenever the ATR was at 9 or less, they're allowed to risk 0.75% of their account. Okay. When it's between 10 to 14, they're allowed to risk 0.5%. And when it's at 15 and above, they're allowed to risk 0.25%. I want to make sure that everyone understands these numbers are theoretical. I am showing you the theory of how this works, not something that you should use. This is based on these traders' reports. You need to have a look into your traders' reports and figure out what works. Okay. So I applied this system to all of 25 of their trades. So 50 trades all up, both for Bobby and James. And what I found was astronomical. See, applying this smooth operator risk management system, once again, not changing the strategy, same trades, same PIP outcome, same process, completely different profits. If we have a look at Bobby, this is now his equity curve. He's halved his loss. Didn't do anything different. Still traded, still lost the same amount of pips, but by looking at his position sizes from an objective point of view, he's managed to halve his loss. James, on the other hand, increases profits by about 40%. Same process. Every single one of these portfolios used the exact same entry, the exact same exit, the exact same strategy, and the exact same execution. The only difference was the position size. Many people overlook it. When they say, oh, I've got my risk management down pat, they go, I risk 1% per trade, I'm fine. I don't need to look at risk management anymore. What I really want to lean into today is show you the power of revisiting the things you learned as a beginner. This is different. You don't look at the trading. You don't look at your trend lines. You don't look at the support and resistance. You don't look at your entries and your exits. You look at your performance, and you trade your performance to either keep you in the game longer or to maximize your profits. For James, we took him from a $17,000 profit from 25 trades to a $27,000 profit in this circumstance. Okay. If the smooth operator is not you and you prefer a steady Eddie, Awesome. We increased his profits by $1,300. For Bobby, we took him from losing $5,500, gave him the steady Eddie, and brought that into 53. Okay. We applied the smooth operator. Now, this doesn't always work for everyone, the same system, and it brought him down to only a $2,000 loss. Analyzing your data to see which risk management system fits you is paramount on making sure, if you're Bobby, you're in the game long enough to learn, or if you're James, you're not giving away profits. Okay? That's the end of the serious part. That's the real message I wanted to send you. Now I'm going to share with you something called the bet on green. The headline here is very simple. It's just fun. Don't actually do it. If you're a James, this is going to be a great tool. It is going to boost your confidence through the roof and you're going to feel like an absolute champion. If you're a Bobby, this is going to be a real punch in the face. And I mean it. If you're not quite there, this is going to show you how far off you are. But I want it to be used as a motivator to do the right things to get where you need to be. This is the Kelly criterion. Okay, the Kelly criterion is a simple mathematical equation which shows you the absolute pinnacle that you can risk. I mean the tippity top. I mean, if you're a jet pulling G-force, if you go 0.1 G bigger, you blow up. That is what the Kelly criterion does. And I'm hoping that that gets your curiosity. This shows you the maximum risk that you can possibly take to get your maximum reward. I'm hoping that sinks in. Get the curiosity. What is the maximum? You ever sat there and gone, oh, let's just go crazy. What is this? This is what tells you your maximum. Now, the reason I'm doing this exercise is not so you go and do it because that'll be very irresponsible, but because the traders who are you, James, you're going to learn a lot about your system and a little bit more about your position management. For the traders that are Bobby, it's going to give you the slap in the face and the kick in the backside to do the right thing to get to where you need to be. I went through and had a look at all of James and Bobby's trades. Now, I'm going to speed this up a little bit so I can get to the Q&A for you as well. Okay. But long story short, I needed a couple things from this. I needed their win probability, their average win, their loss probability, their average loss, divided by their average win. So I have a look through their data, and guess what? I'm really quick at maths. I've even done it for you. There you go. Average win for James is $1,200, give or take. All right, his win percentage is 68%, which as a paramount means his loss percentage is 32%, and his average loss is $500. Simple maths, great trader. The average win for Bobby, on the other hand, was $507, win percent of 28%. That's not as good. The paramount opposite to that is obviously 72% with an average loss of $500. It's time to calculate the Kelly percentage. Let's start with James because James is profitable and it's nice to see what happens. James, let's fill in the document here. You can see his 68% win rate times by his average wins here. His 32% loss rate times by his average loss divided by his average win comes in at 0.5526. For everyone at home, that means, according to mathematics, in James's trading system over the past 25 trades, he could have risked 55.26% per trade. Every mature trader in here just went, there's no way you ever do that. Correct. There's no way you ever do that. But just for fun and maths, it does suggest 55.26%. That alone for James's last 25 trades would have brought him about $354 million. All right, outrageous. How do you actually use this as a normal, mature trader? The Kelly percentage is a fantastic way of knowing what your profitable factor or your profit factor is, but also, okay, how you perform as a trader. If you go through and you do the Kelly percentage, here's the calculation for it. Go do it yourself, okay? Not based on your projections, but what actually happens. If you go through and do this one step, I see that question, I like it. If you go through and do this calculation, divide the answer by 100. That is how I do my steady Eddie. I am a steady Eddie trader, okay? I use the Kelly percentage, or what I like to call the bet on green, taken from roulette. and I divide that by 100, and that makes my average risk. So there's a good little trick for you James traders in there. For you Bobby traders, let's do the same calculation. As you can see, we've got the average win rate, which is 28%. The average win is 507, 72% loss rate, average loss of 500 divided by the average win, which is 507.14 once again, same as above. That gives us a negative 0.4299. That means that the maths behind Bobby's system tells him to risk negative 42%. It is so far out of the mathematical equation that it's telling Bobby he should be risking negative 42%. Bobby needs to bring back 42% before he gets to a break-even point. Let that sink in. Now, that just seems detrimental, right? It's this crazy number that I've just thrown out in the maths that we've done. But the reason I'm sharing that with you is because it can highlight your profit factor and it can highlight your performance. All of the calculations I've done today are not projected outcomes. They are previous outcomes. I have the exact dollar value, the exact pip value that comes in. If you're a James trader, do this. Learn about your system. Do not do this. That is outrageous. Divide that by 100 and consider utilizing that. If you're a Bobby and you get a negative, put it on your wall, put it above you, and use that to highlight the problem areas within your trading system. Is it your execution? Is it the strategy? Probably not. Most times it's not the strategy. And really, really jump in. Guys, that has been my presentation here on position size management. What I want to do is open up the floor to questions, and I can see there's already a fair few in there. I will invite Anastasia back on with me as well, but I hope you enjoyed that little... I don't want that last little bit to discredit the rest of the information. That's a bit of fun, but I do hope you enjoyed having a look into it and learning how to really analyze your position sizes. Last thing to reiterate, looking back at those charts, let me bring it up one more time. Looking back at those charts on the equity curves, not a thing was altered in their strategy. I didn't tell them when to enter, when to exit, how to read the charts, or what to do. The only thing I did was change their position size and their process in looking at risk management, and look how different the outcomes are on the charts. There you go, guys. Thank you very much. How was that, Anastasia? Did you enjoy that?
Roland, that was amazing, to be honest with you. Guys, go ahead and drop in the chat your favorite takeaway from the Jordon session. Because mine probably was how just changing one little thing, you can completely reverse your results. Because you know, Jordan, how a lot of people, especially newbie traders, they think that they need completely to shift their strategies, and they keep hopping on from one strategy to another, from one strategy to another, and they actually never get to see, you know, their results if they would shift just one aspect, two aspects of their trading system. So I think that was really eye-opening. Thank you so much for that.
It was. Yeah, when it all goes back to when I walked into that firm and I tried to figure out how much capital I would be trading with, and they wouldn't tell me. And it was the first time that I had seen someone be a risk manager and someone be a trader. And that's when it clicked with me that retail traders, we do everything. We literally do everything. We were the risk managers with a psychology aspect, with the analysts. We do everything in one, and it's incredibly hard to do. That means you need to step away and analyze it from a different position within your business of being a trader. And today I'm really hoping a lot of you managed to see that, and hopefully you're going to go back and review your previous data as a risk manager, not as a trader. And I think you'll be amazed by some of the results.
This is so true. We have a lot of thanks to you in the chat, but we also have some questions, actually. Do you mind if we go through them?
Yeah, let's do it. Let's do it.
So one of the questions was about the ATR, right? So the ATR is based on which time frame, Patrick is asking, and what is setting that you use in your presentation?
So for this scenario, both James and Bobby were 1 hour traders. Okay, the 1 hour time frame. So I just used it on that. Now, this is very relative. The reason I use the ATR, it doesn't have to be the ATR that you use. It can be anything that measures volatility. If you prefer to use volume-based metrics, if you want to use the VIX, for example, perhaps it's all a matter of testing what works with your system, but having a look and just trying to see patterns, not on the chart. And this is where it gets so complex for people to see, but looking into volatility-based patterns and your performance and measuring those. And you'll begin to identify, if you can't notice patterns, that's okay as well. There might not be discrepancies between that. You might have to look somewhere else. Or you're going to see that, hey, when things are going absolutely crazy, I don't perform very well, like the scenario I just shown here. Or when things are going absolutely nuts, recent events, I perform really, really well, right? So you can really lean into what works with you. The ATR, I'm not going to dive too much into the settings because it's not actually important. The theory behind using the ATR is what I want you to concentrate on, not so much the ATR itself.
Thank you so much. So we got a lot of similar questions. So I hope that one answered all of them well, because a lot of people asking about the ATR. But we have one more complex question. So Barry is asking, would be this useful to add the Kelly ratio into the advanced statistics?
I think the risk managers at the Fivers would kill me. I argue they're going to kill me just for sharing the Kelly percentage ratio, because it is, as I mentioned, I call it the bet on green. It is the thing that you should never do. The way I use the Kelly ratio is, once again, is to divide up by 100. So 100 units of risk less than what that suggests is how I do it, okay? So I don't think the Kelly ratio is something you should live by. I don't think it's something you should ever test. It is based on previous performance, and it's the absolute pinnacle point based on your previous performance. It does not indicate any future. For example, with James, he went on to 435 million or something crazy, right? In that scenario, it told him to risk 55% per trade. That means if James just had 2 losses on the trot, he was gone. All of his money, everything was gone. Like, it is just not a smart way to position your money. Divide it by 100. The purpose of it is the theory. All right, the maturer traders are going to read into the theory behind the mathematics of the Kelly percentage, understanding that, and then applying that to something like the smooth operator or even the steady eddy will be really, really beneficial.
Thank you so much for that, Jordon. So just to clarify, because Igor is asking, and we had also several questions like this, are you using the specific EA for selecting the position size? Because you talk about automation, right? Because a lot of also people are struggling with controlling the risks manually. Like you said, if you're trading an institutional trader, you have someone who is behind your back and they are watching and they're like, okay, that's enough for today. You're done. Go take some rest. Your trading for today is over. But as a retail trader, you really do have this difficult point that you need to control it by yourself. And especially when emotions start ranging, that might be really difficult. And I think this takes years to master. So are you using some kind of automation?
I don't personally, but I do recommend it if you struggle with it. What I would love to do as even a test, and maybe we'll do this in the future for a future event, is take 20 traders and behind the scenes blindfold them to the risk, and we apply the risk behind the scenes and see how their data changes. In terms of using an EA, there's plenty of different tools out there for position size calculators and things like that. I've always been a firm believer in understanding the maths yourself. Any indicator I've ever used or researched, it's paramount that I understand the maths behind it, because I can't put money somewhere that I don't trust, as we all know that. So if you do choose to use some kind of EA, feel free, but make sure you understand the maths behind the system and how it works. Automating this, especially if you're a steady Eddie, you don't need any automation. If you're the first one, a daredevil, you don't need automation because it's the same lot size. But no, personally, I don't automate it. I like understanding the maths and doing the risk behind it.
Yeah, but you do recommend it if someone is a beginner and find it difficult, especially maybe for newbie traders, who just start and then trying to get into this and build this discipline over.
Realizing the risk is very important. If it takes too long and you're a quick executor, then yes, something automated is useful.
Yeah, perhaps.
I'm definitely a daredevil, and I'm super zoomed out. My camera has died. I don't know what has happened. My camera is the most reliable camera in the office. Don't know what you've done to it, Jordan. All of that risk management has just killed it. In a minute, I'm gonna have to go and get it sorted out.
I've told everyone to zoom out and look at themselves objectively. It looks like your camera wants to do the same with you, Alex. If you said you're a daredevil, judging by the data here, it might be the worst way to be.
Well, I can't pick. That's just how I am. But I'm sure there's a lot of people in the audience that are also quite similar.
Let's take your advice literally, Jordan, and zoom out and see it from the perspective.
Exactly.
Alex, technical difficulty won't come as a surprise. I bet that's Jonatan on the back end pulling that up.
100%.
Well, there you go. Okay, wicked. Well, thank you very much, Jordan. It was fantastic to have you on. We're gonna talk a little bit about the giveaway and pull up some accounts for some people, and then our next guest will be in the background getting ready. So, any last words, Jordan? Before
I hope I hit my mission today. My whole mission was to change your guys' perspective on how you look at position sizing. Most people don't even look at it because I don't think it's important. Purpose of this demonstration was to show you just how important it was, whether you're a losing trader, whether you're a beginner, a break-even trader, or whether you're a profitable trader. Having a look into how you position your risk is detrimental.
I definitely agree. Well, thank you very much, Jordan.
Thank you, Jordan.
And that's it. I just kicked him before he could say anything. But there you go. So there you go, guys. I know there's a lot of people asking about the giveaway. So you go into the link. You will be given the code has been pulled up on the screen. If you've had issues with it, go in again and try the code. I'll bring that briefly up onto the screen so you can use it. I'll give a couple more minutes and then we'll actually give the first 5 accounts away. But how was that, Anastasia? Did you enjoy that as well?
I did. I made some notes as well for myself, but I have this pleasure that I can reach out to Jordan and ask questions personally. So I'm going to use that definitely.
How lucky are we? Definitely. We're super lucky. But he's also available on Tradelicious. So if anybody else wants to go onto Tradelicious and sign up as well to his email list, the link and everything will be in the description of this video on YouTube. And for everybody that's actually asking, it is going to be able, will be able to rewatch the whole marathon if you want as well. So I know there's a lot of people working. Don't worry, it's going to be saved as well. So there you go. Now I'm just going to pull up my screen for a second. There you go. And we're going to give the first 5 accounts away.
Let's go.
There you go. So those are the first winners of the 10K high stakes accounts. So you'll be getting an email with hub credits with a link that you'll be able to obviously go and purchase those accounts as well. So we've got a couple more minutes before we actually bring Victor up when he's going to be talking a little bit about his risk management and many things. If you don't know who Victor is, amazing. I'm not going to ruin it for Anastasia because she's got a whole intro for him. But if you're coming to the trading room and things like that, you'll know Victor and everything that he does. But
let's maybe remind everyone who is new here about our trading room.
Go for it.
We have people who never heard about it before, or you are new here and you are completely for the first time on one of the Fiverr events. So every single week, there are several days in a row from Monday to Wednesday, there are more coming, where we host live trading room, where together with you, we look at the market, we analyze it in a real live time, and we look for some different interesting ideas. We also answer your questions, so you can bring your questions, trading related, strategy related, technical aspect related, anything that you need to those live sessions. And we are there, several different traders, right, from different places with lots of experience, helping you to become better and get funded with the Fiverrs as well. So make sure that you subscribe to the Fiverrs YouTube channel and get your notifications on about the next live session.
Definitely. And for everybody that's asking about the special account, there is an exclusive account for everybody that is a part or registered to the event. So on the weekend, you will get given a link where you'll be able to get that specific account. And nobody else is going to be able to buy this account. It is specific for the MasteRisk traders and people that are on this with us today. And all of the details, if you go into the Fiverr's MasteRisk Marathon landing page, you will have all of the details there. So if you scroll down as well, you've got the FAQs. You'll be able to find out all of the requirements for that account, and also all of the tools. So the tools that you've got from every single person that is doing their presentations. You've also got something from Alphabeta as well, which is a mindset course from Louise Bedford, because we can talk about risk management and talk about edge and everything, but even with all of those things, if you're too scared, if you're hoping, if you haven't got the right mindset when you're coming into the markets, that unfortunately, all of that can go out the window. So you've got all of that to make sure that you are, seems like a scam, the links are not working. We've got to bring that one up. Check the link again, mate, honestly, and you'll be able to do that. It's I'll bring it up as well if you need, but it's the link works and you've got a code as well. There you go. We'll wait for Victor to give the thumbs up that he is ready, and there you go.
So there is a question. So is there the deadline, Alex, for the purchase of the account?
No, whenever you've got the link. So anybody here, you've got the link. It's $50. So whenever you want to purchase that, if you might not want to purchase it, whatever, but it's in its exclusive account that has got specific parameters for everybody that's in there. So it's not going to come around again. So it's going to be a little bit of a missed one if you don't get it.
Exactly. Definitely.
Okay, Victor, are you ready? Give us a little bit of a heads up. There you go. Okay, so he seems ready. I'm going to pull him up. There you go.
Hello.
Hello. How's everything going?
I'm doing fine. How about you guys?
Yes.
You're doing amazing. Really excited to have you here, Victor.
Thank you.
Alex?
Same as I'm excited, and I hope everyone watching this is exciting as well, because man, this is important stuff. What we're gonna be talking about, not only my presentation the whole day, and it's all good stuff for traders.
I wanted to keep it a surprise, but Alex already pulled you out.
No, sorry about that.
But
No problem.
nonetheless, guys, who doesn't know Victor, right? For those of you who follow our live trading sessions, you see Victor every single week. You know how much value he is ready to bring to the table. Victor is a trader who's been trading since 2018 and has developed a very strong focus on the risk management throughout this long journey. So he's already a funded, successful trader, and he's learned to find how to approach the risk management from the best angle. And we all know how crucial is this part of your trading strategy. Today, he will be sharing with you his key insights on this specific topic. So make sure you have some notes, something to take the notes from Victor, because I'm sure there will be lots of value. And for me as well, I'm ready. I'm ready for you, Victor. Are you?
I am certainly ready. I hope everyone is as well. Are you excited? Let's get started.
Go on then. I'm going to leave you guys to it, and I'll see you a little bit later. See you later, guys.
See you, Alex. Victor, I'm going to be back, make some notes, and the stage is all yours. We are excited to see you here.
Thank you. Thank you, Alex and Anastasia. Thank you for that introduction. I'm going to put my let me see. Is that the yeah, exactly? That's a little bit better. All right. So today, my presentation is going to be about mastering risk in this MasteRisk online marathon. Trade management cannot miss, right? So I'm going to be talking about how to protect your capital and stay in the game as long as possible. And if you don't know me yet, I'm Victor. All right, so let's get going. What are we going to be discussing today? Of course, it is never enough time to talk about risk management. But first off, I would like to start with a general idea of what is risk in trading, right? Then we will be, if we are trade risk managers, and we are as traders, before you can do anything about the risk, you need to be able to identify what the risks are. So we're going to be listing all the different types of risks that a trader has to deal with. And then I'm going to be asking, or not asking, I asked myself as I was preparing this, I was thinking, what can I give you guys watching this that is going to help you elevate your trading the most, right? And I chose these two. One is the available risk capital concept. Very important. It isn't applied enough, in my opinion. And the other one is the optimal risk strategy, the FFR. I'm going to be talking about it later. And on the last one, just to let you know what I'm talking about, what if I tell you there is a way to increase your profits if you have a profitable system, a strategy, and if you're not profitable yet, will make it very hard to lose your account? Wouldn't you be interested? That's exactly what we're going to be discussing today. So stay tuned, and let's keep on rolling. All right, so introduction to risk management in trading. What is risk in trading? If I ask you, what do you think is, what would you answer? Of course, the first thing that comes to mind is, well, the risk in trading is, of course, that you're going to have a loss, right? It's the from the distance from the entry, from the moment you enter, the distance from that entry level to when where your risk, your stop loss is put, right? And yes, that is obviously that's a risk in trading, and that is one of the things that we will list or will name. That's the the risk as you are in the trade, right? Very important, and we'll discuss different ways to mitigate or to handle this the best way. But is that the only risk you have as a trader? Of course not. And so when you think about it, risk is not only in the trade, it is actually anything that threatens the survival of the account. Anything, right? It's much broader. And you could also say not only the survival of the account, it's the capital, of course, in the account. Okay, so we're going to be talking, when you think about that in a broader perspective, you can understand that it is much more than just the risk that you run while the trade is open. All right, so let's identify the different types of risk that as a trader you need to be mindful of, need to recognize, identify them, and have a plan, have thought about them to how to mitigate, how to minimize that risk, as you should as a risk manager. Okay, so what kind of risk does the trader have to think about? Well, the first thing was what we just mentioned already, which is the strategy specific risk, right? All strategies, including profitable strategies, of course, have losses. No strategy is immune to losses, even losing streaks. Now, every strategy has a fluctuation in their returns they give you, right? That's inherent to every strategy. You cannot avoid that. And if you don't handle this risk or adapt your position sizing adequately, just this fluctuation already can make you lose the account, right? So it's a risk. This you mitigate this, of course, through position sizing, and we'll discuss a little bit about position sizing is, of course, how much you risk per trade, and we're going to be discussing the best way to do that. So besides, even if you have a profitable system, a profitable strategy, and there are risks that are inherent to the strategy, you also have to think about the risk that the trader brings to the table. What do I mean by that? Well, in order for you to get the results that you have backtested and that you know about your strategy, that's the reason why you're using it. And in order for you to get that result, you need to actually execute the trade plan. So anything that stops you or impedes you from executing that trade plan perfectly is a risk, right? It can be something like distractions, not being available at the times that you're supposed to be available as a trader. Or it can be as well emotions, right? If you're not able to handle losses as a trader, that may push you towards taking trades that are not part of the trade plan. Trades that are not back tested, that probably most likely don't have an edge in them, meaning they're gonna cause you capital. They're gonna result most likely in losses. So that's a risk. And as well, human errors, right? With human errors, we just think about a trade, opening a trade perhaps 10 times bigger. Hasn't that happened to any of us, right? Maybe not 10 times, but more than you should. That's a risk. And that can happen, right? Human error risk. All right, so these are the strategy and the risk specific to the trader. And even if you're trading an EA, you think, well, I don't have those emotions, those timing and human error issues. An EA can still have problems or faults in the coding, or something can go wrong with the EA, that it is not executing the plan as it happens all the time, right? So that's the trader specific risk. Then you have market specific risk. The first thing that comes to mind, of course, is the high impact news, right? These are, think about the NFPs every month, the rate decision we have every so often. At these moments, even if you have a profitable strategy and you execute as the trader the trade plan to the T, you can still have bigger losses than you planned, losses that will pose a risk to your account. Because in those moments, of course, it doesn't happen all the time, but during high impact events, prices, the market can gap up or down many tens of pips. It can be in your favor, of course, but also against you. And if in those times, if you are very close to that current level, or your stop loss is very close to where the high impact news hit the market, then your stop loss will most likely not be executed at the desired level, meaning you're going to be losing more than you plan. That's a risk. And so how can you mitigate, you ask yourself, the high impact event risk? Of course, it is by avoiding those incidents, if possible, by either closing the position before these news or hedging them, right? And there are another what comes to my mind is, if you haven't it's good to consider that there are high impact events typically are announced, right? You can see them on Forex Factory, on those calendars. There's economical news release calendar, but there are also central bank interventions that are typically not pre-announced, right? They happen on surprise. One incident that comes to mind right, that makes you think about these things is in 2015, on the 15th of January, the Swiss National Bank decided to depeg the Swiss franc from the euro. And that decision, that intervention caused that the pair euro Swiss dropped 1,300 pips. Yes, you heard it right, 1,300 pips in minutes, right? That is something real. It can happen. It only happened 10 years ago, and it may not happen as big as this one. This is a very extreme case, but these things can happen, and you have to have an idea. You have to at least have thought about this. In such a case, what will you be doing, or what have you done to accommodate this risk? One of the things that you can do, of course, in such a case, there's very little you can do, right? Because 1,300 pips against you, that's going to, cause the loss of the account if you have a position open in that pair. That's very highly likely. One of the things you can do is, of course, not have all your capital in that trading account, right? That's one thing. The other thing that you can think of is if you're trading your own funds, you could make sure that the brokers you use, right? I know this is a prop firm event, but this is risk in general as traders. If you're using your own capital and you got to be using a broker, of course, you need to make sure that broker has negative balance protection, right? If this were to happen in the future again, and you're affected, you're going to be very thankful that you have that negative balance protection. Some traders that had positions open during this incidents not only lost their capital that was in the trading account, the loss that they incurred was even bigger than the balance that they had. So they ended up owing money to the broker. I mean, that's a major risk you want to at least have thought about and done something for it. Okay, so all right, let's continue. Then you have not so impressive risk, but still a risk that needs to be thought about in beforehand, which is infrastructure risk, or the risk that technology might fail. And what I mean by this is anything that impedes you impedes you from accessing your account. And that can be the loss of electricity, loss of internet connectivity, or of course your PC could fail. This may not sound something that happens very often, and it doesn't. But it can happen as a risk manager, you need to have at least thought about it, as I said, and have a backup plan. It can be as simple. It's not a big thing, but it's a good idea to have a solution ready. It can be as simple as having MT5 on your phone already with your account, everything put in. In the event this were to happen, you are easily, within minutes, you can regain access to that your trading account, and perhaps take that trade off before high impacts it comes in, or perhaps put that stop loss that you didn't get to put in because of the loss of internet connectivity. And of course, in the Western world, you say or think this always never happens, and that is true. However, in other parts of the world, losing electricity might not be something so sporadic. So it's a good thing to think about it, because it can be a risk to your account as well. Then you have capital risk. And I know it sounds weird, because this is not something you talk about as a trader very often, but it is real. One of the goals we have as traders, right, is to create income, right, when you're trading a prop firm account. You want to get the profits. Yes. And eventually you want to increase your net worth. And by doing so, once you have enough capital, you've increased and you have more than when you have enough, you're going to be wanting to trade your own capital as well. Actually, that's one of the goals. Alongside your prop firm accounts, you want to have your own personal account trading. So when you are in that phase and you're actually doing that, you're running capital risk. What is capital risk? Well, if you save or invest or trade, you have to deposit that capital into a bank or a broker, in any case, a financial institution, right? And that institution becomes the custodian of your capital, right? It's yours, but you don't have it. They have it. So they have the responsibility to safeguard properly this capital against risks as mismanagement, fraud, cyber attacks, and so on. So this is something real, something you need to think about beforehand, right? One of the ways that regulators mitigate this risk is to obligate that custodian have they segregate the client's money from the money or the funds from the brokers, as in this example. If anything happens to the broker fails, the client's money is safe because it's separated, it's segregated, right? That's how you handle segregation risk, right? Segregation risk is, of course, when a broker or that financial institution doesn't segregate properly the funds of the clients. So how do you mitigate this risk? You can already maybe guess how it is. It is by choosing your custodian wisely, right? Choosing one that is well regulated and is choose an insured custodian, meaning one that is, in case of any losses, you can recoup your money with compensation schemes and so on. These things you have to think in advance, of course, right? Once your money is already there, and one of these events were to happen, it's already way too late, okay? And there's nothing worse than having spent years learning how to trade, getting the capital, and then losing it on such an event, right? So very important, capital risk. As a manager, as a trade manager, you need to be, as a risk manager, you need to be aware of. And that is also one of the benefit of trading with a prop firm. Since it is not your capital, you don't run any capital risk. The only risk you run is, of course, the fee that you paid, right, to get the evaluation account. And if you have had at least one or more withdrawals, probably that you don't even have that risk anymore because you recoup that risk as well. That is the great advantage of trading prop firm accounts. If anything happens to the capital, it's not your risk, okay? However, there is one last one that I want to mention is that, of course, since you're trading with a prop firm, you do have prop firm insolvency risk, meaning if the prop firm fails, you will lose the account, of course, right? And any profits that you might have in the account. You might not lose, it's not your capital, but you're still losing something and perhaps the fee as well. How to mitigate this risk? Of course, the way to do it, right? The way to minimize the risk of prop firm insolvency is, of course, choosing a solid prop firm, right? Like the Pfeiffers, one that had stood the test of time, that is not here just recently. So when you choose your prop firm, you better choose it wisely. You don't want to go after, flashy discounts. You want a solid prop firm. All right. So these are the risks that a trader needs to at least have thought about, okay, and have a plan about, have a plan B or a contingency plan, just in case anything happens, you are covered, or at least you have minimized your risk. Okay, now that we have listed the risks that you need to have addressed, I want to talk about the available risk capital. What is it and why do I think it's so important? When you have a trading account, right? A prop firm account or a trading account, how much capital is really available to you, right? How much capital can you really risk? Well, it depends on the risk tolerance of that account. Is it a personal account or is it a prop firm account? If it is a personal account, then you decide what the risk tolerance is. Are you willing to lose 10% before you stop, 20, 30, 50%, or simply the whole account? You decide, right? In the case of the prop firm account, of course, the prop firm decides for you, right? The max loss limit that is, right? So let me give you an example why this is important. At the Fivers, we have 3 different programs. High stakes account. Let's say we compare the available risk capital on the high stakes account and the boot camp. Both of them having the same 100K balance, right? All right, the max loss on the high stakes account is 10%, meaning that's once you reach that max loss limit, you lose the account, right? The account is no longer tradable, it's disabled. So 10% of 100,000 is 10,000. That is the available risk capital on the high stake account. Now, what is it on the bootcamp account? The bootcamp account on the funded stage is 4% of the balance, right? On the evaluation account, it's 5. But on funded stage, it's 4. Meaning, if it reaches that level, the equity, you would lose the account. So the actual available risk capital on the bootcamp account, the 100, the same balance as the high stakes account, is going to be 4,000. As you can see, the same balance of both accounts have complete different available risk capital available. So why do we use the balance to calculate position sizing, right? To manage our risk. If the balance isn't what is relevant, it is the available risk capital. So the conclusion of this is that using available capital for your position sizing is far superior than using the balance. Very simple, but very important. I'm going to give you an example and to illustrate this a little bit further. Assume you have a trader that is risking 1% of the initial balance. That is something we hear all the time. And let's say the initial balance is 100K, right? That person is going to be risking 1,000 per trade. 100% sounds conservative, right? Just 1 out of 100. That's not a lot. However, since the max loss on that account in this example is 10%, that would be a high stake account. 10% we already saw previously has $10,000 available to trade with. What the trader is actually risking is not 1%. Yes, it is 1% of the initial balance, but that's not very relevant. If you express it as a fraction or a percentage of the available risk capital, the actual capital that matters, the actual figure that matters, then that person is risking 1,000 out of 10,000 available risk capital, meaning 10% of its available risk capital. Now that you can see that's differently than when you thought about it was only 1%. Okay. So, and this is actually the actual risk, not the 1%. So after 5 losses, his balance would be, right, 95,000 if that person were to use a fixed dollar amount risk, meaning he's going to be risking the same amount each trade. After 5 losses, he's going to have 100,000 minus 5 times 1,000, meaning minus 5,000 for the 5 losses. He's going to have 95 in his balance. And if he were to continue doing risking 1% of the initial balance, right, 1,000, what would his risk be? He would be risking 1,000 still, but how much available risk capital does he have? In this case, he would have only 5, right? He had 10 to begin with, and he lost 5. So he's going to lose. He's only have available 5,000. So he's actually risking, right? The relevant metric, the actual risk metric is he's actually risking 20% of his available risk capital on the next trade. As you can see, his risk management is by no means conservative, right? This illustrates that you should not be using the initial balance for your position sizing. Okay. Once again, as I said, that's the correct conclusion. You should be using the available risk capital. It's far superior for your position sizing and thus for your risk management. All right. Let's talk about, that's the available risk capital. Very important, very simple, but fundamentally important. Now let's think about, let me show you, I ask you what were you, if you would be interested in a method that would increase your profits if you had, or if you have a profitable system, and would make it very difficult for you to lose your account if you have an unprofitable system or an unprofitable period. In risk management, there are many ways to do your position sizing, how to calculate what, how to assess what to risk on your next trade. And let's just, for simplicity's sake, discuss 2. The first one, very popular one, is the fixed amount risk, and that is the fixed dollar amount. What is it exactly? Right? It's something that a lot, I dare to say, most people use. At a 100K account, you're going to be risking, in the case that you're risking 1% of the initial balance, you're going to be risking 1,000 on each trade. That means you're going to be risking 1,000 on the first one, and also on the second one, and every subsequent trade, no matter what happens to the trade, if you go, if you have a winner or a loser. Okay, that's the fixed dollar amount risk. It's very simple to calculate. You only calculate it once. It's very easy. It's clear, but it is not the best way. I propose to use instead of a fixed dollar amount, to use a fixed fractional risk, right? A fixed percentage risk, right? How does that work? If you have a $1,000 account, and you're going to be risking 1% of that, assuming that the 100K is the available risk capital, and you're going to be risking 1% of that available risk capital, you're going to risk 1%, 1,000, right? 1% of 100,000, that's 1,000. However, that means that the first trade will be 1,000 you're going to be risking. But depending on the outcome of that first trade, your available risk capital changes, right? So you calculate it again, and using a fixed fraction of that available risk capital. That is much superior than the fixed dollar amount, and I'm going to show you why. In the case of a fixed amount risk, on average, if you have a profitable system, let me see if you can see my cursor. Yes. If you have the upper line on this graph, if you have a profitable system, what will happen in time is that your account or your balance will grow at a fixed rate through time, right? So no matter how much the account has grown in time, you're gonna still keep on growing at the same rate. And in the case that you have a unprofitable system or strategy, the same applies, but negatively, of course, meaning that you're gonna be losing the same amount on average going forward. That's the fixed dollar amount risk. And in the case of a fixed fractional risk, which is better, what happens is that since you're calculating the position sizing after each trade, right? Since you're applying that same fixed percentage to know what you're going to be risking, if you have a profitable system, when you are winning, you are going to be using the same percentage of a bigger risk, available risk capital, meaning that even though your risk doesn't go up, right, the percentage that you're risking is the same. Because you have more capital, because you're winning, of course, that means that your dollar account, your dollar amount that is being risking is going to increase, but without increasing risk. Okay, and what will happen is that you will have an exponential growth in your account. This is real. The other applies as well if you have a unprofitable strategy, or simply you have an unprofitable period as a trader. What happens is, since you are calculating your position sizing as a fixed percentage of the available risk capital, when you are losing, your capital decreases, of course, right? You are getting those losses. That means that since you're using a fixed percentage, that means that because of your capital is decreasing, that means also that you're going to be automatically risking less in dollar terms, but your risk is going to be the same, right? And what does that have do to your equity curve? You will have an exponential decay, meaning that as you go into a losing streak or a losing period, you're going to be losing less. This is extremely powerful for your account. Do not underestimate this. You get the best of both worlds. If you have a profitable system, you're going to grow exponentially. And if you don't, and you have an unprofitable system, you're going to be losing less each time, right? And if we compare this in a graph, you will see that the fixed fractional risk is superior to the fixed dollar amount. That's the red line in the graph, upwards one, this one, right, the red one, compared to a fixed dollar amount, right, without increasing your risk. And in case of a losing strategy and unprofitable, using the same strategy, right, the strategy didn't change. It's just your risk management change, right? If you were using a fixed dollar amount, you're going to reach that max loss limit earlier, faster, quicker, meaning it's much more riskier. Instead, if you use a fixed fractional risk, you're going to stay longer in the game, because with each loss that you incur, you're going to be losing less and less. And in theory, you never lose the account. I say in theory, because of course, at some point, you're going to reach the lowest volume possible for any trade, which is 0.01 lot size, and you can no longer apply this fixed fractional risk, right? Which eventually means you will lose the account. But it's going to take a long time, much longer by far, than if you were to use a fixed amount risk. All right, so how do you calculate this? This is very simple, I know, but let's just put it out there still, right? So how to calculate it? Very simple. You take the available risk capital. Remember, it's not the initial balance on the account if you're trading a prop firm, right? You take the available risk capital and you apply the risk, right? A fixed percentage of that risk capital that you're going to be risking on each trade. All right, let's look at an example to show you how it works in real time. Imagine you have a 100K balance. We start with that amount again. And imagine that the max loss limit is 5%, meaning if you reach that, you lose the account. This could be, for example, a bootcamp evaluation account, right? Funded account is 4%, evaluation is 5%. That means that your available risk capital, this is the proper way to do it, using the available risk capital, not the initial balance for your position sizing. You use the available risk capital is 5,000, right? 5% of 100,000, 5,000. That is what you have to work with. And let's assume that you have decided that you want to be using 10% of that available risk capital on each trade. Okay, you do this simple math as I just showed you. You take the available risk capital and you multiply that, or you take 10% of that, you multiply that, in that case, with 0.10, which means $500. So you're going to be risking $500 on the next trade. Now imagine that the first trade was a loss, and the loss was, of course, 1R, the whole R in this case. How much do you have available to you? What's the available risk capital? Since you had a loss, you no longer have 5,000, which you began with. You have 5,000 minus that loss, which was risking 500. That means that you have 4,500 left, right? Doing the proper way, you're going to be using this for your next trade, meaning 10% of the available risk capital for the next trade is 10% of 4,500, meaning $450. There, you can already see it at work. You take a loss, it's risking less, okay? On the second trade, let's assume that you had a winner. You had a 3R winner. Now, the available risk capital, how much do you have? Well, after the first trade, you had $450, and you had a 3R winner, meaning that you won 3 times the amount that you risked, meaning 3 times 450. How much is that? That is 1,350. You add that, of course, to what you had at the beginning, 4,500, to the sum of 5,850, right? What we have just here. And then you take, of course, you do the same operation. You take 10% of that available risk capital, and that is what you need to be risking for the following trade, 585. This may look like more work, and it is, because you need to calculate this after each trade. And if you're trading a lot of trades in a day, you could look for a compromise to do the calculation not after each trade, but after each day, right? So it's a little bit easier to you. This may look like more work, and of course it is. You have to do this calculation more often than with a fixed amount, dollar amount risk. However, the benefits for your survival and your profitability far outweigh the extra effort by far, right? This is extremely powerful for your risk management, applying fixed fractional risk. I am a firm believer, if you're not using this already, if you were to use fixed fractional risk and do it correctly using the available risk capital, it's going to be a game changer for your trading journey. So that is my presentation. Do you have any questions? Let me check in the chat if we have any questions.
Victor, that was amazing. If I may, actually, I've got a question to you myself as well.
Go ahead. I'm all ears.
Yeah. So, some people believe that you should scale your risk when your account grows. So they scale their account, the prop firm account or the private account, it doesn't matter, right? And they scale their risk together with the capital that they currently have. Now, other people believe that they should stick with the same risk until they psychologically get used to the new amount of money in their account. So where do you stand and why?
Good question, and an awesome question. Well, this is the most optimal way to handle your position sizing, meaning your risk management. If it is an issue, if looking at your P&L and you're risking more as you're scaling up your account is an issue psychologically to you, you need to address that. And if you can't, then I can understand that you don't want to be using a fixed fractional risk, because as the account is growing, you're going to be risking in dollar amounts bigger monies. And if you're not ready, you need to be aware of that. That's okay. In that case, I wouldn't mind for a limited period that you go and use a fixed dollar amount for when you are in profit. But by all means, use the fixed fractional risk when you are in drawdown, because that will save your account. It will give you longevity, and that is a very good thing. Not losing the account is very important, right? So if it's too risky, or not risky because your risk doesn't change, right? Fixed fractional risk entails that you keep the same percentage throughout time. But if it is affecting your psychology or your mindset, then I would propose to do that. Use fixed amount for a certain moment, and or perhaps increase more slowly to get accustomed to numbers. And another thing you could do, and this is not about risk management, this is more about psychology and about mindset. What you could do is not have your P&L in front of you while you're trading, right? This is a major thing. What you can do, for example, is turn that column out and just express it in pips, for example. Yeah, if you do that, then you're not seeing the P&L. You're not going to be affected by it psychologically, and it's going to be much easier to you. There's another more advanced or another way to do that is to use, and I've talked about this in the past a little bit. It's a little bit cumbersome, but it does help you. One thing is you could do to avoid this P&L effect on your psychology is to use a master account as the signal provider to your prop firm account. And on the master account, you're going to be trading. And in this master account, you use fixed dollar amount risk. So you always see the same amount going up and down when you're losing and when you're winning. And you're not seeing whatever is happening on your prop firm account. So you're eliminating that effect. This is something that I apply myself, and I recommend, if it is an issue, that is one way to deal with this issue.
I like that. I like that way as a beginner. The only thing is, like, when we're looking at like risk and pushing your risk limits, and it's like going to the gym. You really have to warm yourself up. You really have to slowly progress. And doing something like that, as much as I love it as a neat hack, I think people really need to practice just pushing themselves just a little bit more, just pushing making a little bit of extra risk after, let's say, 10, 15, 100 trades, whatever it may be. When they feel they are comfortable now, then to step it up just where they're a little bit, maybe a little bit more uncomfortable, and getting used to it that way. Because us as traders, we can get really stuck in just being comfortable in what we're actually doing. And it is good, but it takes money in trading to make money as well. And we're not here just to, just play around with we want to gain bigger risk each time. So definitely super important. I like the hack though. It's super good. We just got to push ourselves just a little bit in feeling that bit of being a bit uncomfortable as well.
We have lots of comments in the chat saying that what Victor taught has already changed lots of lives before, because some people already heard that before, and they applied it 100%. And then actually really changed their results. We had massive amount of comments. I was bringing them up. So thank you so much, Victor.
100%.
We have a couple of more questions, actually.
No problem.
Your personal takeaway, what's the percentage of the available capital you personally think is conservative or appropriate for the prop firm account?
I didn't go into details into how to assess the percentage to use, because of course we need to do it within a certain, we have some time constraints. But there's more to risk management, as I said at the beginning. This is just, I just picked a couple of things that I think are going to elevate your trading, your risk management the most. But one of the things, how to assess what percentage to use. In the example, I used 10% of the available risk capital, but how do you know if that is conservative? That's the question you have. How do you know it's conservative, or are you not over risking? The proper way to do this is to gather data on your strategy, and then measure, after you have some good data set, sample size, right, hundreds if possible, if not more, measure, convert everything into R multiples, and then measure what the maximum measured drawdown was in that period. That is the best way to assess what is the risk of the strategy, because that is what you've measured in the past, not you guessing or assuming. No, you measure it. That's one thing. Then you apply a certain correction, because the measured max drawdown is only in the period you measure. It doesn't mean that in the future you're not going to have a bigger max drawdown. So you apply a certain margin for error, maybe using twice what you measured, and this is you actually you use this going forward. You assume that in the future you're not going to have a bigger max drawdown compared to what you had in the past. And once you do that, you divide, in let's say you had a maximum drawdown of 20R, right? Let's say you measured 10R in the past, and you take a margin of safety. You assume that in the future you're not going to have a drawdown bigger than 20R. What you then do is you take the available, I know it's a little bit difficult to just say it, but you take the available risk capital and you divide that, you solve for R, you divide that to that 20R to know what is 1R, meaning the available risk capital divided by, in this case, 20. That means that you're going to be risking 1/20th or 5% of your available risk capital in this case. So what percentage you should use should be decided, or should be assessed, by having historical data in R, and then assessing or measuring what the drawdown is. That is, in my opinion, my humble opinion, the best way to know how much to risk. Let your system, your data, tell you what you can expect in the future for your max drawdown.
I really love it. Like, the fact that you need to collect the data is crucial, because sometimes people are trying to find an easy way, and find someone to tell them what exactly to do. But even if you use the same exact system for trading, the same exact strategy, the entries and exits are still going to vary, because we are all individual traders, I think, and we all see these things a little bit different, with some personal individual take on it. So I think it's really crucial what you just said about the data.
It is, and you need to think about it. What is the biggest risk to a trading account? What is it? If you think about it, it's your max drawdown. That is what's going to make you lose the account. It's not of the profitable periods, of course. It's those periods that you have either consecutive losses, or periods where you're going down on your equity. If that continues to go down and you don't have a proper way to manage that, you're not using fixed fractional risk, for example, and you don't know what your max drawdown can be, because you don't have that data from your past, from your historical data, then you don't know what you're flying blind, basically. You just hope that your future max drawdown is not going to exceed the limits, the tolerance limits of that account. As a risk manager, we need to do a better job than that.
Yeah, 100%. Also, Plus is asking that about the EA that you mentioned in the beginning of your presentation. Could you repeat that one, please?
I didn't mention any EA in this presentation, but sometime back, indeed, I mentioned an EA, and that's from Earn Forex, which was an indicator first, and now it is an EA. You can get that at earnforex.com. It's a very simple. You put it on your MT5 and you put in you can have the percentage calculated for you, avoiding that human error, or the fixed amount. Let's say you calculate at the beginning of the day and you say, okay, I need to risk $500 today. You put that in with on the chart, and automatically you only have to move your stop loss line on the chart, and it will calculate automatically your lot size. That is such a big thing. It's a very simple thing, but it's there is edge in there, right? By avoiding human error. Not only that, but you can also have hot keys activated. This indicator turned EA. You can have it on your keyboard where you hit a stroke, you decide which one, which will automatically enter the trade. So you don't have to click anything. You don't have to input the number. It will automatically know where you are because it is on the chart, of course, and your stop loss that you have input, and it will automatically open the right volume for your trade. It's called Position Sizer EA, and you can find it on earnforex.com.
I think it ties back to what Jordan said about the risk manager, being a risk manager for ourselves as retail traders.
Yes.
That can really help a lot. So,
Yes,
Victor, do you also advertise to use fractional risk when your R2R is 1-to-1? Because different people have different risk to reward ratios, and it depends, of course. But what is your take on that?
Whether or not you use fractional risk shouldn't depend on your risk reward ratio. What it should depend on is what your equity, how much your equity moves during time. There is something to be said though that I didn't mention. In prop firm, there is another level of difficulty when you're trading prop firm account, which is you don't only have to take care of the max loss limit, but also of the max daily drawdown, right? And this is something that needs to be, so if you're using fractional risk and you are very profitable, you need to take into account that you need to know if your drawdown for that you need data, of course. How much what is the max daily drawdown that you can incur, within one day? And this is another limit that needs to be taken into account, because if you become too profitable with a prop firm account, you could be risking too much. But coming back to the question, the risk management does not depend on the risk reward profile, whether you have negative risk reward, whether you have a very high risk reward like I trade, not all the time, but often I look for 5, 10, and even more. Your chosen risk management strategy should not decide on that profile, but whether you want to have a optimal risk going forward for your account.
I love it. Yeah, I totally agree with that as well. And there are a lot of questions. I know your takeaway, but just, I know what you're going to say, but because people keep repeating and keep asking the same thing.
No problem.
This is a good question, though. This is a super good question. And yeah.
And very important one. So can you say, what you think about this? If you are using such an approach to risk, it's going to take longer to get out of the drawdown. So what do you think about that?
Yes. Before we do so, could you put up the previous question? Is it close to you? The previous one, which was from Evans.
From Evans, I don't think I think I already unstarted, to be honest with you.
No problem. But I thought to answer, do I advise Evans? Do I advise using fixed fractional risk for risk reward ratio of 1-to-1? Yes, I do. I forgot to say that. Let's come back to this question. You mentioned it takes longer when you are in drawdown and you're risking a smaller dollar amount. It also means that it seems like you are in a in a drawdown. How do you say that? In a well, right? You're in a drawdown and you're only risking so little. how can you recoup that money? The thing is, once you are, this is protecting you from when you are in a rough patch, when you're trading, you have a negative expectancy. But once you regain profitability, you will get that same exponential growth within your drawdown. So it is you're not going to be while at a certain moment at the peak or the trough of your drawdown, you're going to be risking less in dollar amounts. It's going to grow very quickly, exponentially, when you get back on track and you're profitable again. So do not be afraid that it's going to take too long. And it may take a little longer perceptionally, but ask yourself this question. What do you prefer? Do you prefer losing the account or it taking a little bit longer?
That was very good.
That's it.
That's the key. That's the key. Yeah, I remember that, my personal shift, one of my breakthroughs in trading career became when I stopped shifted on how fast can I make profits and when is it going to be this moment when I'm going to get a withdrawal of profits, but the fact that I just don't want to lose the accounts anymore. I was just so sick and tired of losing the accounts. And I would prefer take longer to get my profit than to keep quickly losing my accounts again and again, because I don't want to scale back my risk.
Yeah, that's
exactly
big. It's big as well, because when you go into a losing streak, it's a bit like a snowball effect, and the revenge trading and the boredom trading can kind of come in. And what Victor is saying, just cutting the risk, just to get you back feeling good, just to get your confidence back, because you lose when you go on to some losing streaks, especially if you've made mistakes. The confidence is a thing that can ultimately lead to the blown account. So the lack of confidence and the lack of risk management lead to the blown account. But if you have those things there and you gain the confidence back, there's no reason then afterwards, once you're feeling like you found a nice setup, to then put the normal amount of risk and then get up to break even a little bit faster. It's just about slowly getting yourself back into feeling confident, because that is a big key to the trading as well.
It's counterintuitive, right? Because we come to the market thinking, why do we trade, right? Everyone has different reasons why do we trade, but ultimately, obviously, the first answer is we trade to make profit. But counterintuitively, if you focus on the profit, you're less likely to get the profit. You need to actually focus on the risk, not losing the account, to get the profit. It sounds weird, but that's how it works.
Yep. I definitely agree with that. So Victor, thank you so much. Have you got anything last to say to the audience? And then we'll jump over and we'll do the next 5 giveaways as well. And Saul will be here very shortly to take on and do his presentation.
I have a homework request for everyone.
Wow.
If you're not using fixed fractional risk yet, try it for the next 10 days and come to our YouTube stream and tell me in the chat what your results were.
Well, there you go. You heard it from the man himself. And obviously, go onto YouTube. We're here live trading. Anastasia, Victor, Jonatan, absolutely everybody comes live every week to trade live in front of you guys as well. So Victor, thank you so much. And we'll see you soon.
Victor, thank you so much. That was a really strong takeaway on the risk management. Thanks a lot for your input.
Thank to you all.
So that's it. We've got a quick 20-second break, and then we'll be back. Give me 2 seconds. Traders, stop going at it alone. Now join the Alpha Beta Labs, a free online community built by traders for traders. Share your insights, drop value, and get rewarded for all of your contributions. Now there's no limits, there's no gatekeeping, all traders, all markets at all levels. So click in the description below and join us right now. Yeah, so I don't know what that guy was saying over there, but no, that's the Alpha Beta Labs for anybody that is seen in the link, we've got a course there that is going to be talking about mindset with Louise Bedford. A little bit about the Alpha Beta Labs is a community-led education project that we've been working on ever so hard at the Fivers. So when you come in there, you're going to be introduced to the homepage. So you'll be able to go to the website in the link in the description, but you'll be able to come in here and you'll see on the side, you've got all of the different community chats. You've got as well the strategy banks with loads of different community contributions. You've got my strategy in there. You've got Steven's strategy, many different traders in there that have been taking the time to put content in here ready for this event. So go in there, check out some of the courses. You've got a leaderboard as well. So you get rewarded for your contributions to the community, free accounts, hub credits, premium subscriptions to things like TradingView and FX Pro, all of those different things. So that is it. That's Alpha Beta. But Anastasia, how was that for you? That was really good, wasn't it?
Was really good. That was really good. A lot of value, a lot of notes again. I saw a lot of people also in the chat saying that they've incorporated it already and saw the changes, and some of them will try it out, because to be honest with you, what Victor said was also one of my breakthroughs when I started trading, because I was obviously, as all the traders, trying to get it quickly back out of the drawdown, and we all know how it ended. Always, every single time. So what Victor said is really, really key. I hope everyone made some notes and is going to incorporate that in their trading systems.
Yeah, it's one of those. Everybody thinks I think about risk management, and to be honest, it is boring. For me, risk management is boring, but it is the most crucial thing in trading. It's like if you can throw everything else out the window. If you've got your risk management on point, you're going to be able to keep in the game while you're going through bad patches, while you're going through as well risk management when you're going through good patches as well. Sometimes maybe you want to increase your risk if you've got a trade setup that has got really good expectancy. So understanding, like Victor says, because he's the king of data, understanding your data, understanding your risk is a game changer, especially if you're trading in prop these days as well.
Yeah, and prop is, a lot of people complaining that, prop firms has the rules of, the maximum drawdown, daily drawdown, and so on. But if you cannot make it in a prop firm, you are not going to make it in your live trading account, let's be honest, because this is something that disciplines you to stick with your risk management. And if you cannot here, then you can go and grow your own account, but not the other way around.
I definitely agree with that. Prop firms, people think that it's just they've got all of these different rules, but these rules actually help you in all of your trading. If you can stick to prop firm rules and you can stay disciplined, it will help you with all of your trading. It will help you with your investment ideas. It will help you with your crypto portfolio. It will help you with absolutely everything. So it's definitely a game changer. What we're going to do, I'm just going to put up the next bit for the giveaway, and then we will, let's have a look. We will introduce Saul into the picture. So let me pull that up. Let's check I'm bringing on the right page.
There we go.
There you go. So another 5 people.
Who are the lucky winners?
There you go. So you guys, you'll get an email as well later on today once the event is over, and that's it. That's it. So there you go. I'm going to jump out and I'm going to leave you, Anastasia, to introduce the next guest into the chat. All right. See you later.
Thanks, Alex. See you later. That was a really strong takeaway on the risk management from Victor. But what if I tell you guys that there is a completely different angle to this? The next speaker doesn't even need the introduction, because Saul Lokier is our CEO. He's been trading for over 15 years, guys, right? And over the years, he understood the best techniques and advantages of active trade management. This is the person that you can learn absolutely massive amount of knowledge and wisdom about trading. And he's going to be sharing the powerful methods with you to enhance statistics and be profitable even when you are wrong. So, Saul, we are excited to have you here. Thank you so much for your time. How are
Hey,
you doing?
Anastasia, how are you? Glad to be here. How are you? How are you guys?
I'm doing amazing. Alex, I believe too, he's in the background, but we've been looking forward to hear your part.
Absolutely, looking forward for the presentation. It's truly, it's amazing to see, all these efforts from weeks and weeks of preparation and putting all the events together and all the content and everything. It's hard to understand how much work is behind and how much people is working hard in order to put these events together. And it's glad to be a successful event finally out there and happening in real time and everyone getting the best from it.
Yeah, this event is going to change a lot of lives, but it only will do so for you guys if you actually take notes and implement what has been taught on today's marathon, right? It took a long time to prepare for a big team of people. Make sure that you take the most out of it.
Absolutely. We always say, the risk management and everything that is related to managing something, especially risk, it's always heavy content and it's the boring part of trading, and it's not the adrenaline part of trading that we always want to be feeling and enjoying. But it's it's like going to the gym. You have to do the hard work and the push-ups in order to get stronger. So it's the same. In order to become a pro trader and consistent and profitable trader, you need to put the risk management in place. So that's what we do, and that's what we're trying to accomplish here.
I mean, sometimes trading must be boring in order to get results, right? But so it's this is about the small things, the small steps that we do every single day.
Yeah.
And this is what brings a huge results in the end. So thank you so much again for being here. The stage is all yours and we are all ears. I'm going to be in the back.
Thank you, Anastasia. Thank you. So guys, welcome everybody to the presentation. If Anastasia is going to be in the background, I might have a little chat with her during the presentation, but I will be reading your comments just to get some feedback from you. So all this presentation, and maybe let me show my what I want to show you. Years ago, I was with this learning what everyone's learning, about risk rewards and about the win rate and the fixed risk you put into a trade and your positions and your trading, and I felt something was missing, because you're there, learning these strategies that it's supposed to give you a certain win rate or a certain risk reward ratio, and you start executing that trade and applying that strategy. And you realize that it's not giving you the results you were expecting, or suddenly you have to be you shouldn't have more than 5 trades in a row because that's your win rate, your expected win rates. But suddenly those more than 5 trades in a row come, the losing trades come, and you start questioning your strategy and you start questioning your statistics. And you start going into those mistakes that eventually, you end up losing money or blowing accounts or whatever it is. And I felt something was missing. Trading is not so straightforward that you place your trade, you buy or you sell, you place your stop loss, and you let the trade go. When you start understanding that there's a lot of things to do once the trade is live, once the trade is on, you can really improve your statistics and you can improve your performance. And I started, investigating and learning and watching others and studying from what it was available back then. This is years ago when I started trading, and I found a lot of content related to how to manage winning trades. Okay, and I think it's something like there's a lot of content out there, and there's a lot of now on YouTube videos about it. It's very easy to start managing a winning position, because we know there's some techniques like trailing your stops or taking part of your losses to the part of the winning trade, part of your profits to bank the profits, and there's very little conversation and discussions and content about how to manage losing trades. And if we look at strategies, strategies tend to have between 50% win rates, or if you're scalping and have some high win rate strategies, you might have 70% win rate strategies. But if you have high risk reward ratios, your win rate might be negative below the 50%. So there's always potential losing positions in your strategy within the nature of your strategy, that if we manage or if we learn how to deal with those or what to do with those, we can certainly increase our profitability. Okay, so for example, if I have a strategy that it has an expected 60% win rate, okay, I know 50% of the times the trade will go in my favor, which is fine. But then I'll have 4 out of 10 trades that those will start going against me and potentially all the way to my stop loss and taking me out for a loss. So what happens if through active trade management, and I'll go into the techniques, I can either fix or reduce or the impact or those 4 out of 10, the 40% losing trades. So let's say, applying some techniques that I will go discuss with you in a minute, I can fix 2 of these trades, okay? 2 out of 4 losing trades, I will fix them. Then I've suddenly brought my winning rate all the way from 60% into 80% win rate, because I managed to fix or to reduce the impact of my losing trades by half, okay? So this is what makes trade management so powerful. And it's something that is not, I don't think is taught enough. I don't think is discussed enough. And I think there's a lot of potential, a lot of value. And that's when I realized this and started applying these techniques and started putting to practice what I learned, that all of the sudden, I became consistent and I became profitable consistent. My win rates went from 70% to 80% or to 85%. And sometimes you pull off your data and you find yourself, 90% of your trades are winning positions just because you manage the losing trades, okay? So those are the messages that I want to share with you. And I have actually some live examples going on. So let's start with the presentation. I want to give you just the principles, and then we'll go into the trading platform and we'll apply some examples into live examples, okay? So this is, the passive management, which is what most of the traders are doing, versus the active management. And in the active management, we have active management when we are in winning positions and when we are in losing positions. So basically, the techniques we can apply to every trade, if it's a winning trade or a losing trade, is to scale in, okay, to add into that position, or to scale out, to reduce size, or take partial profits or partial loss, okay, to reduce the quantity, the volume of our position, either if it's on a win trade or on a losing trade. So we said, adding into a win rate, I don't know if it's something that a lot of traders apply, but it's something you have heard of, okay? If you're riding the trend and you have a pullback and you can add into that winning position, it's not unheard, okay? It's something you might be familiar with. The same with reducing, scaling out from winning positions, okay? We all know this. You were expecting that breakout, that movement to come. It goes in your favor, and you take partial profits, or you take half of the position off, and you let the rest go. And sometimes we combine this with training the stop loss just to make sure we're risk-free on that position. So I think these techniques of scaling in and scaling out, adding and reducing from win trades are very well discussed. You might be familiar, you might be applying those. A little disclaimer, I'm not a huge fan of managing winning trades, but we'll go into that later. I think the real value and the real impact into your trading is learning how to manage the losses, okay, the losing trades, because we know these techniques of putting half of your profit when you're in profit, when you're in a win trade. A lot of traders are doing that, and yet they're losing money, right? Because they are impacting their win rate. What could have been a full win, they're now making it a partial win. But when it goes into your loss, you're taking the full loss. So most traders are taking partial wins and full losses, and that's why their statistic doesn't look the way they would like to be. So what we're going to try to explain and to give some examples and live examples is on how to scale in and when to scale in and how and when to scale out on losing positions. And with some practice and with some time, we'll see how our strategies and the statistics of the strategies will start improving. just Anastasia, I know I'm not seeing the comments, so if there's some questions that is worth discussing, just during the presentation, just interrupt me and we'll take those questions. If not, at the end we'll handle all the questions. So okay.
At the end, we're gonna do the separate Q&A. So just focus on what you're saying. Everyone is really excited about hearing about the topic.
Excellent. So I'll move on. So okay, we said that the managing of winning trades, we know this. Okay, we have a breakout. We have a consolidation. A market is going sideways. I'm sorry, that we had a certain trigger. We bought. The market went in our position, and we add to that position. Okay, that's buying. Okay, or adding into a winning position. Or if we have a buy order here, the market is in our favor. Okay, we're winning. At some point, we take partial profits, and we let the rest of the trade continue to have our favors. I believe you are familiar with that. Let's move on into how to manage losing trades. Okay, so let's say we have a buy position up here. Okay, and the market starts going against us. Okay, and our stop loss is down here. Okay, the trade is still live. Okay, it's open, but the trade itself is in drawdown. Okay, we're losing money. If there's a valid entry point, okay, or if there's a real or it's a justification into adding into this position, okay, somewhere there, okay, then we add a second buy position. Okay, so if we bought up here with, let's say, a small position, we started small, we didn't go very heavy, we didn't go with a full 1% of the position, but we started small, and the trade starts going against us, and there's a justification for going again in a buy position in the same direction, we buy again. Okay, and we keep our stop where it is. All the stop losses are in the same place. I will exemplify this a bit later. But if from this point the trade now goes back to our initial trade, or potentially to the direction what we're looking to accomplish, now we have a first entry and a second entry, both going in our direction, and this trade now will have a better win risk reward ratio than the first entry. So overall, we have accomplished two things: potentially fixing the first bad entry. It's not a bad entry, but at the start, the trade started going against it. It's something that we always know, backwards. We never know if the trade is going to go in our favors in advance. So we thought this initial entry was a good entry point. Start going against us, we add into that position, and it goes in our favor. Now we have fixed that first trade. Okay, the first entry, we have fixed it, and or the whole setup, we have fixed the whole setup. And second, this second entry has a better entry point. Okay, has a better entry price. So the overall statistic of this trade have improved. Now, what happened if we reduce into a losing position? Okay, let's take this example, and then we'll go to the charts to give some more examples. We buy here, okay, and we have the trade or the range we're willing to risk, and we have our stop down here, and the trade starts going against us. Okay, what happens if instead of buying, or instead of doing nothing, just letting the trade go all the way to our stops, we take partial losses? Okay, the same thing we do when trade goes in our favor and we're in profit and we take partial profits. We do the opposite. We bank losses in purpose. Okay, we take the loss, we take partial loss. So let's say the distance from this point to this point, we were risking, let's say, $100. Okay, it doesn't matter the distance, the pip amount, whatever it is. From this point to this point, we were risking $100. What happens if at this point, when we realize, there's a key level there in smaller time frames, something that tells us, okay, if that mid level is broken, it will most likely go into our stop. If at that level, I decide on purpose to take half of the loss, okay, and then the other half, only the other half of the trade that I left on goes to my stop, okay. Then instead of taking $100 loss, I've taken suddenly, just a quarter of the position, $25, I banked it. So I saved myself $25 at this point, and the overall loss, it turns down, it goes down from $100 to $75. So I've saved in this example, for example, I've saved myself $25 that I can reallocate later. Okay, I'll wait for my next position. I will wait for my next setup, and then I have that little $25 that I've saved from this previous trade. I will be able to apply it. So it doesn't sound like a lot. Okay, you saved $25, but it's a quarter of each position that goes against you. Okay, so if any trade you're applying, you're losing. You're applying this technique. You're saving, a quarter or a third of the position. You're saving that money, small money that you're saving for future opportunities. And all of a sudden, your losing trades, okay, are being smaller. So your risk-reward ratio is also improving. Okay, so this is just the theory, the principles behind. We'll go into the charts and we'll look for some examples. But I have one example here that I took this screenshot yesterday from the gold chart. We'll see what happened with this chart. Okay, but let's say we have a consolidation. Okay, we have a range, and we identify there's a pivot point here and a pivot point here. Okay, real time. This is coming a resistance, and we have this support down here. So the next time the price comes to the resistance levels, we buy. Okay, we're looking for the breakout. So we got into a buy position in order to anticipate, to catch the breakout. And we all been there. The breakout doesn't come. It doesn't matter that all our indicators will say, no, okay, the momentum is there, and the relative strength index, the impulse is there, and there's strength behind this movement. The breakout doesn't happen. Okay, the breakout, the market is not listening to our indicators, and the market starts going back into the mid of the range. So we have many things to do right now, right? Our stop, remember, is down here, and if we look closer into this range, okay, we can see there's also like a mid level of support and resistance in the middle of the range. Okay, we can see this point and this point and this point and this point and this point, also like a significant level, okay, in the middle of the range, like that levels within the whole range is a significant level. So what happens if at that point, okay, we decide to take 50% of the trade? Okay, if this trade goes then to my stop, we have saved 50% of our money, okay, or 50% of our full position. So potentially a quarter of the full position, of the full lot size. So let's see what happens in the chart. Let me show you my screen. Percent. I'll show you what happened with that trade, and then we can discuss. And I'll show you a live example that it's live, and we'll take it from there, the conversation. Okay, so let's go into the platform. Let me make this larger. Excellent. Okay, so this is the gold. Let me zoom in a little bit. Okay, this is the screenshot I took. Okay, so I took the screenshot, and the market was around there. Okay, and you can see from that level, the market continue to the downside. So in this example, for example, you remember from the presentation, our stop losses were down here. We had that significant level there. Okay, at this point, we didn't know the market would continue, okay, to the downside. But the fact that we, in this example, the fact that we took 50% of our trade in loss, okay, I banked that loss, had saved me some money that I can then decide what to do with that later. Okay, maybe I see, okay, I had a false breakout to the downside. It's still back into the range. It has the potential to go again and break to the top side. So if in this case you decide, okay, if it goes again to the resistance, buy again, you have saved some money in order to put it into that next opportunity. Okay, so that's the importance, or that's the impact of doing this banking losses in purpose. Okay, and it's it's very, very hard, because you say, okay, why would I take losses on purpose? Okay, I don't want to be wrong. So there's a lot of psychology also going, and discipline also going into this decision of taking losses on purpose. But you will help you will thank yourself in the future, the fact that you're consistently taking losses when you should, okay, or partial losses. So let me walk you through the next example, okay, which is in the Euro USD. After, doing some, I don't know, your analysis or whatever it is, we decide, and let me zoom in, okay? We say, okay, we have, let me take you real time, okay? So let me take you back in time. Okay, we have this chart, okay? And we see, okay, there's a nice movement to the upside. We're forming higher highs and higher lows in Euro USD in the 1 minute chart. I want to be looking for buying opportunities, okay? And we have this this pullback. We have a double, a double top, and then when we retrace and we go back to, let me zoom in. When we go back into this level, okay, right there, I expect the market to continue to the upside, okay? I don't know what's coming afterwards. I don't know what the market, if it's from there to create a support level and a pivot and then to continue to the upside, or to continue to the downside. But that's my entry trigger. I expect the market from this point to go to the upside and potentially to break to the upside, or just to continue sideways. Okay, that's my signal, or that's what I expect the market to do. And all of the sudden, I see the market going down. Okay, but in my analysis, I also understand that I have a key level here, and I understand I have a key level here, and I decide to put my stop loss below this key point. Okay, I say, okay, if the market goes all the way down below that level, that means has broken this key level right there and this key level right there. Just if you with your eyes, you can see the key levels is where the market initiated important movement. So we know this is a important movement, this is an important movement, this is an important movement, and those key points or key levels are the opportunities for me to either take partial losses or add to the losing trade, okay, to a losing position. And I say myself, okay, if we break through this level and we break through this level, we'll most likely continue down. Okay, so I will just place my stop below that level right there. Okay, that key level. Now we go forward into time. Okay, if you can see for this trade, for this example, I took 1 mini lot, and I'm risking. Okay, let me show you. I'm risking 30 pips, so I'm risking $30. Okay, so if I do nothing and the market goes to my stop, I will be losing $30. Now, why not at this point? Okay, the market is already in drawdown, and if why not at this point? If I say, okay, if it's going to break this level, most likely, okay, we'll go to the next key level because there's no much in between. There's no much support in between the key levels. And if I understand, and that's how I understand the market, if we break strongly this level, we'll go to the next level and potentially to my loss. Why not taking partial losses? Okay, so if I see the market breaking hard, okay, breaking strong, like doing a strong candle and closing below that level, I will take a partial loss. And if I go, for example, okay, I'm now down $8. Okay, at this point I will be down, let's say $10 or something like that, and I go and I modify the order and I take market execution and I take half off. Okay, and I wait. Okay, and I close half, okay, because my trade is 1 lot, so I will take out, okay, I will take partial loss, okay, ideally when it comes down here, okay, but just to give you the example, okay, I'll close it now, okay, and see what happens. Now, my maximum loss, okay, from $30 has gone now to $15 now, okay, because I closed half of the position. So I banked a $4 loss already because that's 8 pips. I was at 8 pips and I took half, 5 micro lots. And then I have $14 left. So my overall loss at this point would be around $20. So from $30, I brought down my maximum loss potential loss to $20, from 30 to 20. So I've saved myself a third of the money. You understand? I saved $10 that I have now available for the next opportunity. And if I don't know, if I see the momentum coming back, if I see the market returning to this area and gaining momentum to the upside, and then forming these higher highs and higher lows, I can add those $10, okay, the 5 micro lots I just took off, I can add them back, okay, and I can play around with my trade as the market gives me new information that I can rely on making new decisions. Okay, so that's one example. That's how to scale out of the trade. Now let's say I'm now, let me hide this. Okay, let's say this is a fresh position of 0.05 lots. Okay, and I'm in a drawdown. I'll wait for the market to come back to this level, and if I see strength into this level, or I will wait for the market to go all the way down to this level, and if I see a good recovery from this level down here, I will add back another 5 micro lots, or I will add back another mini lot. Okay, and that would be the technique of adding into a losing position, because my initial trade up here is now in drawdown, but I'm consciously adding into that losing position. Okay, so this level, okay, I've taken down position. Now it's invalidated. So, okay, I'll remove it. And I'll wait for the price to go into that level. That's my next valid entry point. So now if the market goes down here and it bounces up, I will add into that position. So even though I'm in drawdown for the trade, I will be adding into a losing position. And if I manage to go down from this point somewhere, okay, the market comes here, bounces up, I add, and somewhere here in the middle between this entry point and this entry point, okay, somewhere there, I will be already at break even for the trade. Okay, you know what I mean? Because I will be half of the distance between this entry point and that entry point. So at this point, I will be already at break even. Everything above this level, I'll be already in profit, even though I started in drawdown. You see how powerful this is? So this is the principle. If we see the market goes there and we have the opportunity to do this live, we might do it live. But these are just the principles, guys. And it's something that requires some practice and some understanding. But you will see how through adding into losing positions, always when there's a reason to add, and scaling down, okay, banking partial losses from losing position, you will see how your stats will start improving. So adding to a losing position potentially will improve your win rate, and scaling out of losing positions will potentially improve your risk-reward ratio. So that's the presentation, guys. Let's take some questions, because I guess there's some of them.
There definitely are. So thank you so much. I think a lot of people don't usually think about adding, especially to winners. More people add to losers, but they also don't do it right necessarily, right? So it depends, but it's a very interesting approach. But there was a comment that if you take partial loss, it will significantly reduce your win rates. What do you think about that?
Yeah, if you take partial loss, depend on what happens with the trade, because if afterwards goes in your favor, your win rate, it won't be impacted, but you will be improving your risk-reward ratio. It's very hard, guys. It's very hard to have, that would be ideal, of course, having super high win rate and super high risk-reward ratio. I've never seen, or it's very hard to find someone with a very high win rate and a very high risk-reward ratio. So depending on what you're trying to accomplish, as long as you have one of those high, you're profitable, right? And if you can maintain those consistently high, you'll be consistently profitable. So you're right. By taking partial losses, you might impact your win rate, but you will be contributing to improving your risk-reward ratio. So that's the trade-off.
Exactly. I think it's more of a psychological challenge, for people to take a loss, because we don't, as traders, often want to take a loss because we don't want to admit that we are wrong. So we keep hoping that the trade is going to reverse instead of taking the partial loss and reducing it, because in the end of the day, you can scale back in when the price goes back into your profit, right? Do
Absolutely.
you do something like that? So if you take partial loss, can you scale back in?
Absolutely, and I think it's part of the you know, it's never a 1-0 game. You know, there's a lot to do when you're actively managing a trade. The market is constantly giving you feedback on what should you be doing at that point. So if you take partial losses and then the market is telling you, okay, I'm ready to go with you, then that's your opportunity to add back that trade. But in case the market would continue against you, you have saved that money already. But if it starts giving you the signals to go in your favor, you add that back. So you're right.
And that was the answer to the question, what if we take partial loss and then the market reverse, right? You can always add back in when you see that it's actually going in your direction.
The most challenging thing is understanding when is a good moment to reduce or to add. But as long as you have like something basing or backing your decision to either reducing into a loss or adding into a loss or adding into a win, then you're good. Okay, as long as there's a signal given by your strategy, a valid entry point, a key lever, something there to back your decision, then you're good.
Yeah. Do you think, Saul, the question from me personally, do you think it's more useful for traders who never practice scaling in or scaling out to practice it first on demo to find maybe approach the right or live account immediately?
No, absolutely. You know, as everything in trading, the first, you know, at first it's going to be confusing and you're not sure why you're doing things, and takes, you know, some practice in order to get familiar with this and get comfortable and understanding, you know, potentially it's not for you, right? But every new things we do on trading, ideally to do them on demo accounts, okay? To practice, to understand, okay, every time I'm adding into my losing position, I'm actually losing more, so I shouldn't be doing this. Or when you're reducing into your losing trades, it's actually being beneficial for you, so you keep that. There's a lot of things in trading that will never fit everyone, you know. So we need to practice and test things and understand why do I keep and what do I, you know, let go. But if you feel today that you're following your strategy, you should be making money, and something's not working, potentially one of these techniques will be the aha moment you were looking for, and you didn't understand why you're not being profitable, even though your strategy is supposed to be profitable, you know.
100%. Sometimes this is one small change that can really shift everything.
Absolutely.
So how do you personally take partial loss? So does it depend on the market structure or equity or your personal risk management system? You know, we have a question from the audience about it.
Yeah. So what I usually do, and I invite you to join the trading rooms. We're live, 3 days a week through the whole day, and I'm there once every 2 weeks. On Wednesday, I'll be tomorrow. So join us to the trading rooms, and you will see me trying to demonstrate these principles live, because that's the way I trade. You know. So what I usually do is I split my entry into multiple trades. You know, the nice thing about the hedge accounts, you know, the forex accounts, is that every click it's a different position. So for me, if I'm, for example, in this trade, if I'm looking to trade, let's say, one full lot at this first entry point, I don't go with one full lot. I might place 2 half lot trades. Okay, so I enter with two trades at the same time. And then when it's going against me, I just take one off. Okay, so instead of going into the edit position here and you know, all these clicks are a lot of time to do, I just take trades off. So I open multiple trades and I just take trades out and I add new trades when I need it. So you will usually see me, and if I go to the history here, let's say last month, let's see what we got. Okay, you will see I'm very consistent with my volume, okay, because that's the way I trade. Okay, so I place a bunch of one lot trades, and then I just manage those trades. So I take some off and I add more. And when I keep my lot size consistent, then it's easier for me to analyze my statistics. So that makes it more useful for me.
So what would you recommend to traders who just trade a very small account? Let's say they trade only one micro lot at a time, because they cannot in this way, scaling out if the trade goes in the loss, for example. So what would your advice be to the traders who are just starting?
Yeah, usually the account size shouldn't be a problem unless you're trading micro lots, right? If you're trading micro lots, there's no half micro lot, okay? There's nothing smaller than that, so it will be difficult to manage that. But if you're taking, let's say, even 2 micro lots, then at some point, if you want to scale out, you can take 1 micro lot out. And if you need to scale in either on a win or on a loss, you can add another micro lot. So the only scenario where you will not be able to actively manage your trade if you're taking 1 micro lot trade. As long as you're trading with more than that, you have another trade to either take out or to add it back. So I think especially on small accounts, it's a great opportunity to start practicing these principles, because on small accounts, if you're using micro lots, the wins and the losses are not very impactful, okay, are not very significant, and it's very helpful in order to focus on your stats and the performance of your trading without focusing on the money side of the trading. And only once you have mastered or feel comfortable doing that with micro lots in a very small account, then you can start sizing that up, and start doing the same principles. But instead of 1 micro lot, you do 1 mini lot or 1 lot or 10 lots or whatever it is. When you get into larger accounts, you will start, every trade will start being or representing a lot of money. You will see thousands of dollars going up and going down, and then that sometimes makes focusing on the process more difficult because you're very focused on the money. So if you build these foundations and if you build these skills of active trade management in small accounts, okay, in micro lots, it will help you stay focused on the process and not on the money in the long run.
Yeah, so if you're just starting basically with a small account, just focus on refining your strategy and grow your small account to at least where you can take a couple of micro lots, and then you can start already played with scaling in or scaling out of the trade as well.
Absolutely.
So if you are adding to your position, do you adjust your stop loss together with extra positions, or do you leave it where it was initially?
No, my stops never change. When I set a stop, my hard stops, is because I understand my setup after that point has been invalidated or is breaking down. So just as in this example, okay, if I was to add to this trade, okay, let's just put it temporarily just to have it in place. Okay, if I'm going to add a second position at that point, my stop will be at the same level. Wait, let me add it. Okay, my 2 stops will be at the same level because the stop, it's representing where the whole setup has failed. Okay, so I don't want to be holding losses beyond the point where my setup has been invalidated already, which in this example, it's here. But if you're trading a breakout, okay, if I was, let's go back to our gold example. Okay, if I was, at this point we went, long, and at that point, instead of losing, I added a second position, just as an example. Also, the stop loss of this trade would have been placed at the same level here, because when we break down that consolidation range, the whole thing has been invalidated, and I want to be out of the setup. So doesn't matter how many trades I'm adding into the setup. My stops, all of the stops, will be always at the same point.
And I think this is where the line goes, right, between playing with your position and trusting your position still. Because when you still keep your stop loss in place, it means you still trust your trade. You're just managing the risk to reward and how much you lose in this case? Because there was also a question, where is the line between trusting your position and becoming greedy and messing up with your trade?
Yeah, I don't know. Someone in the trading, I can't remember who was that. I will have to. I manage my trade. I never marry my trades. I have gave up long ago of the fact that I want to be right. Okay, I don't care being wrong, because I know I'm executing fine. It's just the market or the trade that went wrong. It's not me being wrong. So as long as my setup is valid, and I before going into trading, I'm analyzing. Okay, I'm trying to understand what I want to accomplish from this setup and what I'm expecting for the market to do from me in a certain position. So I did all of that work before I engaged into the trade. Okay, I placed a trade. So I'm unbiased of the outcome of the market. Okay, or that position. So I set my key levels. I understand where I want to be out of the whole setup, because that's the point I need to be out. Okay, my stop losses are, and in between I manage, but I never get married to that, because when you get married, and I suffer that, I learned that the hard way, you end up losing a lot of money. And if you don't end up losing a lot of money, you are end up losing a lot of mental energy and emotional energy, because you thought you should be right and you were married to that trade, and so all of a sudden the market disappointed you, so you will be affected emotionally, and I don't want to be in that position. I just do my pre-analysis thing before the trade. I engage, I execute, and then I manage what I already think I understand it's manageable, but I don't get engaged with the trade.
That was such a good quote, what you said. I manage my trade, but I don't marry my trade. Correct. I really love it.
It's not mine. I have to remember who said that.
Well, that was a really good one. I'm going to make a note for this for myself as well. So, do you reduce the amount that you add to the winning trades, or do you add the same equal amount of lot sizes that your initial position that you entered?
On a losing trade or on a winning trade?
On the winning trade.
Yeah, you will. If you see me trading, most of the times I'm managing my losing trades, and I don't do a lot with my winning trades. Okay. And I go back to the beginning of my presentation. Most of traders are taking partial profit, partial wins and full losses, and that I want to be doing the opposite. So if a trade goes in my favor, I bank profits and I wait for my next opportunity, and I'm more focused on managing the trades that are going wrong. If you know what I mean. So I'm taking partial losses and full wins. That's my goal.
So if you add to the losing trades,
yeah,
do you choose the exact same lot size as your initial position or the smaller one?
So no, usually it's the same one, but I might be, that's more sizing and not the management. But there's some webinars. If you go to the YouTube channel, and there's a model that I explained that I add as a pyramid. Okay, so I start small. Okay, let's say I start with 1 mini lot, and the second entry level I add either 1 mini lot or 2 mini lots or 3 mini lots, but usually larger than the first one, in order to get into my full allocation. Okay, because if in my mind I know in that trade I want to be with 1 lot, I don't get in with 1 lot at my first entry. So let's say I get it with 3 mini lots, and I have 7 mini lots to allocate. Okay, so if the market goes against me, then I add the rest of the lots, the 7 mini lots. I add them at a better entry level, and then I'm full allocated with my 1 lot that I wanted to be there. But it's just, instead of being with 1 lot at first, I was 3 mini lots and then 7 mini lots, just as an example. Or you can play with it. Okay, you can try 5 mini lots, then 5 mini lots, and then to play with it. I'm very discretional. You will see me trading, and you'll find I'm a very discretional trader. So it really depends on the setup and how many valid entry points I have within the setup. And if that's an A+ setup that I rely more, then I go more aggressive. So it really changes a lot. That's more the sizing, the allocation management, more than the trade management technique, which is always the same.
Yeah. So you said that you never move your stop loss. What about break-evens? Do you have your break-even strategy, or you never touch your stop loss at all?
No, I hate that. You know, I remember myself. I've been there. Okay, you know, you catch you get the breakout. The market is going in your favor. You trail your stop, and the market retraces, takes your stop. Okay, takes your stop. It takes you out of the trade for break even, and then continues in your favor. I hated that, and it was. I know. I've talked to a lot of traders, and I know a lot of traders are doing that and are suffering from the same things, and that, you know, it was going back to the same principle. Okay, that I'm taking partial profits. Okay, the market it's taken me at break-even many times, and that's affecting my profitability. So I take the full loss, I take the full profit, and I don't trail my stops. Okay, I just take the profits.
So it's either the full loss that you have, or unless you scaled out, or the full profit. So you completely trust your setup. And I think this is the goal, right? When you enter the trade, it should be the one that you completely trust.
You just need to be consistent with something. So you choose something that makes sense for you and you run with it. Because many times, and that happens to me, I take the full loss and the market continues in my favor. And I have potentially lost money because I left money in the table. Okay, I've made peace with that. I'm happy with that. Okay? Because I know my next setup is around the corner and I will have a new opportunity to make money. So I don't care about those potential larger wins. Okay, I just don't want to be. I just don't want the market. When I was in profit, I don't want to give that profit back, which if I had the opportunity to bank it.
Absolutely. Someone says, I'm heartbroken so many times that I gave up on marrying the trade. Yeah, that's so true. So could you give their advice for beginner traders how to avoid frustration and manage your emotions when we lose 2, 3, 4 trades continuously? Is there anything that you could recommend?
How to avoid frustration when you lose 3, 4 trades continuously?
Because we've all been there, right? When we were just starting, you have so many years of experience. How did you get out of this, if you ever had it, right? This emotional range about being so attached to the trade or to the loser.
That's the thing. I think, you know, you shouldn't be avoiding frustration. You should be managing frustration. Okay, and, you know, we're humans. We have emotions in us, and we need to understand what is actually triggering that frustration. And you will, you know, I'll leave the long answer for Richard in the self-management presentation. For me, if you already trigger into an emotion, it usually comes from a risk management mistake you made. Okay, it's usually an oversized trade you took, or a poor setup that you took, and you shouldn't have taken, or you're applying the wrong strategy without knowing you're applying the wrong strategy, or applying the right strategy in the wrong moment, or the wrong context of the market without you knowing that. So usually the frustration is only the symptom of a deeper, you know, problem, or you know, something we need to a disease we need to understand. But just to give you something practical to do, you stop and you zoom out. Okay, you understand. You try to understand what led to that, you know, a streak of losses. Was that the market? Was that my bad execution? Okay, you try to understand what led to that. Myself, the strategy, the market. Okay, you zoom out, you pause, you calm down, and you start the process of rebuilding your foundations and rebuilding your confidence. So you reduce risk, you reduce lot size, you even go back to demo trading, and you start applying your principles and your basics back until you see your stats are back in track. And once that happens, you rebuild your confidence into going again to live, again to large lot sizes, again to all of it. So the first thing you do is you stop and you zoom out, and you try to understand what happened. You rebuild your confidence, and then you go back to the markets.
Wow, that was really packed with lots of useful information. Thank you so much, Saul. Alex is back as well with us.
And I've got my camera sorted. I had to pop out to get. I couldn't deal with that low quality HD camera. It was super bad. You could literally see the whole office, and it just didn't look good. So popped out to get that sorted. I did miss, unfortunately, some of the questions though, but I'm sure it was action packed. I know we've talked. You and I, Saul, have talked so many times about these types of things as well. In the early days, we were doing a podcast where you were I wouldn't say directly mentoring me through some bad patches, but everything that we were talking, you and I, and then Mickey as well, really helped me. The exact things that you were talking about here really helped me through going through some rough patches in my own trading. So you guys definitely should take some of that on board as well. Definitely.
Yeah, and I know, it's so the first time you see these concepts might be a bit overwhelming and advanced, but it's just a matter of time and practice and coming back to our sessions, guys. And we do a lot of live demonstrations and opportunities to learn more and get more familiar and to ask those questions. And we're here to support you, right? So take it slowly.
Yeah. Well, there you go. So if Saul, have you got anything else before we kick you off and bring on Mickey Katz in 10 minutes and we'll do the giveaway? Have you got anything to say to the audience?
No, just guys, it's been a pleasure. Thanks for being here. When you're invited into an event and you don't pay for it, and it's very easy to go away and don't care about it and don't get engaged. But congratulate yourself that you're here, that you're learning, that you want to become a better trader, because this is really a profession that can give you freedom and mobility and income opportunity. Is amazing. Congratulate yourself. Thanks for staying. Thanks for coming. Thanks, Anastasia. Thanks, Alex, for having me. And see you later.
Wicked.
Thank you for your time.
Well, there you go. I know the audio as well was messed up. Thank you, Void, for telling me. Gosh, it's been one of those days. Camera and then the microphone. But I hope you guys enjoyed that. And one of the biggest things as well, take every little bits from everybody and see what works for you. Because you can find something, if you think at the same time, you're not going to know what really truly works for you and your personality and your trading characteristics. So take some of the things that you like from Saul, some of the things you like from Jordan and Victor, and try and mold it into something that is really good for you as a trader, because that's the most important thing.
100%. That's like Victor said before, right? It's about testing what works for you. Mm-hmm. First testing it and then obviously applying it, right? And from these bits and pieces, you can create something really, really powerful.
Definitely. And for everybody that's already jumped into Alpha Beta, say hello. I know there's literally over 100 people that are already in here now. Do me a favor, go in, say hello to everybody, make a post about your trading journey or what got you into trading, where you're at, if you're break-even trader, if you've just got started, or maybe if you're already funded and you're taking massive payouts, say hello to us. It's really important. And for this question, what I'll do, go into the link below in the description of the YouTube, and you'll be able to go into, let's have a look. There should be the tools for traders, and you'll be able to see the course by Louise Bedford, and that will direct you straight away to the Alpha Beta Lab. Okay. Now we got Mickey Katz coming up soon, so we're going to do quickly the giveaway so we don't miss out. So we've already had 10 people. We're going to just pull on for another 5 people for a chance to win the 10K high stakes accounts. We haven't used any music or any sound effects, Anastasia. What is going on with us, huh?
It was so packed with value that I think music was unnecessary so far.
Yeah, well, no, the sound effects. Next time we're going to have sound effects, though, definitely. You can't miss out on those.
You are a boss of sound effects of music.
There you go. Mickey's getting himself ready. He's just signaled to me in his own way. But here you go. There you go. So those are the next 5 people. Again, everybody that has got an account, you'll get an email from me with the link to buy that account. and you can either have hub credits or the actual link for the specific account. We will sort that out as well after the event. But that's it. So far, really excited to hear what Mickey's got to say, because Mickey's always giving it big, always saying that he's the best at risk management, the best trader and stuff. So I want to hear what he's got to say about this. But he's an interesting way that Mickey trades. So it's going to be cool.
I've never seen it personally, so I'm really looking forward for that.
Yeah, Mickey's been a prop trader in a physical prop house here for a few years. He's been an educator. He's done communities. He's done all of that. And when he came to trade the pool, he really brought everything with regards to proprietary trading for equities and stuff. So if you guys have never seen what Trade the Pool is, you can go into the link as well and check it out if you're into the equity markets and stuff like that. But the man himself, he's one of the best people I know for equity day trading specifically. But yeah.
Alex, can we talk a little bit about the contest that is going on, the trading contest? Because
a lot of people have asked about that. The first 5,000 registrations, those people have been entered in a special contest that is happening tomorrow. So unfortunately, if you haven't heard back, you haven't been picked, and it's a shame. But it was only 5,000 people. But you do have an exclusive account that you will be able to use as well, and you'll get an email regards to that on the weekend. It is an account that is exclusive for this particular event, and yeah, that's it. That's what you're going to be able to get. When would the brand tools be available on the events page? Make sure that you're just refreshing or deleting cache, because that can also happen, but they are there. They're waiting for you if you want. And the scaling plans and things like that, they're the same as the hyper growth scaling plan.
We had lots of questions about the replaying the videos, guys. Everyone who's attending, you will be able to rewatch it, check again the presentation. So everything that you need to repeat, you will be able to repeat again at any convenient time. So just wait for the end of our today's event, right? And don't worry, you will all have it again whenever you need to repeat anything.
A question, Anastasia, have you been in any trades while you've been in the back end listening, or have you kept out?
Not today, to be honest with you.
Really?
Yesterday I had 3 of them running, but today I've just entered the one, but not before that, like just a half an hour ago.
What were you trading yesterday?
I was actually getting my 2 break-evens yesterday, 1 stop loss, so that wasn't a great day for me. Yeah, but it kicked me out right before going in my direction again. One of those was USD CAD. Yeah, I know.
Wait, hold on a second though. You were long USD CAD, yeah?
I was short on USD CAD.
Okay, fair enough.
Yeah, no, I was. Wait a second. No, I was long. I was short on GBP USD. I was long on USD. That kicked me out, literally tick to tick. I'm just looking at it.
I think we were in there. So I was short pound dollar, got out, break even, and then I went and did a long on USD CAD, and that was a good day yesterday. It was a good day, but the markets are fantastic. Markets are super volatile and stuff. So
I've just entered the short on USD CAD like a half an hour ago, so it's in a little profit now. Let's see how far it can go.
Yeah, you guys you've got to come into the live trading room if you want to see Anastasia live trading, going through all of her analysis, because just because she's the host here doesn't mean she's not a trader. The reasons why we're even speaking with Anastasia is the time that I met her, I was doing a risk management interview with her to check if she was a real trader. And because of that, as soon as I started speaking to her, I noticed her ability, and then we got her to come on as part of the Fivers team as well. So you've definitely got to come onto YouTube to check out some of her trading and her content as well. And
a lot, Alex. Well, that's going to be tomorrow, so we're going to see each other tomorrow again.
Oh God! Oh yeah, that is correct, isn't it? Wow, the weeks go so fast recently, huh?
I know, time really flies.
Wow, I don't know if that's because like for traders, it's like it's like quite fast paced for some reason, or maybe I don't know, maybe that's just me, but it feels super fast paced recently.
No, the same for me. I can't believe it's a half of March already. For me, it feels like 2025 just started. Like a few days.
So strange, huh? That's so strange. Well, we're gonna wait for Mickey until he gives me a thumbs up, and then I'm gonna bring him on. That's not a thumbs up, Mickey? Oh, that's 3 minutes. He wants us to bring him on in 3 minutes. But if anybody has got any other questions or anything, let's see if anybody's written anything in the chats here.
What will be the profit split on the new account?
The like normal. You have got, if you go into, let me pull this up. Do you know there's such a problem when you've got multiple monitors and you've got so many tabs open. I'm a real bad one for tabs. I've got like 1 million open. Let's see if that looks like the right one. Perfect. Yeah. Okay. So if you go down to the FAQs, all of the questions about the contest, all the questions about the trading account, everything is here. And you should see as well the toolkit for all of the different downloadable content. What I'll do, let me just delete cache and let's see if it loads for me. It should load. I'll figure out what's going on with that. If anybody wants to tell me what's going on with the tool, if they see the toolkit, and if not, I will raise that to our dev department straight away as well. How are you managing EU? It's so violent these days. Isn't that what we need though? Isn't that we want volatility as traders? But what do you think with that, Anastasia? Because you like trading EU, don't you?
I love EU, and for me, it's, to be honest with you, it's good when it moves. It's much worse when it just stands in one place.
Hate it.
I didn't like the beginning of the year because of that, but now the past few weeks it really moved well, And there was another comment that someone was saying that okay, the forex is just so slow, So I think it depends on how you see it, because for someone it's going to be super volatile these days. For someone it's still going to be not enough because they're used to trade high volatile markets like crypto or stocks or whatever it is,
Yeah. I can't. That's one thing that I hate, and one thing from my trading as well. If I'm stuck in a range, I will eat myself up in that range because I'm always trying to get the momentum. So sometimes I don't understand that I'm in a range until it's a little bit too late. But then, once it opens up, and like the markets have been these last couple of months, wow, it's been the gift that keeps giving, So.
If I'm in the range, I'm trying to get out on break even or in a small profit, whatever it gives me, because the longer is the range, the higher is the chance that it's just going to go against me. It's always been like this, so I'm just not playing this game anymore.
Yeah, that's definitely. We'll see what Mickey's doing. He's still playing around in the. Okay, that's it. So there you go. I'm going to bring Mickey on. I'm going to bring Mickey on, and we're going to say bye to Anastasia for now. She's going to join us later on.
See you guys later.
Anastasia.
Thanks,
See you later. Bye. Oh, here he is. There he is, guys. What you've been waiting for, Mickey Katz. Been trading for over 2 decades, as you can tell. It's been stressful. White beard. Can't hear him either, All of that trading's broken his mic.
Here we go.
Oh, there you go. Yes, hear him now. How's it going, Mickey?
You're looking pretty good, Alex.
I've got a couple of wrinkles. I've got a couple of wrinkles. I'm getting there, But
what's going on, everybody? How's it going?
We've got a lot of people here. I'm gonna leave you to it, Mickey. If you just pop up your chart, you're ready and everything.
Fine.
Unless you want me to stay with you, I'm sure you don't want me to do that. You got a lot to talk about.
I don't want you to stay, definitely. But okay, so
any questions that you guys have for Mickey, mark them out. I'll pull them up on the screen when it's a good time to do so. But at the end, obviously, like everybody's done it before, we'll stop and we'll go through any types of questions that you may have. So yeah, see you in a bit.
All righty. Thanks so much, Alex. Hi, everybody. How are you doing? So before we'll start this presentation, let me get to know you a little bit. Tell me, obviously, you're in the forex space, but let me know how long you've been trading for, and what are the time frames that you're using? I mean, are you a short-term traders, maybe a mid-term, long-term investors? Share with me a little bit more information about you, so I will get to know you as well. And just a quick introduction, because Alex didn't do that. Thanks, Alex. So I'm Michael, the CEO of Tradepool. We are the sister company of the Fivers, and we are basically dominating the stock market for stocks for traders that want to trade stocks and want to get funded by us. So go to tradepool.com. We have 12,000 symbols, ETFs, stocks, and all the goodies. So today we are going to dive in and actually talk about something a bit different. And at the end of the presentation, we'll go into the trading part, really. But I'm going to start with this and actually talk about how to build a portfolio in 2025. Let me pop up the screen here. Okay. What's that? Remove other media. So I'm going to remove that and do this. Right here. Is that the right one, Alex? If you want to check that I'm okay with the camera and all, I'll move a little bit here. Okay, thanks. You playing with it? Nice. Okay, so you guys saying 2
Sorry,
years.
Michael, do you wanna just make it full screen for me? Click at the top, make it full screen.
Let me give it a shot. How is that?
It will do. Yeah, it will do. See you in a bit.
But okay, because I
Could be
can't see
better.
myself.
No.
I can't see
Right.
myself, and I can see the chart. So the chat. So let me try something else here.
Don't worry, guys.
How's
His
that?
trading is much better than his ability to use
Much
StreamYard.
better,
Okay?
much
better.
Although I'm doing it quite good, I can say. Okay, anyway, let's start, guys. So I see that most of you guys already have some background, right? A year and a half, 2 years, and so on. So that's great. So it will be much easier to progress and move forward as we go along with this presentation. And like Alex mentioned, you can definitely leave comments in the chat, and we will answer some questions, and we will answer them at the end of the presentation. So what we're going to talk about is building a portfolio in 2025, which is totally different than what we learned or heard about from our parents or grandparents on how to actually build a portfolio and what is a portfolio, right? And let's dive in. So first thing we need to know, and by the way, this presentation, I got to share with you guys, I built it through an AI. It's called Gamma. I'm not an affiliate of them or something like that, but they're really great. I tried it. I loved it. We're going to answer some of the questions like why build a portfolio. Eventually, I mean, we need to think why, all of us are traders. So in most cases, we only see the next big trade that we want to do. But when it comes to thinking a few steps ahead, we got to understand that a portfolio is needed. We're going to answer the question, what is a portfolio, a healthy portfolio that actually has a few diversification basically within it and multi-structure, and is a bit more complex, but in a good way, comparing to, like I said, what we learned from our parents, for example. And at the end, you cannot really talk about portfolio without talking about a drawdown. So we will leave a few minutes talking about drawdown in generally about the portfolio, but also about how to get yourself out of a drawdown from a trader perspective as well. So let's continue. All righty. So what's a portfolio and why we actually need it? So obviously, up until today, we know that we have a traditional portfolio where basically is a portfolio of a buy and hold, and we'll talk about it in a second. But it makes sense that every one of us, and it doesn't matter if you're in your 20s, 30 or 40, gotta have something for the long term as well, mid-term, long term as well. Because we all know this, we probably saw it on YouTube or post on Instagram. What would have happened if I took $1,000 and put it in Google when it first started, or the Bitcoin when it first started, and so on? And this is something obviously that we want to aim for as well, because maybe we won't find the next Google, but we can first search for it. And second, even though it won't be Google, it could be others that will give us a great return after 10 and 20 years of holding. And basically, what we're trying to do is creating wealth, besides the fact that we're trading, and trading is mostly for the, as we call it, like the income or the paycheck, right? Comparing to investing when we actually want to build wealth. Second thing is the passive income. We can use actually investing for getting money, free money, right, from dividends. So I'm talking about obviously stocks, but when you're buying, for example, McDonald's or Google or Apple, they all share dividends with the shareholders. And once you do that, once you hold your stock for X amount of time, you will get that into your bank or into your broker account. And this is basically a free money that you get, right? And it doesn't matter if the stock is going up or down, if you're losing money or making money, like unrealized money on your portfolio. At the end of the day, if they share dividends, you get it. As simply as that. And this is something that you can definitely use in order to put back into your investing. So you get some dividends, you put it back into your investment, and you continue to grow your account. And the last thing, and I'm not quite sure that it's applied for all countries, but I'm guessing that in most Western countries at least, you can get a loan when it comes to on top of your portfolio. So for example, if I have $100,000 of account, I can ask the bank to give me on top of that, to give me, or because of that, to give me like 80 up to 80% in most cases. Obviously, check it with whenever with your bank and your country, but in most cases you can do that, and then you can take this $80,000 that you get as loan and either put it into investing or use it for real estate, for example, or whatever it is, to basically leverage yourself. Because a lot of the times when it comes to building wealth, it's actually the focus should be on leveraging yourself, obviously with a good amount of risk management. But if you look at the top-notch investors and the guys that in the top list of the like the 100 richest people in the world, they are all leveraged their money, right? They're not just using their own capital, but they're actually using the bank or other people money, like you do in funding, for example. So that's also something that you need to consider. If your country allows that, this is definitely a great way to leverage yourself and push it beyond what you have actually. Alrighty, so two types of portfolio. The one that we just talked about, the traditional one, you buy and hold. There is nothing to do with it. You took IBM, for example, a common stock. You just buy it and wait 10, 20 years until you're retired. Your retirement comes and then you sell it basically, right? This is one option. And the other option will be the 2025, which is much more flexible, which is active. You manage the trades, you manage the portfolio, the diversification, and obviously, if you do all of that, it should be also healthier and wealthier. So in that case, you can still definitely do the traditional when you just buy stocks and hold them for a long time. But because First of all, we have the knowledge, and we'll talk about the edge, what we bring to the table. Because we are traders, we have those nuances where we can actually be more active and manage the portfolio and actually make more money comparing to just buy and hold and wait 20 years. So in that case, we're still aiming for the long term, and we'll talk about the time frames, but we're still aiming for the long term. But we are trying to get much more out of that capital instead of just buying in all the common stocks. And I hope it makes sense, because today with the tools that we have, for example, from AIs, and again the knowledge that we have as being a trader, we can definitely take that to advantage and actually shift a little bit and change it as we go along, comparing to just buying and hold. So we have more knowledge than the common people, the public, that in most cases won't be too much involved or won't be involved in his portfolio or her portfolio. Alrighty. Next slide. Again, I'm still testing this this gamma thing. So next slide is not coming. Let me try to do that. Let's see. Okay, got it. Alrighty. So when it comes to building a portfolio, and we're doing it right now together, so try to think what we want to have in our portfolio. We are building it right now, right? The 2025 portfolio. What do you think? And let me know in the chat. What do you think should be within our portfolio? And we are aiming for a few time frames, different time frames, but let's say the longest time frame will be like 20, 30 years. What do you think will be inside of that portfolio? While you're doing that and writing, there are three elements that we want to take into consideration. One, obviously, the risk. We all aware of that. This is something that we encounter every single day when we click the mouse key, right? And the risk is basically what we are willing to lose on that specific portfolio. Later on, we will talk about the unrealized loss and the realized loss, which are two different species, basically. But this is something that we need to decide, the risk side, we need to decide before actually clicking the mouse key, before actually making that investment. Second thing is the time frame. The time frame that we want to aim for, like I said, in a traditional way, it will be a long-term, like 20, 30 years of holding. But we actually can combine the three elements, which is short-term trading, mid-term, that could be for a few months or even a year, and long-term, 10, 15, 20 years. So we can mix everything together instead of just holding one position for a very long time. And the last thing is, how do we split the pie, right? We have the weight that we want to split between all the assets or all the markets we are having within that portfolio. And we need to decide how we actually going to do that. So I want to go through the chat to see if you're with me on that. Let me know, guys. Okay, I see that you're writing stocks, bonds, gold, crypto. Alrighty, a few stocks, NASDAQ, S&P, crypto. Okay, alrighty. So this is definitely something that we wanna cover, the stuff that you mentioned here. And let's go to that slide and see how we basically going to split this pie, right? So when you think of a portfolio and you sit at home and build yourself the right portfolio, in most cases, stocks will be at the top of the list, right? Probably 50%. This is what I put here, 50%. We'll dive in a second. We'll dive into the stocks sector or market, and then break it down to a few types of assets within the stock market that you can put in your portfolio. but this is definitely something you want to hold for a long time and have enough weight on your portfolio, because we do know that the markets, at least for now, if you take 100 years back, the markets actually made it up and actually reached all-time high, right? Maybe beside the Australian, if I'm not sure about that, but at least the US market definitely did a few times after those drops. Besides that, I'm also adding here the cryptocurrency that you can definitely add to your portfolio. Obviously, this is, again, a long-term investing in this case, or a mid-term, but obviously much more volatile and more risky, since it's fairly new, and we didn't see a whole lot of recessions or crises to see how it will react eventually. And obviously there are many stuff of regulation around the world around it. So in that case, this is something you want to add to your portfolio, but not necessarily more than 10% from the total. I did put some forex here, mostly for hedging, not to see some huge jump from it, of course. Commodities like oil, like gold, wheat, palladium, platinum, a lot of commodities that could be definitely interesting for a mid-long term. And one thing that is something fairly new to the world of portfolio, which is the funded accounts, right? Because when you think about it, first of all, when you get funded, in most cases, you can buy and hold, you can actually hold your position for a long term, right? You don't have to sell it. It's not just day trading. You can actually hold your position when you fund it. There isn't any reason for you to cover if it's something that you're looking for the long term. Second thing, you leverage yourself, right? As I mentioned before, the loans that you can take from your banks, if you have a portfolio account, then you're basically doing exactly the same thing here. You use the funded account, you use our capital in this case, in order to leverage your profit. So this is something that I would actually put a lot of focus in my portfolio, and not just the classic one as mentioned before, because now that you have that ability, that option, you can definitely use that to your advantage. And so I put 20% of funded accounts. Obviously, it doesn't have to be just one funded. It could be a variety of funded accounts. Some of them could be for forex, some of them could be for stocks, some for commodities. You can play with it and build a funded portfolio account. So this is something to definitely consider here. And so looking at everything, at least from a financial market perspective, these are the assets or the markets I would go with. You can definitely add another chunk, maybe for real estate investing as well, and also some new age investing, like investing in startups and other stuff like that. Alex, I don't know if you did that or you did that with us, but we actually invested in a vegan chocolate company this other, I think last year or so. It's a startup, something that moving forward could be a potential nice gain with it. So this is also something you can add to your portfolios. But when looking at least the asset that you usually trade, this is what I would build from the markets. So going into the 50%, right? The stock plays, or the stock market that you want to hold your portfolio with. I broke it down to four different aspects, right? You have the individual stocks, which is higher reward or higher risk, higher reward. Sector ETFs, broad market ETFs, where you can actually expose yourself differently in order to lower your risk in that case. And of course, index funds that you can hold for a long time, as said. But there is also something that we can do that most guys that hold in portfolio in the public won't do, and also in the banks, they won't do that, in investing banks and all, they don't do DCA, right? And we can definitely do that as traders. And DCA, for those of you not familiar, the terms is dollar average cost, right? The dollar cost average. It's basically meaning adding to your position as it goes either to your favor or against you, right? For those of you who saw me trading in the Fiverr's live trading room or other webinars that I did on the Fiverr's YouTube channel, where I shared my scaled account on the hyper growth plan, you can see the trades that I did there, and I also explained how I'm doing that. Maybe if we will have a little bit more time, we will touch on that as well. But you can definitely build your portfolio according to DCA and not necessarily just buying and holding, right? So DCA meaning that I'm buying, let's take the NASDAQ, right? Or the QQQ, the ETF that represent the NASDAQ 100. And every month, on the first of the month, right, I'm buying the same amount of money every single month. So let's say I'm buying with $1,000 on the first of every month, I'm buying the NASDAQ, right? All the time. So I'm compounding, right? I'm building that portfolio by compounding and by averaging my position. So if I'm doing that, if it goes to my favor, great, I'm adding more. If it goes negative, and we'll see a chart in a second, if it goes against me, I'm adding more to the position, same price, same amount of money, right? On the same day. So a lot of the guys that doing DCA, and maybe you saw a video on that, they will do what I just mentioned, regardless of what the chart is doing, because we're looking for a long term, like 20 years. So they would say that in most cases, it doesn't really matter what the chart looks like, but they will add the same amount of money. And for the long term, it will be right for them, because the market, at least the last 100 years, continued to rally. Doesn't matter if there was an advantage. It's an advantage if the market is dropping, because you actually can add more in a lower price. So DCA is definitely one to consider. We will learn, we will talk about it in a second, and learn how to DCA plus it. So we can actually use the DCA concept by finding the right areas to add to the position a bit differently than what is a classic DCA. So again, going into the stock area, when we break it down, the stock market, we break it down and want to understand what to add to our portfolio, this is definitely could be the right split. When, of course, individual stocks, because it's higher risk, we don't want to have, from that 50% that we just mentioned, we don't want to have 40% out of it, right? We want to have 10, 15% out of the 50, which is individual stocks. Now, we can play with it even more. And, you have classic stocks like Google, Apple, Amazon. Obviously, we want to hold those. But we also can find those unique opportunities, because the market is full of those crazy companies, startup companies, just IPOs, went to the market. And now if you take back, let's say, NIO, the electronic car, at 2020, right? It went from $5 to $70-something within a month or so. So those kind of stocks you can definitely watch for and look for and want to add to your portfolio, but it doesn't have to mean that you will hold it now for 15 years or 20 years. So you can mix the two, right? You can have those Googles where it will go for a long term, and you can have those short term, mid-term, where you're actually looking for that pop, right? The one that just got out, no one or most public don't know about it, but once the public will know, they will jump on it, and it will push 100 or 200 or 300% up, and then you can sell it. So it's within your portfolio, And if you believe that in 20 years it will be relevant, you can leave a tiny chunk in it still, but take most of it out. So this is for the individual stocks, right? It could be those big names, or it could be potential movers. Sectors ETF and the broad market ETFs, obviously you can all the XL something, XLF, XLQ, XLV, XLU, those all ETFs that covers different sectors in the US market. And that's great. And you can also try to go not just for US stocks, right? If you want to find a little bit more edging or find the next big market, that could definitely be emerging markets as well, right? So you have your US market portfolio, but you also add in some ETFs that covers the European market, the Asian market, maybe South American market like Brazil. That's a huge market there as well. So you can definitely mix a few of them. So out of this 50% that we mentioned that you hold in stocks, within that you can dive in and play with it as well. And one more benefit that we mentioned before is the flexibility that we as traders have comparing to a bank, which if we see a strong move to the upside, we can definitely take a chunk out, put it in our pocket, and then let it continue again differently than what the bank will do, which holding it for a long time. Alrighty, next slide. Next slide. We'll do that. Okay, so this is our edge, right? We have the trading knowledge, so we can analyze the chart, and actually when we DCA in, we can actually understand where we want to add more to the position. If I just said that every month you buy in the same amount of money on the same day you buy in the market, right? You DCA and you average in your position. So instead of just doing that, you can tweak it just a little bit more and actually say, you know what, I know that today it's the first day of the month and I need to buy with $1,000, but I see that if the market will drop just a little bit more, there is a major liquidity level that in most cases it will bounce from this one, right? So then I say to myself, okay, I will wait a few more days to see if the price will drop to that major liquidity level, and then I will add more. Now, if that liquidity area is a very strong one that we didn't touch after like few months or even few years, this is a place that maybe I don't want to add just $1,000. I want to add $5,000, right? Because I'm averaging, the DCA is averaging my position. So if my position, my holding position is here, like the average price is here, and the market dropped, and now it's reaching a very crazy level, I can add more here, and then I'm dropping the average price lower, right? Comparing to DCA in a classic DCA where you add always $1,000, $1,000, $1,000 every single month, right? So you can use your trading knowledge in order to analyze the chart and understand where to add more to your position and where to add more. So you don't have to be just a systematic robot, but you can actually manage it according to what you see on the chart. And that in most cases, if you do that right, obviously, in most cases, it will give you a huge advantage on others that will, just buy every single month. You can use today AIs to build your portfolio, right? You just click of a button and you get tons of information about each company. I did one research very lately with one of the AIs tool. And basically, I told him this. I'm looking for the next Google, right? This is what I wrote to him. I'm looking for the next Google or Amazon. I want 5 different stocks that you think will be the next Google or Amazon, considering 20 years, the way you see the market and the way you see the world in 20 years. And I added one more thing that is super important, which is look for stocks. In that case, I looked for stocks. Yeah, look for stocks that the management of the company already proved themselves at least once, right? So the CFO or the CMO, the marketing guy or the finance guy, and the CEO, at least one of those three actually showed proven method over the years before that. Once I did that, because obviously I worked with him a few times until I tweaked it, but once I did that, I actually got much better results, at least look like on paper, because now I have guys that actually prove themselves. Because you can have a great idea. Take the funding idea, right? Take the literally like the prop firm idea, an incredible idea, but you have companies that already have proven guys that they know what they're doing, right? Like in our case, like in the Fivers, Gil Ben-Hur and Saul, of course, and Tomer, our CMO. So those guys already proved themselves and they actually know what they're doing. So you can, on the next project or the next company, let's say if Gil Ben-Hur, the founder, will build the next company, you already know that he's coming with track record, right? So that's the same concept right here. I'm looking for a company, not just an idea, but also the guys that can drive the team, that can drive this company to become the next big thing. And that was, once I added that to the AI, that was the game changer. Up until that time, I got plenty stuff that he gave me, but nothing that actually catch my eyes, really. Once I added that, it was the right one for me. So, for example, ACHR, I'll put it here, ACHR. So that is, HCHR is basically a company that building vehicles, flying vehicles, right? For the cities. And that will be, landing and takeoff and landing from the road within the city, right? So if you all saw them, The Fifth Element, it's an old movie now, I think 2000 or 2005 or so. But back then it was crazy to see those flying taxis. So this is probably something that we will have in the next 20 years or so, or maybe 30. So this is one that he gave me. And the guys that actually operate in this have a great track record, a proven track record. So this is something that I at least consider. One more thing, so you can easily do the AI thing, research, shorten the time that you need to do it, but try to be creative. Try to add stuff that are not the common knowledge, right? Not something that everyone will ask. And last thing, like as I mentioned before, the adaptation, which is shifting, tweaking the strategy, the type of company. Like I mentioned, NIO, for example, the electric vehicle, and there are tons of examples like NIO. A stock that is traded at around $5, popping up and doing popping up from 5 to 70 or 200, and that's it. You need to get out of it, so you don't have to wait 20 years until you see something from it. You can always leave a chunk in it, but generally speaking, you just took your profit and you out. So adaptation is something that we have compared to big institutionals that don't have that ability. Alrighty, moving forward. I'm dying to see the questions, but I'll move forward and then we'll stop and talk. Yeah, I don't hear you, Alex. Don't hear you.
I said there's loads of questions. You're just in the swing, you're flowing. Yeah. So cool. I'm gonna let you go through it, and then we'll go after the questions, because there's loads of different things people are talking about, from how the prop firm industry works to accounts to absolutely everything.
Okay.
So
We'll touch base. Yeah, we'll touch it. All righty. So the knowledge that we just mentioned, clear levels, defining a specific DCA, making it better, find new opportunities. Like I said, locate the next Google, and also cash for crash. And this is also something like a technique or something that you need to remember to do. Put money aside, because the next time we will have a crash, and this is obviously, there is no doubt we will have a crash the next time, right? It's just a matter of the time. So the next time the market will collapse 20%, 30%, 40%, we're already getting closer to that. The NASDAQ dropped 15% the last month. So the next time we will have it, you need to have enough cash on the side in order to put a big chunk of it inside, right? Imagine DCA in, and then in 2008, when we had the subprime crash, at the bottom you add in a bigger chunk. Or 2020, the market dropped because of the COVID, adding more to the position. 2022, or even as we get in closer right now with the NASDAQ. So always have some cash on the side, just because when the crash will come, you will have the opportunity to do so. Obviously, if you go to the real estate market in 2008, the subprime crime in the US, you have tons of opportunities in the real estate market, right? So that's the same concept. If you had cash aside, you could have done very nicely. Alrighty, so we're reaching that last mile, and like I said, we can talk about portfolio and looking at the potential, but we got to look for the risk as well. And there isn't, you cannot have a portfolio without having a drawdown, right? It's like trading, but also for the long term, when it comes to portfolio, you will always have those drawdowns. Exactly like now, right? A lot of the guys, and I've been chatting with my friends on WhatsApp and whatnot, and obviously all of them are in the market, and every single day when the NASDAQ is dropping 2% more or 3%, they sending me a text and saying, I'm losing so much money, what should I do, and stuff like that. So obviously there will be times when you will find yourself minus 30, 40. In the subprime, you could easily find yourself 50% down. So the thing about it is just understand, first of all, your tolerance, right? And when it comes to long term, at least, like I said, at least in the last 100 years, we saw that the market actually shifting back up and breaking to new highs. So we can expect that to continue until the whole financial markets will collapse totally and we will change it to something else. But until that will happen, it makes sense that the market will continue to rally after those crashes. Maybe it will take it not just a few months to recover. The Japanese market, it took it something like 30 years or so until it reached the new high. But eventually, if you hold in your position for a long time, you will see a recovery, right? So this is something to remember when it comes to a portfolio for the long term. And also, obviously, for trading. So we need to separate those two, portfolio and trading. When it comes to trading, your trading portfolio, you should in that case have some limitations, right? Because eventually, maybe you enter the market and it dropped down, you lost all your account, and then it will recover after a few months or even years. So in that case, on your trading account, you definitely need to have some limitations. But we also need to remember, and that's probably the most important thing, to remember the mental side of it, right? Because on a portfolio level, your unrealized loss doesn't really matter. And of course, it's hard. And I'm sure you guys are all aware of that. And maybe your parents talk to you about it the last few days, or your friends. Everyone is looking at the market. It's in the news. Everyone knows that the Nasdaq is dropping. Tesla dropped like 50% in the last 2 weeks or 3 weeks, right? Nvidia 20%, Google 20%, 25%. So everyone is talking about it. But unless you realize the loss, unless you cover the position, it's just on paper. Now, of course, it's not fun to see that on paper, but it's still something that you need to remember, that you're aiming for the long term. So it doesn't really matter right now that you're in a loss. The only thing that matters is, where do I DCA, right? Where do I add more to the position in order to drop my average? Because we are aiming for a long term. Obviously, when it comes to trading, you need to act differently, and I'll talk about a loss that I have in a second. So remember that there is the realized and the unrealized. When you realize the loss, that's a whole different story, because your mentality now is not just, I'm losing money, but maybe it will return. Now, when you realize the loss, it's actually, that's it, I lost it. Now I need to work my way out of it and basically recover from that loss, right? Two different things when it comes to like on the mental side of trading. As long as it's a portfolio for long term, your unrealized won't matter, right? In profit or loss. It's a long term. It doesn't really matter. So remember that, because a lot of the public doing the wrong thing when they actually seen the 30% drop, 40% drop in the COVID, it happened like crazy. It dropped very rapidly, and then everyone just sold their accounts, sold their position, right? Covered their position, instead of just waiting until it recover, or better yet, look for the place to add more to the position, right? Two different ways to look at it. In 2008, when you're watching the news in the subprime, you're watching the news, and on the news they all tell you to sell to close your position because the market is about to crash even more than what it already did. Then in most cases you will go and realize the loss. But this is, and we're going into a manipulation and all of that. This is actually a smart money play when they actually telling you what they want you to do in order for them to buy in a cheap price. So you're selling to them. I'll continue just a bit here. Okay. So this is exactly what we just talked about, the NASDAQ daily. Actually, I changed that. This is, I had a different chart here. So it's actually 2025. This is the drops from the last 2.5 days, 2 weeks. And most cases when people seeing that drop, they're actually closing their positions instead of just finding the next place to add to the position. And this is crucial, because every time we saw a crash, 2020, 2008, 2000, the dot-com bubble, 87, 29, the market recovered at the end of the day. So we just need to hold a little bit longer and find spots where we can average our position to a better position, basically. Yeah. But when it comes to talking about trading, I had to bring that, Alex. And I'm not sure, probably some of you guys at home already heard me talking about it, because Alex and I did a few podcasts about it, and also I did a webinar. One. What's that?
So this is a big, an extraordinary trade. We've been talking about this quite a lot, haven't we?
Yeah. And I guess when talking about a drawdown, I gotta talk about this one as well. This is a trade that I made, not a portfolio. So a trade that I made and I lost almost 100K in 3 days. And I wanted to touch. Do we have a few more minutes, Alex? Because this is the juicy part.
If it's juicy, and
if it's juicy,
I know it's juicy, so go for it. Yeah, go for it.
So we had those 3 days, right? This it, only 3 days, and I'm losing and getting my ass kicked by this SPCE company, Virgin Galactic, that trying to fly, at least back then, try to fly people to the moon or such, to space. At the end of the day, I saw that the stock is now traded at around $3 or so. So I'm super happy it collapsed even more. But to make a long story short, that was a place where I realized the loss, right? I closed the position eventually, and I needed to recover from that drawdown. So how do I recover from a major drawdown, right? The first thing you need to do, and I see Rich on the line, so we will probably could add a lot of mental and psychology aspect for it on top of it. When you try to recover from a loss, like a big loss like this, you have few things that you need to do, right? One is on a technical level, which is fairly easy. You go back to the trade, you analyze it, you see where did you add to your position, how did you scale in, scale out, your risk side, everything involved of the technical, and what you could have done better, right? That's fairly easy because you understand that level. The second thing is how you take yourself out of that loss on the mental side, right? Because you had, this is probably 5 months, 4 months, 5 months of work that I lost in 3 days. And how do I take myself out of that? And this is realized, right? I don't have it anymore. Now I need to understand how do I not just get back to the game and prove myself that I can do that, but also, making that money, return that money to my pocket. So there are a few mental aspects to it. And there is one thing that really helped on that, or two. One is once I went back and saw the other things that I performed, like other trades that I took before that, I saw that I know what I'm doing, right? So it was easy for me to learn and see, actually prove it that I know what I'm doing, that was just a step back and not something that I usually do. So once I proved myself that I know what I'm doing, it was easy for my mind to say, you know what, that was a step back, but now you can continue to do what you know, what you already proved to yourself. This is one thing. Second thing is just, again, on the mental side, I actually separated it from thinking of that money that I lost and actually said to myself, okay, now my account, if I'm not mistaken, it was like a $300,000 account and I lost almost 100, so it was roughly 200. Now my account is at $200,000. That's it. That's the number. I didn't have 300. I don't remember it, like separating it, eliminating, remove it. I only have 200. Now I'm trading. Once I did that, and obviously it takes time and you need to really focus on believing of what you're saying. So once I did that, it was easier for me to operate on the technical level because I didn't have that, I got to get back that $100,000 loss before I continue to, let myself loose and continue to trade properly. So once I told myself, this is what I got, $200,000, that's it. I didn't have 300 before, I only got 200. So when I did that, it was easier for me to approach it mentally and actually recover from that. And of course, bunch of other stuff involving it. Try to think always, and this is something that I'm talking about a lot, and try to do that as well. Always compare yourself to how big names like LeBron James, Messi, whatever, what they do when they have a streak of losses, right? You go into the court, you play a game, your team lost, another one. What do you do in order to put yourself out of that? And once you understand on the mentality level and on the technical level how to shift that and push yourself back up, it will be much easier to do so. And I will take just one more minute, Alex, if I can.
Gosh, this guy.
Yeah, no, I can't.
No, you can. We've got a little bit of time. I know we've got about 7 minutes. There are quite a few questions.
Okay.
But go on, I'll let you do that, and then we'll put some questions.
Okay, I just wanted to talk about this one. That's my hypergrowth account on the Fivers, of course. That's the last one. I'm missing like 4K in order to reach the 640. So that's so I'm happy about it. Once I will do that, I will probably do another video and talk about this huge move in the price that I don't like, that I didn't like to, although it's a great trade that I made here, but it wasn't the right one for me. And we'll talk about this. But I wanted actually to just cover this one, that the drawdown that I have, right? Because a lot of the times when you start your evaluation or start your funded account, you will have a drawdown at first instead of going right back up, or start with a move up. So in this case, when I started at 320, I went down to 314, right? And then I started to find again the rhythm that pushed myself up. And the reason I got into that drawdown was mostly lack of focus. But the way that I got myself out of that was getting into the zone again. So I went back, checked what I didn't do well on the technical and the mental aspect of it. So on the technical, I was very much more aggressive than usual. I tried to click the mouse key on everything that I see and not waited until I saw that A+ setup. Added more to the position very quickly, although the market was very volatile, so I needed to wait instead of that. So those kind of things that I did. And once I understood that, it was easy for me to say, you know what, let's start from the beginning. I'm not trading 320,000. I'm actually at 314. Now let's start to trade. So I waited for that right setup. I added a little bit more cautiously, waited for the places exactly how to DCA basically the trade. And then I found my rhythm back, and hopefully I will reach that this week or maybe next week or so.
Couple of questions, because these are super important questions, and I've had a big loss as well, and I've also been in a trade where I'm physically frozen. Like I can't close it, and that's due to probably a lot of over leveraging. But you were in the same situation. I remember we talked about this a few years ago, where you were going to teach some other people, do some basic stuff with people on trading, and you knew in the back of your mind your P&L was swinging, like $10,000. It was like, I can't remember, like 90 grand down. How did you close that position? Like, honestly, because it takes a lot to first, when you're down that much, to close the position is super, super, super difficult. And I know there's people as well there that have probably found themselves in a position where they physically, it feels impossible.
Couldn't click the mouse key, huh?
Yeah, it's super hard to do it.
So
how is that? How did you do it, and how maybe can we prevent that from happening?
Yeah. First of all, regarding that loss, when I had it, the last day I started on Monday, and then Wednesday I closed the trade. I traded in my friend's office. He has a big real estate office, and I went there to trade that day. And he just told me, get yourself out of that trade. He actually said it to me, So it was something from the side that actually helped me to do so. But besides that, I said to myself, okay, I lost already roughly 4 months of trading, right? And I said, okay, I can continue to trade, continue to hold the position, but what if it goes against me? I said, I just try to, visualize what will happen tomorrow. It will continue to go against me. Am I willing to lose another 20 grand, 20 something thousand on that day? What will happen if it will continue to go a little bit more than that the next day, right? So I said to myself, that's a shitty situation where I'm at right now. But if I'm not closing it, I can, lose the account, right? Or get myself to a point where it will shift completely my mind in that case. So that's the trick that I used, at least.
Some of the best advice I think you ever gave me with trading was, you said to me, trade what you've got now, not what you had. And I think a lot of people as well do this. If they lose or they make money, whatever it is, they're always trading what they had if they've lost it. And that revenge trading, trying to get it back, can put you into a deeper hole. So that was some really big advice that you gave me. But this is something I think a lot of people understand with DCA. It can be like a double-edged sword, and I think maybe people may get it confused as DCA is the same as averaging into a position. Maybe we can talk about maybe the difference of averaging into a position to DCAing on a.
Yeah, sure. So the concept, like I said before, the DCA is just buying every month the same amount of money every month and just building that position, right? So it doesn't matter, like on a classic level, it doesn't matter what the market is doing. You're just buying once a month. You just add into your portfolio, you're compounding, and eventually you're playing with the average. But eventually, if the price will continue to rally, then you'll do good. Comparing to trading, and there's a lot of like what it's called martingale, for example, right?
Yep.
So a lot of the times we confuse that when it comes to trading, when we actually add in double or triple to the position, and in those cases, in most cases you will lose your account, right? If you add into your position by doubling it or tripling it, it won't last long. You need to do two things. One, add to your position, but as long as it's within the full risk that you're willing to take, right? If I'm willing to lose $100, then I will add to the position. But once I'm reaching that $100, I'm out. It doesn't matter if I need to add more. No matter what the market is doing, I'm out. So it's got to be a dollar limit that you're willing to take on that trade. As long as you didn't reach it, add to your position like crazy. But once you reach it, you're done. Now, if you want to do it obviously smarter, then you need to find those liquidity levels that you say to yourself, okay, I entered here. I know there is a major level here. Only when the market will drop to this level, I will add more to the position. Again, within the risk that I'm willing to take. And that's literally on a technical, like on the risk management side, at least in my eyes, of course, that is by far the number one key to succeed in the market. Adding to the position while you're within that risk. Most traders will add more and more and more, crossing that limit that they were supposed to lose, and just get a better average price. But obviously, like you said, this is a double-edged sword.
Okay, one last thing, because you've taken up all the time, Michael.
Sorry.
Can't stop you from talking. We're going to bring Rich on straight away because we're behind schedule now by 2 minutes. But give everybody here just some of that little bit of advice, like you've done to me in the past, like you're sitting as a trader over the shoulder. Give them that bit of advice so they can take home that will actually help them with their trading in their own journey.
Okay, so first thing, as we talked about, build your portfolio, right? You got to build your portfolio for the long term. 20 years from now, if you're in your 20s, 30s, 40s, Alex is like my son, and I'm always trying to just tell him, Build that for the long term. Seriously, guys, this is something that you need to do. Start small if you don't have a whole lot, and use the funded accounts to do that as well. Leverage yourself, leverage the capital that we give you to do that. 100% go with that. Second thing, I'm going back to the same thing that I mentioned. Average your position, stay within the risk boundaries. You will do great.
Amazing. Well, thank you very much, Michael. We're going to bring another trader that has been trading for a very long time. I know Anastasia's there. God, Mickey doesn't stop talking, huh, Anastasia?
What do you mean? Bye, guys. Thanks so much. Good luck.
There you go. You're muted as well, Anastasia.
Oh, there we are. I was saying that, well, it was a lot of value, so I think we can all agree.
It was worth it. And, you know, I don't know what I would do if I was looking at my P&L and I had like 100,000 in the red. That would be pretty hard for me to close, definitely. So
such a huge amount of emotional control.
Like to close a position like that, yeah, it takes next level type of guts to do that. But this next trader has been a pro trader for 7 years. He's been living off his trading, and then his trading has become so boring because he's so good at it that he decided to actually come and do content and help everybody else with it as well. So I'm going to bring on Richard Wells, performance coach for the Fivers and for Alpha Beta now. How you doing, Rich? You all right?
Mate, I'm surprised your nose is not growing. You're bigging me up too much. Trading should be boring, but it's definitely not. Yeah, we get these heightened states, right, where trading just goes nuts, and we're going to be talking about that today. So I've jumped the gun. I'm excited to get into this, but yeah, when you're ready,
I can't wait for this one because Rich and I have been on calls where we've talked about so many things that help us both, the mental side of our trading, and I've gone on from having calls with Rich to going on a massive 2 to 3 month win streak. So it's going to be a lot of value here, guys, and we're going to be in the background. And yeah, that's it. We'll leave you to it. All right, Rich.
Appreciate it. Thanks,
Rich.
Okay, I'll jump ahead and we'll pull up a screen immediately here, just so that we're working with this presentation. So if it's the first time that we've crossed paths, my name's Rich. I am the Fivers and ABL performance coach. I've been trading full time for almost 7 years. It was not 7 years of smooth sailing. I can promise you that now. The first couple of years were horrendous. And as I was listening to Mickey talk about closing our biggest ever loss, I think until you've really gone through that as a trader, you don't know the other side of trading. Yeah, a lot of memories as I was listening to that. So today we're going to be talking about self-management and how it plays a major role in successful trading. So if you're currently an unprofitable trader, or maybe you're not where you'd like to be, self-management is a fantastic topic to dive into. So self-management effectively self-management in trading is the discipline to control emotions, follow a plan, and make consistent, rational decisions under pressure. Trading has this way of putting pressure on us like nothing else. So it's we've got to keep accountable to being like self-management in every area of trading as well. So today I've put together a step-by-step plan. It's going to help you strengthen your self-management in trading. We're going to start by looking at the areas where self-management is essential. Then we're going to identify our biggest weaknesses and how to uncover what's holding us back. Finally, we're going to dive into the actionable steps to overcome these challenges and help build you into the trader you want to be. So I'm going to give you the plan, but remember, nothing changes without taking action on that plan, okay? That is your responsibility. So we're going to do things a little bit differently today. This isn't just a lecture. This isn't just a presentation. I want you to treat this as an interactive workshop. So imagine you paid big money to be here today. Give it that heightened level of importance. And I want you to really dive into this and do the work as we do it. We're going to build the plan, but I want you to build the plan with me as we go, okay? So if you want to accelerate your trading, you need to do your part. So now's your opportunity to grab something to take notes on, and we're going to work through this together. But first, we're going to take a moment of silence for those who think trading is easy. for those who think they're going to get to where they want to be within their trading careers and they don't have to put in the work.
That is hilarious. Sorry, mate. I had to come in. That killed me.
I'm glad you like that.
Yeah,
I was
I love
playing
that.
around with
That
that.
was fantastic, mate. Lovely stuff.
Well, we talk about it all the time. We talk about the idea that, you know, trading isn't easy, but why isn't it easy? And let's break this down into actionable steps. So the idea is to just, if you're planning on watching this and just kind of, I'll do this later, now is your opportunity. It's never going to hit as hard as what it will in the moment. Okay. So obviously that's not us. We're not going to be those traders that, you know, say, oh, we'll do this tomorrow. We'll put this in the low priority pile. Today, you get to build a plan. So we're going to identify our weakest link within our trading. We're going to learn how to self-manage it, and we're going to build a plan to overcome it and build it into something pretty awesome. So let's get into it. Self-management pretty much is just about how we manage ourselves. Now, in trading, it's not just a case of clicking buy and sell. There are so many different roles that we take on as a trader. And self-management plays a big part in each one of these roles. So what we're going to do is go over some of these simple roles, and it's important that you write down each one of these as we step through them, because it's going to play a part as to what comes next. So let's see if I can do this correctly. So as a trader, our first job is to be a market analyst. Okay, I know it sounds super simple. We're going to start with the straightforward ones because there's going to be stuff in here that a lot of traders are going to hear for the first time. And they're going to be thinking, oh, I didn't quite figure out, actually, that's a part of my trading job. So in the first 2 years, I thought buy, sell, when Lambo. I literally thought it was all about buying and selling. I need to know where to buy and when to buy and how much. And that's it. I'm done. I'm sorted as a trader. That was all I focused on for the first 2 years. It was only after I took on a catastrophic loss. After the first 2 years, I went through something very, very similar to what Mickey went through and explained on stream earlier. I didn't have the discipline 2 years into my trading to close it. However, I have repeated similar events, much more controlled, and I've had the discipline to close those trades later on in my trading career. So we're already seeing growth through that. Anyway, I'm rambling. Let's stick to the notes. Market analyst. Okay, it's our job to figure out in our trading where to buy and where to sell, right? We have to do our own we have to do our own analysis. We can't copy signals. There's no sustainability in it. We need to build a skill set to figure out how do markets move? How do we interact with them from a buying point? Where do we buy? What's the main reason for it? Next job that we have to do is we are our risk manager. The whole event today is talking about risk management. You should have a basket full of ideas when it comes to risk management. But that is a part of our job as a trader. Okay, so we need to be writing this down. We need to self-manage when it comes to market analyst, self-manage when it comes to risk manager. And we've got to figure out, when we're putting on a trade, how much? Is it too much for our account? Is it too little for our account? How much do we buy? How much do we sell? Can we stomach that? How much are we going to risk? There's another word for risk, which is invest. Some traders prefer the word invest. Some just don't like the idea of how much we risk in a trade. For me personally, I'm moving towards the idea of I invest in a trade because I know it has a proven edge, and risk just carries this undertone of like, oh, it's a bit risky, it's a bit gambly. So self-management, risk manager, our job is to figure out how much are we going to buy? How much are we going to risk? How much are we going to invest on this next singular trade idea? We're also the executing trader. Now, I wanted to bring this up because this is something I actually struggled with in year 3 of my trading. Being the executor trader carries a level of discipline, focus, and organization. There was times where I was not at the chart and I was down the gym. There was other times where I was not at the charts and I was at McDonald's. And I forgot to set take profits. That was an expensive lesson, okay? So as an executing trader, we have to be organized around our physical trading process, the buying and selling. How much you're buying, where are you buying, where's your stop loss going, putting in the physical numbers. Alex and I have had this conversation before about how in big firms, they were actually split. One person could do the analysis, another person could be the risk manager. I think Jordan spoke about this earlier. Another person, it's their job to put on the executing trade. Well, As retail traders, we have to do all three of these. We need to have like a balanced skill set in all three of these. Take it from someone who learned the hard way. Risk management was probably one of the last ones that I learned. Next up, we're the stop loss enforcer, which kind of ties into risk management. It is our job to manage our stop losses, put a hard stop in the market or a dollar value, and have a level where we say at this price point, our trade is cooked. It is invalidated. We need to get out of the market. How many times have we allowed ourselves to extend our stop loss, or worse than that, trade with zero stop loss? So this is something that we need to self-manage incredibly closely, that we are the stop loss enforcer. Okay, and it's a skill set in itself. Each one of these, they are independent skill sets. That's why we're listing them as independent things, because again, I thought trading was just the case of just click buy and sell in the right places and make money. And in 7 years of full-time trading, I've learned that actually there's a lot of different hats that we have to put on as a trader. Okay, so hopefully we're writing these down. If you haven't, it's not too late. Grab that pen and paper, start scribbling this stuff down, because it's going to feed into what comes shortly. Portfolio manager. It's important that we self-manage our portfolio. Okay, we might have more than one trading account. I remember I was trading 5 accounts manually at the same time, and I ended up putting multiple times, I put the wrong order on the wrong account, and it led me to over risk simply because I wasn't managing my portfolio. Now, trade copiers, I've got everything dialed in. It's much more efficient. I went through everything in portfolio managing. I was like, I'm not going to buy a trade copier. It's too complex. I don't know how it works. So what I'm going to do is I'm going to change the background of every single terminal I have. And for those of you who know me a little bit closer, you'll see that I had terminals with pink backgrounds, terminals with blue backgrounds, terminals with green backgrounds, and terminals with gray backgrounds. And it was my way of making sure that I was always putting the right trade and the right size on the right terminal, because I was trading more than one system. I think all I was doing is just burning my eyes out by staring at an luminous green background. So as a portfolio manager, it is super important to make sure, are you managing your trading accounts from an efficient process perspective? Are they efficient? Is there anything you can do that might just bring up the way that you're managing your trading accounts? Next up, we've got trading psychologist. For many of us, we are our own trading psychologist. It is our responsibility to improve our mindset or set out that workload and then go and do that workload as well. So trading psychology is much like self-management. In fact, it ties incredibly close to self-management. It is a huge topic, but it's super important that as we start to learn more about ourselves, we do the kind of psychology work that resonates, okay? Otherwise, we're going to be talking a language we don't understand. And each one of us is different when it comes to how we interpret information in the market, how we perceive pain, how we perceive emotions as well. So we're going to go into that stuff a little bit later. But trading psychology is a whole separate subject when it comes to self-management, okay? Next up, you're the boss. You're the self-coach when it comes to your trading. Trading, unlike many other jobs, you are the person that sets out your schedule. You decide what time you start. You decide what time you stop. You decide what accounts you're trading on. You decide your education. You decide if you're going to buy a course. You decide if you're going to work with a professional or go it solo. You decide that maybe you want a community. Maybe you literally just want to shut the world out and figure out trading on your own. We have to take full ownership that in trading, we are responsible for being the boss and the self-coach. And it can be incredibly difficult to set out a good path and a good workload when we're just figuring out what trading actually is. 2 years, I didn't have a clue what trading was. Again, where to buy, where to sell, I'm sure that's all I need. Now I'm 7 years later being able to expand on the points that I use these things as a personal project. Self-management, huge topic, but also super cool, because this is my exact growth path that I put in personally when nobody's watching. I've split all my trading categories into individual projects. I'm not going to jump ahead because otherwise I'm going to ruin what's coming, but I hope we're writing these down. So you're the boss and you've got to take responsibility for where you are in your trading today and how you plan on moving forward with that. Okay, that's your decision. All right. Next up, You're the employee and the student as well. Okay. So when I started to think about trading, I was like, I want to create the most optimal environment that if I was the boss, how could I create like a distraction-free environment where it's the most efficient place to do the actual work that's going to generate a really good skill set. So what I did is I organized an office in a way that it could be like that. I got the second monitor in and made sure it's always clear and well lit and all that stuff, right? Then I had to become the employee and the student that sits and does that work free of distractions. So I'm kind of creating like the perfect environment, and then I'm trying to be the perfect student as well. And again, you know, coming back to that, knowing ourselves better, where are our shortfalls? What do we distract ourselves with easy? You know, are we just doom scrolling on the internet? I can promise you now, there'll be hundreds of traders in here right now with other tabs open on their phone, on their PC, on their laptops, and they're going to just be listening to this in the background. And they're just constantly putting their attention on things that they think they're doing the work. How do I know this? 2 hands up. I was this guy. I was exactly this person when it came to my trading. I wasted so much time and I wasted so much energy. And I have such a passion for helping traders to pull themselves through this environment. But key word there, pull yourselves through. So we are the student, we are the employee, we have to do the job, okay? Next up, you're the fundamental analyst. It is your responsibility to set your news events on your calendar. Part of my daily ASR, one of the very first things in there, it says check news calendar. I have built a routine that I will not check my terminal. I will not open my terminal and check price action until I've opened the news calendar. And then what I'm going to do is I'm going to put an alert in my phone 15 minutes before, and I'm going to make sure that I manage myself around red news events. Red news events, typically something I'm not trading, and I want to make sure that I'm out of the market because it's difficult to manage risk if the market might gap or bring in unexpected volatility. So I want to know when those news events are. Maybe you want to follow the fundamentals. For me, I'm not sort of following the fundamentals too closely. I'm an intraday trader. I'm down on the lower time frames, so the kind of higher time frame bias doesn't affect too much as to the lower time frame moves for me. I'm able to find small movements in the market, but I still have to be conscious. I still have to self-manage in fundamental analyst, okay? Keeping an eye on when those news events come in. Next up, we are the back and the forward tester. So back testing is where we're looking at data from the past, the candlesticks on the past, and we're looking at this and we're trying to figure out what kind of patterns work. How does the market move? How does it react to these areas or these zones or these pullbacks, or what is the tools that we would like to use? So back testing is an incredible tool to develop kind of like awareness of how markets move. Forward testing is how well we can implement the knowledge that we've got with no hindsight. Okay, so they both play a very important part of a trader's career. How are we self-managing ourselves when it comes to our workload? Back testing, forward testing. Is there rooms for improvement on it? Next up, this is a big one, and this is probably going to make a lot of people go, "Oh, Rich, come on, don't do this to us." Well, I'm the guy that's going to do it. I'm going to pull it up because there's no point having blind spots within our trading and just pretending like they're not important. These things on the screen, they are super, super important. They're not everything that a trader needs to pay attention to, but there's some of the core ones. So journaling and reviewer as well. What does this mean? Well, journaling. Let's say for an example, right, we're going to go up here, we're going to look at market analyst. Let me just adjust my screen. There we go, market analyst. We're going to look up here. Let's say that every day we're coming to the market and we're clicking buy, and the market is just roaring straight through our entry into our stop loss. What if it does that 25 days in a row? Journaling is a fantastic way of bringing that to our attention, okay? What if we're over-risking or under-risking in a trade? And we do this day after day after day. What if we're scared? What if we're sizing down, right? Every day we wake up with a new level of enthusiasm. And then the market beats us out of it throughout the day. And then when we get to the end of the day and we say, you know what, I should have sized up today. All my trade analysis, they worked. Next day comes, oh, you know what? I'm just going to go back to where I'm comfortable. I'm going to trade small risk. If we were to journal around that and review the journal, we could see the behavior pattern, and we are more likely to bring it to our awareness. If we can bring it to our awareness, it's no longer a blind spot. We can build a plan and we can fix it, right? Execute and trader as well. If you're at McDonald's every other day and you're not keeping an eye on the charts, you journal about it, you're going to find these behavior patterns. You're going to figure out how to improve it. Stop loss enforcer. If you're the person that doesn't have a stop loss and the market runs against you and you find yourself literally paralyzed because your trade idea is long gone, there is nothing about your analysis that now supports you could be correct. Yet we're holding on to this trade and we're just frozen. I've been there. And at the time, I wasn't journaling. Journaling is a fantastic way of sitting down and saying, right, Rich, how do you feel? Numb. Okay, why do you feel numb? Because I don't know what to do. Okay, what do you not know what to do with? Well, I'm kind of in this trade and it's not going very well. Minus X amount of thousands. Okay, what are you going to do about this? Well, my trade idea is kind of like, it's kind of dead like 60 pips ago. And I wish I closed the trade, but I didn't. Now I'm in this huge loss and I can't close this trade. We're starting to bring to our awareness what that action step would be. And a wonderful way of doing this is saying, look, maybe you don't have the skill set today that you want, but what would the version of you do if you did have that skill set? The amount of trades I've closed because of that, where I've sat there offside in the market and I've said, I hope this pulls back. And I'm offside. My trade is finished. I shouldn't be in this. I've now got a bias to switch my position, and I've not done it. The amount of times I said, Rich, you know what's stopping you from being the trader you want to be? It's this. It's sitting in a trade. So the better version of you would close this because it's no longer a valid trade. And you would journal that actually you didn't manage your risk. You didn't enforce your stop loss. You're going to journal about that. And if you find that you do it too many times, you're going to fix it. So journaling is an incredible, powerful tool to make sure that we're doing the right work that we need to do as a trader, okay? And the journals aren't worth anything if you don't review them. This is why weekly reviews and monthly reviews play such a key part in trading. Anyway, I left the last one, the best one till last. Emotional controller. It is our responsibility as a part of a self-management is to be the emotional gatekeeper, is to be the person in our trading environment that controls our emotions. And this is a sticky topic, but we're gonna dive into this because it's super interesting how emotional controller can affect many of these other things up on the screen. So definitely something that you need to be aware of, but we are going to dive into that in a second. So if you've done this and you've written down these things and you've got a few notes on it on the way, what I want you to do in the chat is I want you to type done. I want to get a little bit of feedback to make sure that we're not moving too fast. Again, this is designed to be interactive, and I want to make sure that everybody here is getting enough opportunity to step through these things and that we're not jumping ahead. So just take your time to run through these, and when you've got all of them written down, now what you can do, you might look at something like this and go employee and student. You might say, well, that's not really a part. I don't resonate with that. Rich, that might be good for you, but that's not quite good for me. You could consider swapping out employee and student for something that's a bit more personal. So if you see something that's not on this screen, that's a part of your trading journey, consider swapping it out. If it's market analyst, then stop copying other people's trades, all right? If it's risk manager, I don't know what kind of trader in here is you've got to manage risk. That's one kind of fundamental component. Now, I can see a lot of us are saying that we've done this. Now, here's the interesting part. Here's the cool bit. What I want you to do is I want you to go through each one of these, and I want you to mark them from 1 to 10. You're going to score each one from 1 to 10. So number 1 is going to be, you definitely need a little bit of work. Number 10 is hold my beer, look at me, I'm absolutely a legend. Okay. Now it's okay to use the same number twice. So market analyst, I'll go ahead and I'll actually pull up here. So you can see that I've scored these. So 10 is the absolute highest score that you could have. 1, you probably need to have a little bit of a rethink as to how you're approaching it. Now, it's okay to take your time within this, because a lot of traders in here, this is the first time where they're going to see, oh, actually, yeah, I have to take self-management when it comes to my portfolios. I have to take self-management when it comes to my emotions. There's going to be a lot of things in here that might be new information to you. So just be as honest as you can. And if you've got a 6 or a 7 and you go, well, executing trader, I'm kind of like a 6 or a 7, round down. I want you to round down. Nobody wants to be king of confidence when it's not the reality, right? We want to make sure that we're being brutally honest about this. The whole kind of idea of this this workshop is to be able to bring to our attention that thing that's holding us back. Okay, you don't need to write it in chat. You can if you want. You can spam some heart emojis if you want. You can subscribe, do all that good stuff, and thumbs up and that if you want. But what I want you to do is I want to write on your notes. I want you to write on your notes, what are the scores on this? Now, if you've written 10, 10, 10, 10, then I'll tell you what, it's hard to learn anything new when our cup is full, right? So
absolute legendary trader who ever hit 10, 10, 10, 10, 10, 10 on everything.
I reckon they just hopped in. I reckon that's who it is.
That is it. I know a couple of 10-10s here.
That's
Louis,
you.
there you go. A couple of 10-10s.
So we want to become aware of this stuff, okay? So let me pull up. I've got a couple of notes to the side. So we've scored all of these, and we're starting to bring to our awareness of what our strong suits are and what our weak suits are as well, okay? Now, when you've done this, I want you to write in chat, what is your lowest scoring topic? What is the thing on this list that you have scored the lowest? What is that thing? So in this example, we can see emotional controller. I've gone ahead for this example. I put it as a number 2. Okay. It's probably what it does on my trading. I've gone ahead and put this as a number 2 because this is something that's actually, super important. It's a low score. There's many conversations to be had about, as we come into trading, how well equipped are we to be traders? I remember the opening thought as I learned about trading. Yeah, I'll figure this out. That was it. I had a huge ego and I didn't realize. So this is something that, we need to be really, really mindful of. Brutally honest. So if you can write in chat, which one is your lowest scoring topic? And we'll give chat just a moment to catch up with this. Because I want you to understand the relationship here. And this is super interesting between all of these things. They're interconnected. So if you imagine a chain, like imagine a big boat and then it has an anchor and you have a chain. Now that chain, each component is made up of individual links. Now it's very important to understand that these things on this page, they're like links in a chain. They all connect to each other. Okay, each link connects to the next link and to the next link and to the next link. So we might be a poor risk manager. Okay, let's say we look at this and we say poor risk manager, and we give that a number 1. We say that is the thing that I am the worst at. Well, if you're not managing your risk, let's just say we're taking on too much risk and we take a loss, that could affect our ability to emotionally control. Okay, so that could affect our ability to emotional control if we took a loss that's way too big. So by being a poor risk manager, we might be suppressing the score of our emotional control. Okay, so I want to share a story with you. Now this was probably about 3 years ago, and I put in the Fivers Discord, and I wrote a message, and I said, does anybody know how to forge? And not just build, but forge and maintain a rock solid trading mindset. Like, what would be the work that we would do every single day to maintain that mindset and put us into a position where we are just trading our best, trading our absolute best every single day? And always remember this reply I got. And the trader said, just like going to the gym, you cannot spot train where you will lose fat. You cannot decide where you lose fat when it comes to training in the gym. It just comes off your whole body as a byproduct of doing the right work. They said in the same way that you cannot spot train your psychology is built as a byproduct of having balance and self-management across many other areas within our trading, not just psychology. And I always remembered that. And I was like, wow, like it's important to remember just how well these things are connected. So all these things on this page, they have some kind of entwined relationship with each other. So you might be, for an example, you might be a great emotional controller. You might have wonderful self-awareness. You might have wonderful self-control, but you might be terrible at risk management. Well, that just means you feel fine about blowing up your trading accounts. So they have a relationship with each other. And what we want to do is we want to identify which one is the lowest. So if you've done this, put it in chat. I want you to write down, what is your lowest score? Did you put boss and self-coach? Are you a terrible boss? Are you like a really harsh critic to yourself? Are you a really lazy student? Is that the one that come up as a 2? So it's super important to be honest with ourselves, because you might have an 8 or a 9 or a 10 for many of these, but you might have 1 or 2 that's really low scored, like this emotional control down here. And we're going to develop that weakest link, and we're going to work on that lowest score, and we're going to bring it up until it's no longer the lowest score. And then we're going to work on the next lowest score. And it's a combination of just constantly working on the lowest scoring section that we're going to build up our skill set so that all we've got in our trading is 6, 7s, 8s, and 9s. It is, we've heard of the 80-20 rule, right? Where we can do 20% of the work, get 80% of the results. Think about the gym analogy. In the beginning, you get them beginner gains. In trading, we soak up a lot of new information. Well, there might be things in your trading that you can just put in 20% of the work, and you can get massive increments on that score as well. So definitely something to be mindful of when it comes to that. Okay, because we're always pulled down to our weakest link. Okay, if we're a terrible emotional controller, it's going to affect everything in our trading as well. So it doesn't matter how good you are at technicals. If you get emotional every time you take a loss in your revenge trade, your technical analysis isn't really worth a lot, right? We get traders in the market that love to be right, and they're not good at earning money. We get traders in the market that have wonderful emotional control, but they're not good at earning money. We want to be in the market to be earning, to be building a skill set, earning capital on that. And one of the most powerful ways I've found to do it is to collectively self-manage across the board, to build our skill set up and focus on being way more than just a trader that clicks buy and sell. So let's have a quick look in chat, and we'll get some feedback on what kind of answers that we've got at the moment. I can see. Let's have a look. Emotional control. Journal, emotional control, trading psychology. Stop loss enforcer is coming up. I'll click on some of these, pull them up. So we've got journaler reviewer as well, backtest, forward tester, risk manager, emotional control, backtest, forward test, and boss. I give myself too much time off as well. Love it. Journaling is the worst part. There's a lot of traders that have identified that journaling could be a bit of a blind spot for them as well. Jane, you've got all of the qualities, which is great because you've identified the areas in your trading that you can really build up your skill set as well. We've got emotional controller, journaler, risk management. Okay, we've got a lot of good answers in chat. Now, the important thing in this is the majority of traders are going to fail. Okay, this is something to really, like, if you do your research on the internet, you're going to find the majority of traders, they fail. It's not because they lack knowledge. It's because they can't control their emotions. Let me put it another way. We choose the wrong action for the emotion that we're feeling. All right. And I'm going to repeat that because it's super, super important that we wrap our mind around this. Okay. I was 2.5 years into my trading career. And if somebody said this to me, I would go, shut up, Rich. I don't think there are truer words that resonate with me as a trader of almost 7 years. We choose the wrong emotion for how we are feeling. Okay. Sorry, we choose the wrong action for the emotions that we're feeling, right? So we need to identify what is our trigger. We always talk about like what comes first, the chicken or the egg. The trigger is what's going to hit you first. The emotion is what comes after. What you choose to do as an action comes after that. So many traders, they'll say, Rich, I struggle with overtrading. And I'm like, you don't struggle with overtrading. You struggle with your emotions. And you don't struggle with your emotions. You struggle with identifying the trigger that's causing that emotion. So for me, for an example, right, my biggest trigger is a bad loss. That is the thing that gets me as a trader. I'll go from a 2 to 10 emotionally so quickly because I've taken a bad loss. Okay. So let's say, for an example, market analyst, right? My job is I put a limit order on the market and I want to trade there. If I take a trade outside of that analysis and it loses, that's a bad loss. That's not a trade that's in my trading plan. That's not a trade that I should even be in. Risk manager, if I size up too much on a trade because I think I can pick the next winner, which I'll give you a little clue here, we can't. Okay, this is why we have to use risk management in trading. We do not know the order in which the winners and losses will come in. Trading is a probability game. Maybe you got a 70% win rate at 1-to-1. You don't know when the losses will come. So we have to manage risk. If I've sized up and risked too much, that's a bad loss. If I've chased a trade because I didn't execute the way I was, like if I looked at this and said, look, I should have gotten here, I didn't see it in time, the market's moving away, I've got that FOMO, I'm going to put on a trade and I enter at a bad price, that is a bad loss. If I don't respect my stop loss, that is a bad loss. If I'm trading on the wrong account, and I've done this before, when I was trading, I had my trade copy out. And I said, you know what? I kind of like this trade, but I'm a little bit nervous about it. So I'll tell you what, I'm going to go into my trade copy and I'm just going to pick one account. And I'm just going to trade on just that one account this time, rather than trading on my master account that would have copied it across my portfolio. I just singled out one account. I was like, you know what? If it loses, I'll be glad that I only took a loss on one account. If it wins, that'll be a good problem to have. The trade won. And now I'm sitting there going, I just won $150 and I should have won X. And we just know the next trade is probably going to be the loss, right? So portfolio manager, if I'm not trading the way that I should be on my accounts, that's a bad loss. And even a win that wasn't taken correctly is a bad loss, okay? So that's my trigger. It's first, I'm hit with the trigger. Next comes the emotion. And then often we choose the wrong action to deal with the emotion that we're experiencing. Don't believe me? Think about road rage. Prime example, right? So I want to show you how damaging it is to have all of these things under control, but then emotions just comes in at a 2. It drags everything down to the lowest possible level. As I said, if you can't control your emotions, your analysis isn't really worth a lot. And effectively, this is what the weakest link is doing in our trading. It is breaking that connection. It is breaking that chain. It is breaking that wonderful process, that feedback loop that we have as a trader. So it's super important to recognize which one of these is dragging down your trading. Which one is your lowest possible score? And I just want to say thank you for everyone who's been stepping through this and doing this. Like, genuinely, you are building the skill set that the future you will thank you for in the future. This is the kind of work I had no insights of when I started trading, because I was watching dumb videos on the internet, buying into the idea that trading is going to be super easy, make me rich. I'm rich by name. I'm rich by many other things, actually. Yeah, outside of trading, but that's not one for this kind of thing. I'm rambling. Get back onto the point, mate.
Motorbikes as well. He's rich with motorbikes.
You know it. You know, actually, I've got something there. All right, we'll move on. Look, easily distracted. Back to this previous slide. No matter what your issue is that you're experiencing, we can approach this from a very simple plan. It's exactly the same template. So it doesn't matter if you said that you're a really bad boss in your trading, or you're a bad risk manager, or you're a bad portfolio manager. Whatever one that you identified is your lowest possible score, we can address this through this plan. This is the improvement plan. If you're serious about bringing up the score that you identified in your trading that's holding you back, okay, if you're not getting the result you want and you're super frustrated, and at the end of the day you just feel like trading needs a little bit more time, well, this is your actionable step. And if you really, really want to grow, you'll take the time to challenge each one of these and see, what does this mean for you? Is this your growth opportunity? So first of all, we would identify the problem. So if we go back one slide, we can see, nope, hold on. We can see emotional controller. This is our problem, okay? So we've identified our problem. So those of you who have done this in chat, you've identified your problem today, or one of your problems. Then we're going to set a clear goal. So maybe we want to get our emotional score from a 2 to a 9. That's a big old jump. So we're going to break that down, and we're going to say, okay, that might be too big. So we're going to try and bring our emotional score from a 2 to a 3. We're going to create a system and a routine that's going to help us bridge that tiny gap from going from a 2 to a 3. And then when we get to a 3, we might go to a 4. We're going to track that and reflect on how that process is going for us. We can do that through journaling. I was speaking to a wonderful trader more recently, and they had actually tracked this behavior pattern based on how well they performed, and they put it into an equity curve. And it wasn't based on their P&L, it was based on their behavior pattern. So journaling is a great way to do it. Audio, like audio reviews. A lot of traders that I speak to, they create YouTube content, and they put a review about themselves, just chatting through their trading and saying, hey, this is what I learned today. It's a great opportunity to reflect. This is why I was super, super excited to do this talk today, because it is something that I'm applying across my trading. And if you're a bigger student than me, then I congratulate you on it, because I'm a massive nerd when it comes to dialing in that student work and becoming that better trader. And nobody else is going to do it for me. So we're going to track it, we're going to reflect it, and as we get a bit more experience, we're going to be qualified to adjust and improve. Remember what I said about earlier, finding that language that resonates with you. So you don't know what you don't know. And once you get a bit more experience in stuff, you can adjust and you can improve, and you can dial that process in to speak your language. And then we stay consistent and we're patient, because everything that we have spoken about today is a skill. It's not magic. It's not luck. It's something you practice and refine and you apply over time. So every single one of these that you see on here, it's a skill set that you can work towards, and you can build up your score and become the trader that you would like to be. So super, super important to set small goals, stay consistent and patient as well. Summary. And if you've got any questions and anything that you want to have a chat about this, we're going to have an opportunity after this to dive into some questions and kind of play around with this topic for a little bit longer. So we spoke about trading is more than just buying and selling. Okay, it's way, way, way more than that. When it comes to self-management, there's a lot of things that we need to be conscious of and building skill sets in. We spoke about the other areas where self-management is important. We identified our lowest scoring area. We built an action plan to improve that lowest score. The next steps are to identify your next lowest scoring area, and you just repeat the process. And this is the blueprint. This is the step-by-step guide that I put in place 4 years ago. And it is building me every single day into the trader I would like to become. Important note to finish on, you do not have to be perfect. You do not need a 10 across the board to make a little bit more than you lose. I'm a walking example of that. But just getting a little bit better than you were yesterday, it's a great place to be. I'm going to invite Alex to join us up on here. Otherwise, I'm going to keep rambling to myself and invite any questions. You are muted. Mate.
Muted, yeah. Do you know what? These are the things that I think are super important, because you can have all the skills, or all the techniques, all the setups, and you can have literally the setups. Somebody can give you a setup that they make money with, that works, and you may use it and it just won't work. And it just goes to show that first you need to actually understand yourself and what you need, and trade the way that is congruent to your personality.
Yeah.
But also is just your mental side. And I think once you have a little bit of an edge, then it's all about execution. We always talk about, you and I always talk about like reps in the gym.
Yeah.
It's like you're going to go onto the bench. You have to put in the repetitions. You have to warm yourself up. You have to put in the repetitions, because you're not going to go from doing a 60 bench to 120 bench in, jumping and stepping onto that straight away. It takes time. It takes steps. You have to warm yourself up. Sometimes you have to deload. For everybody that's a gym bro, you understand what that means. But all of these different concepts that Rich has gone on are super important, and they're the things when you start to implement, you're not going to see a change straight away.
Mm-hmm.
They honestly, you need to actually be consistent with these things as well, because only after you're a little bit consistent with this, then you're just going to start seeing these things. There was a conversation Rich and I had about 3 months ago, and Rich was being very polite and saying, Alex, stop acting like a expletive, stop acting like in this. And after that conversation, I came out of that and I stopped acting less like a expletive. I started actually not trading randomly, because I trade quite a lot. I'm quite an active, aggressive trader. And I focused on really two main ways of trading. Obviously, I have the punt here and there, and there's a little bit of a punt pot that we've talked about, haven't we, Rich?
We have.
Once you focus on those types of things and you focus on your mindset coming into your trading, you will then see massive effects. But again, it's consistency, like anything.
Yeah, Alex, I like that you said that you did less of that, because we often think, right,
you can't get rid of it. You don't want to get rid of it as well. We're human.
Yeah, but going cold turkey is a dangerous thing. When you have a behavior pattern that you've probably done your whole life and it resonates with who you are. For an example, you might love adrenaline, it's excitement, something like that. To just cut that out, it's not good. That's not a good thing. Like to just recognize where there's a time to grab a handful of throttle and where there's a time to maybe back it off a little bit. Like, that's already massive improvement. And everybody is on their own personal journey when it comes to this. My triggers won't be Alex's triggers, and Alex's triggers won't be anybody else's triggers. They're going to be unique. And this is why, and I saw it in chat, and a big salute there is know thyself. And I hear this again and again and again from the Scruffy Trader, and it's know thyself. Just the more you can learn about yourself, the more you can understand your triggers, the more you can understand what you're good at as well. Today, we've just spoken about what are the things that we're not so good at. You can do this whole exercise in reverse and identify what you're good at and say, am I a fish trying to climb a tree? Am I genuinely really poorly aligned? You might be super, super impatient. And you're trying to be a swing trader or a position trader. You might be super patient and you're a scalper. How do we get past that without knowing more about ourselves, right?
That is one of the biggest things that I uncovered with my trading, was just the fact that I'm impulsive. I'm not patient. And that works in my favors because I'm on the lower time frame. When I have to make a decision, I make a decision fast. And, that's it. If I'm looking at a trade on a higher time frame, and I'm in there, there's too much going on and there's too much things that can affect the trade. For me, I can't even sleep. I can't sleep when I go home. I'm just focusing on that all the time. So for me, that instant gratification, even though we say it's really, really bad, for me, it's perfect because it means that I can get in, I can get out, and then I can go to sleep and I can recover. Things like sleep, things like eating enough calories, things like drinking enough water are all gonna actually help with your trading. If you've got a clear mind, you are going to feel so much better about making sound decisions. If you've gone out and you've got drunk or you've been, I don't know, not sleeping very well, and then you come in and you're naturally already tired, and then just so you can get a little bit of a buzz, you end up putting random trades on to get a little bit of a feeling something because you're just tired and worn out. Then you end up losing, and then you don't revenge trade, and it's these cycles of things that happen, but they happen because of little things like this. But if you can get consistent with the things that you understand are your blind spots, and you can get consistent with your health, and you can put all of these things in place, I promise you can make a lot of money in trading. And then you just got to learn how to keep it. But step by step, step by step.
How long did it take you? How many years did it take you to figure out just how personal trading is?
No, I knew quite fast how the kind of blind spots that it was showing me in my personality. I knew because I could see it. The only thing is, I'm lousy at learning from mistakes.
Okay.
So it's taken me quite a few years to really learn from my mistakes and just not get rid of them. I make mistakes all the time. There was a mistake I did when it came to Solana, my spot portfolio. I had a stop to get out of my whole spot portfolio of Solana at 170. Recently, I removed that spot. Look at Solana now, it's 110. There was a reason why I put that stop there in my rational mind, but now I looked at the chart and I was looking, it was coming down. My irrational mind was saying, oh, it's just going to come back and then spike straight up. And so I make mistakes all the time. You're never going to get rid of mistakes, but you can start getting better at not making mistakes.
Absolutely.
And, slowly.
That's the journey of a trader, isn't it? Is just improving.
Big time. And this is the stuff when I say it's like, I think performance coaches are super important because, I go back to the gym because it's the easiest thing to discuss, or like martial arts, is that all the stuff that you need to do. Like, let's say when it comes to counting calories or making weight, the stuff that you have to do. But when you have a coach that is there, that is showing you the things that you have to do, that you are accountable to as well, it's game changing. It really is. Like, I know how to cut weight. I know how to put on weight. I know how to lose weight. But my best results have come when I've got somebody there that I'm like, that put me in my spot, that if I haven't done it, like, I'm in the shit, basically.
Yeah.
So it's important stuff.
I think it's also, there is a theory that there are a limited amount of decisions that the person's mind can make during the day to stay focused. And the more decisions you make on your own, the more difficult it becomes to make the rest ones. So if you focus on all the other important decisions and stress around, and then you come on the charts and need to make the right decisions in your trading, that becomes even more difficult. Whereas if you have someone who also helps you to stay on track with other things, discipline, right? With trading, for example, or the performance coach in the gym, a personal trainer, then I think it just becomes also easier, right? Because we are all human beings. And sometimes one day it's easier, one day it's more difficult, of course.
Yeah, there's this super interesting thing I want to touch on is like, I look at you guys and I think, wow, Anastasia and Alex, they're on their chapter 18, maybe they're chapter 19, chapter 20, whatever the case might be, right?
10.5 if I'm lucky.
Okay, well, whatever that number is, it's easy for us to look at and say, wow, look, this trader is in this area, and maybe I'm on my chapter 2. And we get so fixated on, I just want to jump to where Like, we see these other traders, but you don't see what happens behind closed doors. These traders are repping it out year after year after year. And so rather than saying, how can I move from my chapter 3 to my chapter 15? Why don't you just focus on moving from your chapter 3 to your chapter 4? And I know it's not sexy. I know it is the most boring work in the world. But how did Alex get to his chapter 10 and a half? How did Anastasia get to your chapter? We going 10 and a half?
2025. Chapter 25. With a strategy on its way.
So coming through that, chapters 1 into 2, 3, 4, 5. We can't jump. Unfortunately, we can't jump. The psychology, the brain, it just has to get used to it. So focusing on small baby steps. And if you can't see how to move forward, you're probably looking too far in the distance. Focus on just that next step. And if you do that, you can literally follow the blueprint and the framework that we use today. And it is so universal, such a powerful thing. I don't think it ever gets old.
Yeah, couldn't say it any better, to be honest.
I found that it helped me to not put the goal to where I want to be in 6 months or a year from now within my trading, because, well, it depends. I might not even know which difficulties I'm gonna face, on my way. I might not even know some aspects of my character that I'm going to be uncovered during my trading. So I figured out that for me, over the years, it was better to check in on the progress. So what have I done different in the past 3 months, 6 months that helped me to move forward? Am I doing anything different, or am I continuing falling into the trap of doing the same thing and expecting the different result? Am I doing what I'm supposed to be doing? Because it's not that we as traders don't know what we are supposed to do. It's not that, of course, there are a lot of golden, nuggets and golden information on the stream today. But in reality, a lot of people know that they are supposed to manage risks, manage emotions, do not trade when they are stressed, not scaling too much in, and so on and so on. But it's about the things that we know we need to do, but we are not doing still. And that's, I think, where we need to be checking in with ourselves to not fall into the same trap over and over and over again.
And it's easily done. You can do it, and you can waste a lot of years doing it. It's like, Rich, the group that we've got, Full Margin, all of us in there have been trading for so long and gone through all of these things. And I think having a place where everybody is together, one of the things that we were doing in Alpha Beta, having a place where people are in that same journey keeps you accountable. Because when you're trading alone as well, it is tough. And sometimes you don't even see some of the things that you are actually going wrong in until somebody turns around and be like, mate, you notice that you're doing this thing and that thing. And then it's like, you sit back and you're like, wow, am I actually making really good money when in the morning when I haven't got decision fatigue? And then while I'm in the afternoon, after I've been streaming and doing loads of work, then I'm losing all that money because, I'm tired and I'm making bad decisions. Something you might be thinking that instantly could be your edge, just changing that one thing in your behavior. So,
I can't add to that.
Just jump into ABL, guys. Everybody, ABL. Rich is there. He's going to be there, and he's going to be keeping you all accountable. Well, there you go. All right, Rich, have you got anything that you want to give the audience? Any little bit of nuggets of special nuggets or whatever we call them?
Special nuggets.
Special nuggets.
Special nuggets.
How we call it? No, but my English has got so bad recently. But there you go.
Yeah,
have you got any nuggets of whatever?
I do. I have this really super cool special nugget that would have done the job perfectly. The only problem is I got too excited, and I alluded to it earlier. And I said, let's stop focusing on Alex's chapter 10 and a half and Anastasia's 25. Just focus on your next step. That's pretty much it. That's all I got. Is just focus on your very next step as a trader, and just keep refining your processes. Stay patient, stay disciplined, and it'll fall into place.
Amazing, mate. Well, there you go, guys. Thank you very much for Rich to come in and do that fantastic presentation. See you later, Rich.
Thanks
for the time.
So there you go, guys. Nuggets of wisdom. Thank you, Henry. I was waiting for you to help me with that. But yeah, there you go, Rich. Honestly, I can't say better things about him. He's really, really, really helped me in my trading, and hopefully he would have been able to help you guys with some of the brief things that he talked about today. So we've got Jonatan coming in very, very soon. While we wait for him just to give us the thumbs up that everything is ready, we'll go through a couple of little things showing off Trade the Pool and some of the new features that they've got. They've got some really cool new accounts coming out soon. So we'll go through all of that stuff. In the meantime, Anastasia, do you want to say anything to anyone, answer any kind of questions while I put up the website?
Absolutely. Well, while we are getting ready for Jonatan as well, we've had so many amazing speakers today, guys. Can you drop us in the chat one thing that you are already taking away from our today's stream into your trading? One thing that you are going to take and implement into your trading starting today. Not tomorrow, not afterwards, but today. You can drop this in the chat. I have notes from every single speaker like on today's stream, and I think it was extremely valuable. No matter where you are in your journey, the beginner, intermediate, or advanced trader, I think every single one of us was able to find something. What Michael was talking about is a completely different world to me. To be completely honest, it's totally different from what I do, and that was very insightful. That was incredibly insightful.
That's the thing. Like, I look at Charles' way of trading and Michael's way of trading. I can't trade like that, even though it's like I just can't. And I've said to Mickey in the past, I find it crazy how you would average into positions and get into positions like that with that amount of risk. But for him, it works, and that's what I keep shouting out to absolutely everybody. Don't do what other people that works for other people. Do what works for you, and that's when you're going to find the most progress, is when you just focus on yourself, really. Oh, there you go. Hold on a second. I'll put that up. So, guys, Trade the Pool. I don't know how many of you know what Trade the Pool is. But when you go to Trade the Pool, you've got the education at the top. So trading VOD. There are so many things. If you're looking at getting into the equities market, even me, I've started, being curious about more entering into equities. You've got all the different funding traders interviews. Some people have got some very, very nice payouts with Trade the Pool, so you can go in there and see those. And yeah, you can also go into get a free account and a free trial with them as well. And that is pretty much it. We'll wait for Jonatan him to give the heads up that he is ready. Anastasia, has he told you that he's ready, or has he just got his camera turned off?
No, I didn't hear yet.
He's not here yet? Oh,
there God. He is.
The market wizard is never made.
Market wizard himself.
Dear Alex Bagholder.
Oh, yeah.
It is I. I am back.
Yeah.
The honor has been bestowed upon me.
Oh my God!
See, he
hasn't been like live, so he's live all day. So he's actually got some energy.
Yeah, he's been in the background all day. He's been waiting to jump in.
John has such a high energy now after having had some rest.
Yeah, definitely. I don't know. I haven't really slept much tonight, if I'm going to be honest. But it is what it is. It's amazing to be here, and the energy from the chat, everyone. Yeah, it's amazing to be here. The positive feedback that we're getting, it's really, really happy to be here and do this last session. We're gonna do what are we going trading? What are we going to do?
Gold is.
Are we going to do live trading?
Gold is in play. I did have a long on it from early this morning, and it is still pushing up, and it's done a lovely break and retest. If you want to pull up your chart.
Have you watched Lord of the Rings, the film?
Have I watched Lord of the Rings, the film?
Yeah, have you seen that?
Who hasn't watched Lord of the Rings, the film?
But have you read the book? Have you read the book?
I haven't read the book. Just because I got glasses does not mean that I've read the book.
No. I mean, I love the movies, right? I love the movies, and then
where is this going?
And then I read the book. It's terrible.
Okay, is this got a point to what gold is doing, or is this you just want to say that you've read Lord of the Rings?
Later in the live stream, I haven't going to tie it all together with risk management and Lord of the Rings. I do have a point, and the point will be clear in a bit. So, Alex, You said
Yes.
you live trading. Really?
Yes.
You want to look at gold?
Good, yeah, look at gold. I was long earlier today. Did take a little bit of a short on the top, but I got pushed out of that because there's a lot of momentum and it looks like it's done a break and retest and a continuation. So I think we actually missed it.
Yeah,
I don't know if you want to
looks
put the chart.
Looks like we're potentially coming up to a range high here on gold. I got my screen here. I think what I'm watching right here on gold is, we're coming up into a general resistance area. I like how when you're not supposed to be muted, you're muted, and then when you're coughing, you're not muted.
I don't know why that happens. I don't know. There's something going on with all my tech today. Everything is breaking. Nothing is going right.
Guys, before we go into the things that I wanted to be talking about today, and it's all about you guys in the comments here, right? So this last hour, I want you to dictate what we're going to be doing here in the last hour. You want me to live trade gold? I'm going to live trade gold. You want me to live trade whatever? I'm going to do that. If you have any specific subject that you've heard about here today that you want me to break down more in detail, let me know in the comments. Maybe you want some live examples of open trades that I currently have open or recent ones that I've closed, and I can walk you through the risk management of those. And my expertise lies in technical analysis and more specifically swing trading. And I have a very simple yet effective way of managing my positions in swing trading. So, of course, if you want more things like that, let us know. Let me know. And
I think we trade very similar, except for you can't scalp and I can't swing trade.
Wait a minute. Did you say I can't scalp?
I haven't seen you guys scalp very well. I'm only joking. No, my swing trading is abysmal, but your swing trading is really good, and we roughly trade very similar ways, just on different time frames.
I think you can. Yeah, Alex, you can handle truth. Well, I know it's a half truth though. I would say like it's it's half truth. I know how to scalp. I might not be perfect at it, but I definitely know how to. Okay, so you guys want me to walk through some risk management techniques. Now, before I go into that, I want to say first I want to drink water, and then I want to say that if there's one thing to take away from this event today, I think, for me at least, one of the most important things for me in you're right, Henry, we would definitely have to set that up to maybe next week. I would say tomorrow, but tomorrow we actually have Saul, the CEO of the Fivers, coming onto the live stream doing live scalping, because this event is one specific event, but we are actually live every Monday, Tuesday, and Wednesday on this YouTube channel. Me, Anastasia, and Alex were in the live trading room, trading live together every Monday, Tuesday, and Wednesday, and soon also Thursdays. So make sure that you are subscribed and hit that bell notification. Okay, Alex, if it's one thing to take away from this event, what would that be? You have to pick one.
One thing, just one thing.
Yeah.
To be honest, I've got to take some of the stuff that Rich said in the last presentation, and that is just focusing on what works for you and focusing on what's in between your head and really doubling down on that. So yeah, that's it.
Yeah, I think that's very important as well. The self-management and the trading psychology, definitely very important. But
but
I mean,
but yeah, those are really great things, guys. But
I mean, it's all one big thing. It all comes together. I mean, it's all, of course, it all is supposed to work together. But if it's actually one thing that has really changed the game for me when it comes to risk management, it's Victor's way of defining fractional risk. I think that's a really, really important subject. So if you guys have not implemented that into your trading yet, then I would highly, highly recommend you do look into implementing that. Void, it's not coffee. I'm actually quite nervous, if I'm going to be honest. I'm doing this every day, but I feel like I'm a bit nervous because we got like it's a big thing. And coffee. I do like coffee. You guys know that. But fractional risk, super, super important, because if you have a profitable system and you follow the way that Victor explained fractional risk, then it should be impossible for you to lose the account. Okay, it should literally be impossible to lose the account if you have a profitable system, and that's the power of risk management. It's really, really something that has really changed the game for me in a big way. Right. So there will, of course, be a. This is going to be able to. This is recorded. You will be able to watch the replay. Of course, those of you who were not here live, you would not be able to get into the competitions and the giveaways and all of that. And that's the beauty of doing this live, and of course asking questions. But the content is available after the live stream. And do not forget to also sign up to the Alpha Beta Labs. Do that right now. You can go in the link in the comment, thealphabetalabs.com. Go there, sign up.
2 courses that are already available that are super good. That one of them's mastering the mental game. So different types of hacks to help you with the very things that we've talked about today. So different types of breathing techniques, anchoring techniques, these types of things. It's a very short course, but the one that I would really recommend is Dirk's Fundamentals. Now, Dirk is a trader of how many years has Dirk been trading, Jonatan? Over 30?
20, 26, 27, I think.
Yeah, so he has worked in hedge funds. He is now trading his own portfolio. Fundamental analysis is his forte. You know, he used to trade a desk for the euro dollar or euro options. I can't remember which one it was, but he's done those basic courses. So definitely go in there, and if you have a little weakness like myself and Jonatan in fundamentals, then definitely go and do it.
Yeah, very good. Like, and Dirk also, apart from that course with Alpha Beta, he's with us 2 hours every Monday. So he has his own segment in the live training room as well every Monday called the Monday Macro Movers, where he break down the macro moves of the coming days. Okay. Let me go through a couple of trades that I currently have open, just to talk a little bit about the trade management of these positions. Now, as a swing trader, and of course as a scalper as well, as any type of trader, patience is he's laughing. Why are you laughing, Alex?
You weren't you were joking, or you were serious about the scalping comment?
I'm serious. You got to be patient as a scalper as well, though.
I thought you were, you're a funny guy. I thought you were making a joke. Sorry. There you go.
All right. Well, that if there was a joke, it definitely is flew right past me. Okay, so in swing trading, you obviously need to be quite patient, right? I mean, you have to not only wait for the setups to form, but you have to also wait for confirmation and wait for the setups to play out, and it can take quite a long time. When it comes to risk management, what I like to do is I like to enter a small position when price is in the area of interest. So when price is in the area around the area where I want to enter. We can take an example of a losing trade on Euro GBP, this one right here. So the general idea on Euro GBP, this is on the daily. You can see that price went in this downwards trending channel, down into high time frame support area, broke above the trend line, came down to hit that breakout area once again, and that's where I entered a small position. Like if we're going to talk in percentage, now I don't really do percentage. I use Victor's fractional risk approach, so it's based on my available drawdown. So I look at my system, what's my max drawdown of my system, I take that times 2, take my available drawdown. So if my max drawdown is 10, take that times 2, 20. So I assume that my absolute max drawdown will be 20, which is way more than the actual number. I take my available drawdown, divide that by 20, and that's going to be my position size. Now, it can be very small positions if you're in drawdown, but that's how you're not losing your account. So Euro GBP, we had a good entry right here. It went up, but then it started going down. And one of the rules I have is never add to losers, but always add to winners. So this trade went straight to stop loss. So that was a small loss. Now, if we're going to talk in percentage, let's say I entered the desired position size of this trade would have been 1%, and I entered 0.25%. So this loss is 25% of what it would have been. So that's an example of a losing trade that became a very small loser because I was not given the chance to add to that trade. Now let's look at another position. Let's look at AD CAD. So this is a current trade that I do have open, and I remember adding my first position right here. And then when I saw this move up on, let me zoom in, on this bullish candle right here on the daily, I added my second position because it went above that trend line. And then I wanted to add a third position when price went above this resistance. So I added a third position here, and then price broke out right here, and I added a fourth position right here. Now I wanted to add a fifth position if we break that high. Now what's important here is, notice how patience comes in here and why it's so important. Price went up 100 pips and then back 100 pips to entry. Okay, so my unrealized profit and loss was 100 pips from entry to the upside, and then it retraced all of that 100 pips. But I have a very simple rule when it comes to moving my stop loss. Okay, I'm always and only going to move my stop loss if there is a swing point, like on the daily. If there is a higher low, if I'm long. So what is a swing point? Now there's a lot of different rules you can use to determine what a swing point is. There's indicators, you can use ATR and things like that. But there's one simple rule is, if you have one candle here, then for this to be a swing low, you need to have candles to the left of it that is higher to the right and higher to the left. And the more numbers of candles that you're going to be adding to the left and right, the more significant that swing point is. But I usually just look at, if is this is a low, is the next candle higher? Yes. Is the previous candle higher? Yes. Then this could be a swing point. And then you add, is the next two candles after or the previous two candles before higher or lower, and then that creates a swing point. Now that's a good rule to have before you visually understand what they look like. Now obviously I don't have to count the candle to know that that's a swing point, but my rule is to only move my stops when there's a swing point on the daily. And I watch this as a swing point, and I see that as a swing point, and potentially that wick as well. So if this candle, the daily candle we're printing right now, if that one closes up here, then I will be moving. I first have my stop loss here. That's the first time. So now the risk is, I've removed 50% of the risk. And if this daily candle kind of breaks out, I'm going to move my stops to this level right here and perhaps add one final position here. Now, the beauty of moving your stops into profit and adding to the position when you have a winning position is that if my first position, this one, would have just gone straight to stop loss, then I would have lost 20% of my desired position. And I would have made, this is a 4.6 R trade, and I would have made 4.6 divided by 4 because it's only 25% of the desired position, and I'm only going to make 25% of what I plan to do. But now when I'm adding, for example, I'm adding a new position here, and if this is going to be the stop loss that I'm moving to, what I can do now is I can enter here, put that as a stop loss. Now that's a minus R trade. But the beauty of this is I can take the risk that I'm removing here and adding that to that position. So as long as this Euro AD CAD holds the structure above this level, I'll be making much more money than if I would have just entered one position here and then had it go to target. So for me, it's all about having many small losers. And this way of trading, I have around 40% win rate. And I do see that I do have many stop losses hitting, but the idea that turns out to be correct can be very, very big winners because I'm constantly adding to the position. And when I move stops up, I take the risk that I've removed from one setup and adding it to the next setup. So I'm basically compounding on my winners, but I never add to my losers. A trade that I closed, I believe, yesterday. No, it was not yesterday because it was yesterday, I think. So I believe that was, which one was it? NCD CAD, I believe. Yeah, so this one right here. This is another example of where I entered one position here, and then I saw strength and a retest, so I entered a 2 position here, and then we hit that trend line as resistance, and we have no swing point. My stop loss is still here. And then you have a swing point right here. Price breaks out. What I do is I move my stop to the new, below the new swing point. Whatever risk that I've removed here, I have now added to that breakout candle right here. It's a very, very small move to the upside. No, not that one. It was, I believe, this one, that breakout candle right there. I added what I removed here to that position right here. And then you have this breakout. It went into profit. Right before hitting that profit, I moved my stop to below that wick. So a trade that was in the beginning a 3R trade turned into be like a 5 or 6R trade with adding to this position. And the most important takeaway from this is to be patient and wait for the trade management plan to play out. And my trade management plan is very simple. You move your stop loss every time there's a new swing point, and that is to me a swing point. This is a swing point, and that's a swing point. And whenever price breaks above the last local resistance, that's your time to start adding to that position. Because otherwise, you might just hit that as the equal highs and then move back down. So that's a quite simple trade.
Jonatan, we have a question.
Yeah.
Put all your stop losses together when you add to your positions. So they're on one place, right? You move them along with a new position added.
Yeah, I do view it all as one setup basically, and I try to move that stop loss within that same setup. So the stop losses will always be at the same area. Now, it's important that before you enter a trade like this one, you need to have a trade management plan. So before entering a position, you need to make sure that you have the plan ready, because if you start making up your plan on the fly when you're in the position, you're going to start making mistakes. You're going to make impulsive decisions like Alex is very good at doing. And that's why he's scalping, because he can't make any long-term plans.
But I make money on my short-term plays.
Yeah. Well,
Shame
right,
about
so
my long-term plays, though.
we got a house to Solana, by the way.
Oh yeah, I'm leaving. Bye. See you later.
Yeah, there we go.
He knows where to hit me hard, doesn't he?
Yeah. Well, I'm sorry about that. Truly am. So we have a USD CHF here. Here's another example of adding to a winning trade. So if you look at the 3-day, you can see that USD CHF was at a resistance area right here. Now, the plan here was to basically short resistance down to the middle of the range. So that's the overall idea. Short resistance, and what usually happens when price comes into a high time frame resistance area is you form some type of range, usually a well-defined distribution range. You can see right here, distribution range and distribution range. You're looking at the lows. So you can go into the daily, you're looking at the lows, and you want the lows to break. So the lows broke here, came up once again, break and retest of the lows. On this candle, on that bearish candle is when I entered the first position. And then when price confirmed and broke down, I entered my second position, but I did not move my stop loss because that's the swing point, okay? So I didn't move my stop loss. I did not add to the loser because this might just have a hit that stop loss. But then when price broke that low, I entered a third position, moved my stop here, and then it went down to take profit. So adding to this trade 3 times, and notice that my stop loss was always up here. I never moved that stop loss because there's no swing point on the daily. So if I didn't hit TP, if I had an open TP, then this trade would actually have already been open today. But then I always use set stop losses. Take profits, because if I see a high time frame level below, I want to exit at that level. But that's just a general breakdown of how I add to positions and manage the positions. And the key takeaway here would be to make sure that it depends on how you're trading. I know many traders, they like to get better entries, kind of scale into positions even if they're in a drawdown. But when I'm going long, I want to buy strength, and if I'm going short, I want to sell weakness. So if I enter a short position, I'm going to add to that short position the more weakness I see.
This wasn't anything that Jonatan was talking about. Trump has just announced that he's putting 50% tariffs on Canada for metals and stuff, and USD CAD has just gone crazy. So that's
is that happening now?
Yeah, that's just happened.
Right, I was actually short this.
Yeah, I'd go on that. Go on a 1 minute or the 5 minutes. Sorry.
Wow. Okay.
How many pips is that? 70 pips.
On the
You
1
gotta
minute.
love it and hate it at the same time.
Wow, that's 93 pips on that 1 minute, 5 minute. The 5 minute candle is 93 pips.
Aye.
Gotta love Trump.
What I love it. I love the volatility. Yeah, it's fantastic. But what a time to be alive, like everything just is going on in the world, and we get to sit in behind a computer and trade it. So it is quite interesting. But
I think we should definitely. I mean, the White House should definitely launch a signal service. White House official signal service.
They have already made a crypto coin that unfortunately half of us got into. So they did do a Trump coin. I wouldn't be surprised if they did a signal service.
Amazing. All right, so let's see. Do we have any questions on Dante reaction? Yeah. Tesla will melt down again. I did see that Tesla has been breaking down heavily lately. But this is a good question right here.
Across the board, equities, risk on in general has just been a little bit weak.
Oh yeah, look at the S&P 500. This is we're now getting into bear market territory. I mean, this is technically all we need is like a lower high for me on the daily here, and we're in the bear market. Technically a downtrend on the daily, and which kind of lines up with the idea that we talked quite a lot about with a potential recession this year. I mean, this definitely lines up to that, and very a lot of interesting things happening. And also look at Euro USD, a move that I missed unfortunately. But looking at this, I thought that this was going to be a cyclical move that might have taken a couple of weeks. It took 2 days to reach the breakout area to resistance. So I think, very, very powerful moves. I think we're entering. We can look at things like, if we go to Euro AD. Now, Euro AD has broken above a level where it has not created structure above this level since 2020. Okay, when I mean structure is actually, just wicks and candles, but actual structure. And that happened last time in 2020. So either this is just a big fake out, which I don't think it is. You go to Euro NCD, same thing with Euro NCD. We created structure above this level last time in 2020. So either we're entering a new phase of the market, a new cycle. That would be making a lot of sense to see equities have a maybe even enter a bear market. I mean, it would not be surprising to me to see a recession in happening in the markets.
Yeah.
Which means a lot of volatility. Where's that question? I had a question. How often in the day do you manage your trade? So it depends on, so what I do is can go back to an example. So this is again an open trade that I have. I don't have any alerts on this now, but I do I have not moved my stop loss yet. I do have my stop loss here, I believe. I have not moved my stop loss on this position yet, but if we break, so what I'm going to do is I'm going to add an alert here. Now the beauty of TradingView is, okay, I'm on the long chart, so I'm going to remove that. I'm going to be adding an alert here, and then I'm simply going to go into the alert, and I'm going to write move stops up. And then to make everything easy, I can just add a line here and name that. Go in and I can type new stop loss, so I know where to move that new stop loss. And I'm also going to be adding an alert on that level. I'm going in, I'm adding an alert, and I'm going to say on the alert message, it's going to say possible invalidation. Possible.
Are you sure you read Lord of the Rings?
No, I listened to it, which isn't it obvious? Okay, so possible invalidation. So now we have two alerts, okay? One alert above price and one alert below price. Now, if price never hits these alerts, I don't really have a reason to look at the chart. I don't really have a reason to manage to trade. So it's not really up to me how often I manage to trade. It's up to the market. So you shouldn't say that, okay, I'm managing my trade 1 hour a day or 2 hours a day or whatever. What you should be saying is I'm managing the trades based on what the market is doing. And if the market isn't moving, I'm not going to be managing the trade. Now, of course, there is the timing aspect of swing trading that is not in scalping. You know, in scalping, you're in and out of the position in minutes. With day trading, it's within hours. And in that short amount of time, you don't really have, the structures aren't going to be massively changing too much. Because you're most likely trading between major news events. Now, we can ignore things like Trump, tweeting that he's gonna, I don't know, start the prop firm or something, well, some crazy stuff like that.
Trump-funded
things like
traders.
that. Yeah, Trump trade. Yes, I don't know. So you're trading between the news events as a scalper and a day trader. Now, as a swing trader, you're obviously holding the positions open throughout news events. You might not be adding to positions when there's a news event, but you're holding the positions open through news events, which adds a layer of risk, and that risk is time. So if the market starts ranging like this, maybe comes down here, and in the end of the month, we're still here, and we have something like FOMC or NFP coming up, then I got to think like, okay, is this the same trade? Because my trade is based on this trend, okay, not a trend into a range. I'm not a range trader. At that point, I might have to close the trade. So it's not entirely true that I only go with the alerts. I actually do check all the pairs about once every day to make sure that we're not in a range and lost the momentum of the trade. But that's where patience comes in. I use the alerts in TradingView to enable me to not have to force myself to be patient, right? I use tools that can help me be patient, and that would be the alerts. And I think it's a very valuable thing. How to deal with pessimism. Be happy, man.
Just short everything.
Pessimism. I mean, pessimism, I guess, it stems from an emotion of negativity, and we can't control our emotions, right? But we can control our
I would make it work for you, man. If you're a pessimist, double down on being pessimistic, man. Just look for, I don't know, countries or companies that are just, overinflated and just look to short them.
I don't think anything good can come from pessimism.
I don't know. I know a few pessimistic traders that all they do is short stuff, short low cap coins, low cap
I think we're talking about different things here, though. I think we're talking like
what kind of pessimism are we talking about? Are we talking about pessimism when you get into a trade? All you can think about is just closing it while it's in profit because you don't think it's going to work out? If that's the case, then probably the best thing to do is just set and forget. And when you get into a trade, throw the computer out the window or just turn it off or go for a walk or do something, just make a rule that you're going to, when you enter in the trade, you've accepted the risk and you're not getting out until it either hits the stop loss or take profit. That's what I do. I set and forget the majority of the time. If it's a pessimism about the overall state of things and companies and countries or the economy, then look for markets to short. I don't know what type of pessimism you're talking about.
I think we're kind of going a bit too deep on that one. Okay, Anastasia, do you think you can be profitable with the one-to-one risk to reward?
Yeah, 100%.
I think you can, but I think it's about how probable it is and how difficult it will be. Because obviously, to be able to be profitable with one-to-one risk reward, you need extremely high win ratio, right? Mm-hmm. Well, depends how profitable you want to be. At least you need to be definitely above 50% to be profitable. Now, how able to sustain mentally the periods of time with one-to-one risk to reward when you're not profitable? Because if you are just above 50%, let's say 55, you're going to have a lot of periods, long periods of time when you're not going to be profitable at all. And then it's a mental game. So either you develop a strategy which is extremely high win rate, right, which is difficult in itself, or you really need to grow mentally as a trader to be able to detach from, losing streaks for quite a while. So I think it's possible, definitely it is, but it's more difficult and it's less probable because we are all humans. And I think the weakest part of being a trader is our emotions, right? So as long as you can work on that part, I think it's fairly doable.
Yeah, it's definitely possible. I think, if you guys remember, if you've been in the live trading room last year, I played around with actually a negative risk to reward system, which worked out really, really well in the beginning. I looked for trades that I took my regular system where I'm looking for like 2 or 3R, and then I started testing. What if I take exactly the same trades and I'm just gonna exit at half an R, which is negative risk to reward, and I saw that my win rate was super high, like 80%, and it turned out to actually be profitable. So I'm like, okay, I'm gonna start trading that. But I noticed that the margin for error was so incredibly small. Like if I had 2 losers in a row, I was all of a sudden down 2R. Now I need to win 4 trades just to get back. And if I make an error based on making errors, I'm going to dig an even deeper hole. So you have to trade almost perfectly if you're going to be using a low risk to reward system, because there's just no margin for error.
Yeah. And I think with Jack, what you said here, the best thing that you can do, by the sounds of it, you're putting too much on the trade. So you're actually getting emotionally involved in the result of the trade. So, and this is all serious now, cut the risk in half. Just cut the risk in half or even more, to the point that you actually don't care if the trade is going to hit or not. Like, it's not going to do anything. If it wins, it's not going to do anything, like 0.25%, to a point where you're just hitting those trades and you're getting more comfortable with the setup that you're using. Eventually, then you'll start adding more risk naturally because you're so used to seeing that and it playing out and you executing on it. That's the best thing you can do.
Yeah, we have. This is, first of all, let's cover this one. How many trades? How many trades do you take in a day? So for me, I look at how many trades I take from swing trading. How many the trades I take in a week and in a month, because a lot of days I'm not going to take a trade. Last time I took a trade was my latest position, I believe, was on 80 USD, and that was entered on the 26th of February. That was my last swing trade that I entered. But then if I look at my day trading, which, yes, I do actually day trade during the live trading room. Yesterday, I took 20 trades on gold. So it's very different depending on how you're trading. And I was actually profitable, Alex, taking 20
Wait, hold on a
trades,
second.
scalping
20
on gold.
trades in gold.
Yeah,
Very impressed.
yeah, up 1% on the account.
Very nice. Very nice.
Very good.
Check
actually.
EuroCAD. Look, USD CAD is absolutely shooting up, to be honest.
Yeah. So EuroCAD is one of those pairs that I. So there's no way for me to trade this. I mean, the only thing I could think about is perhaps wait for confirmation of a rejection, because obviously at some point you're going to you're going to hit a resistance. You're going to. By the way, Vinicius, you're the person who's going to be trading against me to win a 20K high stakes account. So, guys, that's what we're doing. Some of the things we're doing in the live trading room is we're inviting the viewers to trade against me, and if you win against me, you win an elevation account. And 20K high stakes is actually pretty nice account to win. So if you're interested in that, make sure you send an email to the Fivers. No. Trading room at thefivers.com. Okay, so we're hitting resistance, right? And if I put a ATR indicator on here, we'll see that on the daily, surely, yeah, we're just hitting the daily ATR over and over again here. So it's very, very extended. I think we can go in here. We can look at the 2 times ATR, see where that is. Yeah, we've hit the 2 times ATR multiple times in this move to the upside, which is obviously, it's quite an extreme move. You can see usually it keeps within that ATR window, these ATR bands. So one way for me to perhaps trade this is, of course, zooming out and looking at the higher time frames. I'm going to be looking for shorts. I mean, there's no other way for me to view this. If I go to the weekly and I ask myself, when was the last time we created some sort of structure above this level? Well, that was during the financial crisis of 2008. 2008, that's quite a long time ago. So what's the odds of EuroCAD trading above this level? I would say not very high. The odds are higher that this is going to be resistance. So I will be looking for shorts. Now, what would that look like? Well, it's going to look exactly like it did on USD CHF. So we go back to USD CHF, go to the daily. This is what it looks like, a distribution range on the daily. So that's what we're going to be looking at on EuroCAD. And my target is going to be the breakout level right here. So this is going to be a big move, right? It could potentially, if we enter in here, we're talking about an 807 pips move. That's a big move. That's a big move. But on the daily, to me, makes perfect sense. Makes absolutely perfect sense. So what I would be looking for on the daily is something like this, and then I will most likely be entering here.
Maybe that's going to be a little bit of manipulation, a little bit of stop hunting. Give it a little bit, a little bit of oomph.
Yeah. So this initial position with this stop loss. Now we're talking about a very, very big stop loss. So is that how big stop loss would that be? Oh, okay, 350 pips, probably a little bit too wide, but depends on what market structure would be doing. But then I would be adding, right? I would be adding, if I get something like this, then I could easily add a bigger position here with that being my stop loss, and now that would be like a maybe 2-hour trade. So it's all about finding the areas of interest, and when you have the reaction you want at the area of interest, you start building that position. And then you might also, when you have the direction, because if price does come up here and then starts moving lower, you now know that you have a high probability of price reaching lower levels, maybe all the way down to 1.5. So you go into the 4-hour, and on the 4-hour, you might find very good trends to trade, and you might find multiple trades on the 4-hour within that overall daily move. So that's EuroCAD. Now, even if you're a day trader, scalper, or whatever, having the knowledge of the higher time frames from a swing trader's perspective and a cycle perspective, because this is what it is. EuroCAD this is just a cycle move, which happens, I would say, once every other year or something like that. And once you see the reaction that you want to see for the higher timeframes to confirm a direction, you have the best opportunity to go into the lower timeframes and find positions with that bigger trend. So, for example, is this a good time to go long? Absolutely not. I would not go long here if it's not if you're scalping, then yeah, you might want to follow that momentum to the upside. But I would not go long here. But if you see the confirmation here on the daily and the breakdown, then you have a wonderful opportunity to trade this whole region to the downside from a day trading perspective. And that window might be open for, 3 months or so. So you have a 3-month window on EuroCAD where you can go short only with high probability of trading with the trend. So even if you're a scalper, day trader, whatever, make sure that you do have an understanding of what's happening on all timeframes, because it's all about the finding the direction in the market, especially with forex, because forex is rarely giving us directional moves. If you look at the monthly for EuroCAD, it's just one big range, and the whole range is 40% that has been played out over, talking about, I don't know how many years is that, many years, 15 years or something like that, 20 maybe. So
yeah,
trying to find a direction in the ranging market can be difficult.
The bigger the time frame as well, the more people that are looking at it, and the more bigger institutions or companies are looking to get into those type of areas. It's not like, your little retail trader that is just trying to get into the middle and just catch a couple of pips in the day. Those are places where commercially people be wanting to sell. So that's a really nice spot, and I never look at EuroCAD, but it's definitely interesting just looking at that on a purely supply and demand type of outlook.
Yeah, what's interesting is we have it for almost all the Euro pairs. We have Euro NZD as well. You can see here on the monthly that we're definitely creating something new, and this tells me that either like every time we enter this area, ever since 2010. Every time we enter this area, there's a monthly wick, okay, which tells me that within 20 days, we might have a high time frame top on the monthly, or we enter a completely new cycle that we have not seen in Euro NZD since the financial crisis. Now, what's the risk of that, and what's the odds of that happening? I would say only if we have a major shift in the macroeconomics, which might happen, because I do believe that there is a chance that we're at the end of the business cycle. And what happened last time? Well, it was the financial crisis. So there might be the possibility that we do see a whole new market cycle, which then, look at what happens last time. Well, this happened. So we might either be in for a short trade down, 1,000 pips, or a move to the upside for, that's not 6,000 pips, is it?
It is.
Wow. Okay. Yeah. I mean, that would be nice, but
I mean, with Trump's tariffs, right, and now that the European Union is trying to look for the other solutions, right, it might be possible. So I think we are on the edge of a very interesting situation within the next couple of weeks, that is going to set that tone for the next months to come or years to come even.
Yeah, it's absolutely crazy. Yeah. This is also great. This is the best time for us to be trading. Like, it's probably the best time ever to be a trader. You've got ways to make money so cheap being a trader in this day and age. The tools are the cheapest they've ever been. You've got funding now. Spreads on funding accounts are next to nothing, and execution is something that you're not going to get with your standard CFD broker. So really, I'm
looking at your USD right now. It's like 1.0 to 1 in pips, which is obviously very, very good. And this is in a quite volatile market as well. So it's the spreads on the fiver is obviously very, very good.
Yep.
Do we have any questions on the things that have been covered today? I would love for you all to ask whatever questions you have in the comments, and we would love to help you guys out. Well, it looks like we're almost at the end. Wow.
Yeah, you've been chatting along.
I've been. But you are free to interrupt me whenever, you know.
No, I could not interrupt you while you're talking about your swing trading.
If the market moves opposite to you, then your losses may be huge. I don't think it will give good risk to reward. Is this when adding to the position? I mean that makes sense. You know, if you're adding, but you got to make sure that you're not adding more to the position. You have to have a max of the amount that you want to be adding to the position, so that when you're at that maximum and it hits that stop loss, you're not going to lose too much. So on, for example, AD CAD, which looks great now, and hopefully this is going to be continuing like this. You know, I've added here, 3 positions, but I would like to add 1 more position. If I don't add 1 more position, then this will not be as big of a winner as I would have hoped for. But I do recalculate the risk on each of these positions, and I make sure that if all positions hits that stop loss, it's not going to be too big of a loss.
Alex is saying about AI for trading. We actually did have Michael covering how to use AI for building the portfolio on stocks. So you guys will be able to rewatch it afterwards and repeat this information, because we did have it covered. Actually, it was a very, really interesting part. This is one of the opportunities that has never been accessible before. And I think like traders need to really pay attention to what's happening with AI.
Oh yeah, definitely. AI is. I mean, I've thought about this a lot, and I think, you know, in the next 5 to 10 years, trading is going to become quite difficult. So I think now's the time to trade. Now's the time to get into prop firms, and now's the time to make money. Because what we're doing now is, if you look at news trading, it's impossible to trade news events because the market moves so quickly, and you have trading algorithms, you know, being at the very place where the numbers are being released at the very instance, and then they have, you know, high frequency trading, and they're you know, building their office so close to the actual exchange that their orders are front running every other orders using AI. So you cannot compete with that from a news trading point of view. And I'm afraid that we're going to see something similar with day trading and scalping. It's going to be incredibly difficult to pull money out of the markets as a scalper and a day trader. The more AI comes into the market, and the more trading algorithms and bots that we have based on AI, especially if we got like AGI coming, like super intelligence, that's going to be difficult, very, very difficult. And that's why I liked looking at swing trading, because the intraday price action is fairly easy manipulated, but it's very difficult to manipulate a cycle move. You can't manipulate the business cycle. You can't manipulate the weekly weekly trends, okay? But you can definitely manipulate intraday price action. Now, there are instances where central banks and traders for institutions working, you know, dealing with central banks have actually been caught manipulating prices. And there's a story on that on the pound, for example, many years ago. But it's possible. But it's definitely not possible to manipulate, if you look at AUD CAD, a trend like this. This trend exists because of underlying forces in the economy and human behavior, that is. And that's why we see trends and repeatable patterns, because human emotions have been the same since the Stone Age or whatever, and they're going to be continue to be the same for a long time, and it's repeatable. But with AI, we have a new type of intelligence that might actually influence things on an intraday level. So I really do think that now's the time to be trading and to pull as much money as possible out of the market, because it's going to become very, very difficult.
Yep. Okay, so I think we've come to the end anyway. 5 o'clock, isn't it? Anybody got?
It is. Do we have any? We want to cover like what happens now? With the competition, with the event, and
so I'm gonna go
prices.
through all of that stuff right now. First, let me put on this screen. So obviously, there you go. To put on this screen. For some reason,
I had to remove mine first.
Wow, StreamYard has got so bad recently with its bugs. So if you can't see this, for some reason I had a bug that I couldn't see this without going on incognito. So if you can't see this, go on incognito, enter into this URL, and then you'll get all of the different brand packages. I don't know, not package, but downloadable content. So you've got a trading plan that you can use. You can copy and paste that into Notion and use that as the digital version instead of having a PDF. You've got an ebook from Trade the Pool. You've got the Mindset Hacks course from Alpha Beta, and people have already gone into Alpha Beta and they're putting their trades. They've already started introducing themselves. You'll be able to see the trades of people that have taken the last couple of days. You should USD CAD yesterday and then gold today. And then Tradelicious, you've got a cheat sheet with all of those different things. So go in there and get yourselves some of those materials. With regards to the competition, so the competition, everybody knows that have been informed. The first 5,000 people would have already received an email. That is starting tomorrow. So good luck. Don't go too crazy straight away. It's a marathon. Just play it properly, play the game properly. And with regards to the exclusive managed risk accounts, those evaluations will be available after the weekend once all the emails go out. Now, again, they're exclusive accounts. They're not going to be available in the future. So go in. They're very reasonable price. I think they're only about $50, but the upside is, if you're able to pass them, the upside is incredible. So what else have we got to go over other than that? We've been over...
maybe just an idea here, because I do see that there are a lot of people not seeing the things that you're seeing. So, like you said, go into incognito on your browser, see if that works. But I'm also thinking maybe we're going to send out an email, correct?
Yes, we will. That's a good idea. We're going to send out an email with all of these things.
And maybe we should tell the
Marketing
people
team
writing that email to include this in there as well.
You're not just a swing trader.
What am I as well? What do you call that?
It doesn't matter. Let that go over your head. Other than that, guys, that's it. I hope you've enjoyed these sessions. We do have our Twitter profile as well, which is the MasteRisk Twitter profile. Go in there and give it a follow and stay up to date with some of the topics that we've talked about. We're going to be uploading many different things to help you with risk management, because honestly, it is one of the most important things, especially, once you go through an evaluation, the evaluation is the test, and you can go heavy on the risk and you can pass it fast. Some people like doing that, but once you get a funded account, that's when you really need to bring it in. It's no longer a test. It's your money. You're making money from this, and it only takes one account to set up yourself for a whole, taking that money and opening another account and a trade copy, and then suddenly you've got a really nice amount of funding that you actually can make a living from. And I promise you that you can make a lot of money if you do it properly. If you don't do it properly, then you're going to be chasing your tail for years to come. So anyway, guys, Anastasia, thank you very much for being the host today. You've done an amazing job. How was it for you?
Alex, You too. No, it was my pleasure, really. We had amazing speakers. Thanks to all the speakers. Thank you, Jonatan, for your time. It was an amazing lineup. Lots of valuable information. Everyone who joined late, who were late perhaps, you can rewatch it. The recording will be available. Make sure you're not miss out on any part of this marathon.
Yeah.
And make sure tomorrow we got Saul coming on, live scalping. Saul's going to be with us tomorrow. Alex will be there as well, I hope. And we're gonna do some live trading. We're gonna trade gold. We're gonna trade Euro USD live. So make sure that you come tomorrow as well. Same time, same place.
Exactly. Now we're going to be passing you all over. If you're interested in the equities market, you're going to be going over to Trade the Pool, where you're going to have some of the nicest moves because the equity markets are open now. And by the look of forex, it's going to be a crazy, crazy day for the equity market. So we'll see you then, guys. Bye. MasteRisk free online marathon is going to start super soon. 6 sessions, 8 experts, and